whether it be consumption, whether it be capital growth. I think most of the domestic-facing sectors probably will do better in this uncertain global environment. And we believe that many places the valuations have corrected meaningfully. There is nervousness across the street. And the consensus is that this year is going to be a very tough year from a return perspective. So in this environment, in the short term, I think we should get good bargains from an overall perspective. And we are looking from a portfolio construction quite constructively in looking at companies which have strong franchise, which can gain market share. Nigel, nobody is talking about many Indian companies, Indian entrepreneurs gaining market share because they are cost competitive. They are far more productive in the last decade or so. So in my view, many companies and sectors you could see Indian companies gaining market share at the expense of some of the other competing nations. And we have to watch out. And one more important trend which I am seeing, I think which should be brought to notice, is the divergence between the index return and the median return of the index. Last quarter, which is the fourth quarter, the NSE 500 index return was negative 6.5%, but the median return of that index was negative 12.5%. 6% gap is one of the highest we have seen in the recent last few years. And that shows that the few stocks in the index is holding the index higher, but the breadth of the market has been extremely poor. So our sense is that this will be a stock pickers market. Going forward, you have to make sure that you are betting on right franchise, right businesses, right promoters, and navigate this without losing capital. And I think one needs to keep on checking whether the business model has been fractured or it's got stronger. So I think it's a classic next 18 to 24 months will be a bottom-up stock pickers market. And the easy money era, which we saw for the last 3-4 years,
which is a point you've made, which is a point you've been making, and I think absolutely bang on. Pankaj, one specific area. So I have two questions. One, which are these companies where you think market? Let's talk companies, if you will, where there could be market share gains. Second, you had a view on chemicals, a positive view on chemicals, and now that, according to some sector, which gets hit because of these tariffs. I'm sure you would have looked at. And your view was own a bunch of these chemical companies, and actually there was a bit of a recovery which had started. Maybe it is still on and the stocks have come off the lows. But what's the impact there? Yeah.
So if you take a slightly medium to long-term view, Prashant, the largest country manufacturing chemicals is China. And we are a very small drop in the entire ocean. I think it's a great opportunity for Indian chemical companies to gain market share. The export data which just came some time back yesterday, it's very encouraging to see a very strong growth across chemical companies on the export market. And I believe that if manufacturing has to be protectionist, chemicals will find its favor across, and Indian chemical manufacturers across CDMO, CSM, as well as some of the important areas where they are focused on domestic market should gain prominence. From a result perspective also, I believe that though index will give you 11, 12, 13% return, but many of these companies are so well positioned and they have a low base coming in that this year we should see a 20-25% growth in across many companies. And fourth quarter in our preview is looking very healthy for most of the chemical companies as you move ahead. So don't forget that the next 12 to 18 months, it will be growth along with quality as a factor, which should outperform over a period. And I think companies which can deliver above market returns in terms of growth should find favor among investors. And chemical is one sector where I believe that India has a brilliant opportunity to gain market share at the expense of Chinese. And across the board, I think we are very cost efficient now from an overall perspective. So I think I'm quite okay with chemicals as a sector. Need to monitor it regularly, but I think companies have a very strong moat. The second important part is don't forget that China is a very important piece in the entire metal supply chain. Prashant, you'll be surprised to know that there is a small alloy called anti-money alloy. Just go and search on Google. That alloy is used for ammunition, battery storage and stuff. China decided not to export. And in the last few months, the $10,000 price has shot up to $65,000. And US doesn't produce it. China has 65% market share. And once China stops, the prices just went 6x. And US can't supply ammunition across the world in terms of bullets. So don't ignore that China is an important piece across different commodities. And if China decides not to export or stop the supplies of these, I think a world will have problems. So in many commodities, you could see inflation coming back very significantly. And if it happens in chemicals also, it could be good news for Indian manufacturers.
Okay, so absolutely. I mean, it's not like China doesn't have any chips to bargain with, rare earths, some of these specific, materials, like you said. Definitely, that will be their bargaining chip. And then, like our previous guest said, there's the nuclear option, US treasuries, right? So let's see how this plays out. Thank you very much, Pankaj. Great to get that perspective from you this morning. We look forward to connecting again soon.
Surbhi, before we take a break, if I can just point out, I saw this flash. The 10-year is now, the US 10-year is now 4.5, which basically means we've seen a 20 basis point moves from yesterday's close. If you can have that line up on your screen, that is humongous. 4.48. Wow, that is a very, very large move. I mean, actually, stock markets are, the lesser problem in that sense now, if yields are moving the way they are.
It's not just the yield, Prashant, that's moving. The equity futures have completely dunked again. Dow futures are about 500, 600 points down. S&P futures are down about 1.6%. Same for NASDAQ. So equities down and yields seem to be rising.
I think
higher.
there was an auction yesterday, in the US, and I think it was.
But that would have shown
that was
through
during trading hours.
This is after close a 20 basis point move.
Yeah.
I mean, and I think we should pay attention to this and maybe get views on. We have a whole panel joining us at 9:45 to talk about the RBI, and I think we should discuss this as well. So two things have happened.
But I don't think, Prashant, it's not a 20 basis point move, because this morning, before we at around 6:30 a.m. in the morning, it was already at 4.36, 4.37. So it's actually a 10 basis point move, which is not small, but it's not 20 basis point. Because earlier this morning I put out a note.
What I'm saying is, yesterday we closed at 4.29. We're at 4.5, nearly 4.5. It's a 20 basis point move from yesterday's close in New York, the rates market close.
Right.
So it's a very large move. And the point is that, essentially the market, the realization is now kind of creeping in that these tariffs are here to stay. This 104 tariffs have gone into effect. These reciprocal tariffs have gone into effect. That is, I think, what is happening. The yuan, by the way, what has also happened is that the yuan move is hitting Asia Forex in a very large way. You look at what's happening to the Indonesian rupiah. If you have rates, look at the Korean won. I think multi-year lows on all these currencies.
It's midnight in the US, 9:30 our time. Now you know why these moves are happening. It's symbolic.
It's
the tariffs have
9:33 now.
kicked in.
Yeah.
And this is the reason you're seeing these dramatic moves across currencies, across rates. Why suddenly US futures have dipped further? It's just to acknowledge the reality.
We should actually...
US tariffs
We should
are
actually
a
put
reality.
out a flash as well. It's 9:30, 12 their time, right?
So 9:33, there was, our time 9:33, which is 12 o'clock midnight US, tariffs were supposed to come in. Tariffs are official, reciprocal tariffs are here, and the markets are, for what it's worth, acknowledging that with a further sense of unease.
That's the flash.
Yeah,
that
that's the flash.
US tariffs will come into effect, and, as they say, sometimes you've got to wait for it to actually happen to believe it. And now it has happened. We're 3 minutes in. And
it's
we've got a
4.51, by the way, the 10-year yield. I mean, it's not stopped. When we started this check, it was just under 4.5.
Yeah.
4.51 is just reacting to the reality of it. I mean, we knew it all along. Markets knew it all along.
Yeah.
But it's real. It's official. Those tariffs have come in on all U.S. trading partners.
And what we'll do is we'll also put out some lines on what's happening with Asia Forex. The rupee, of course, is lower. But I think the low was about 88. The high on the dollar rupee was about 88. We are, of course, 86.57 or whatever, about 1/3% move. But many other currencies are down 0.5%, 0.6 odd percent, and we'll sort of put that up as well. But this is essentially, the tariffs taking effect and markets paying attention now and reacting to the fact that maybe this is here to stay and this is going to be protracted. And there is no deal, because there were lots of, obviously one would hope that before the 9th of April, there will be some deal, people will backtrack. I mean, it's just human nature to hope something will happen. But we are past that point, and the tariffs have now gone into effect.
And yeah, I'm glad they fired the dollar yen, because there is a rush to safety. So typically you see, the yen as a safe haven. So it's strengthened even more, 145. The euro is rallying. I mean, in all this, the euro is typically been stronger. And that move is continuing. So 0.5% increase on the euro, 0.5% appreciation of the yen, while other currencies continue to tumble.
Absolutely. So this is the big story which we will continue to track in terms of the market reaction there is. We'll take a quick commercial break as well, because, there is a fair bit happening here in India as well. That, Delhi EV policy, etc., also in focus. So we have a couple of important guests joining in to talk to us about that. Stay tuned. Coming right back up.
Welcome back. Actually, given the kind of immediate moves in global markets as these tariffs come into effect, our market hasn't fallen too much. It's the same 150-point dip. Pull up the intraday chart on the Nifty if we can. There you go. So it's not like suddenly our market has taken a nosedive because of the risk-off sentiment that's playing out elsewhere, which is good, which is a good thing. So not too bad. We'll get Mitesh in just a bit to talk about further trading strategies in this environment. But for a brief bit, let's just look away from US tariffs to something which happened here yesterday back at home. And it was fairly dramatic as well. The Delhi government's draft EV policy 2.0 has recommended phasing out of CNG-driven auto rickshaws, petrol and diesel vehicles as well. Yesterday, IGL, of course, was under quite a bit of pressure on the back of that development. So how can this perhaps play out? Will companies' launch pipelines be impacted? Let's get in some thoughts with Mr. Venkatram Mamilapalle, country MD and CEO at Renault India, and Arun Malhotra, auto industry expert and former MD of Nissan. Gentlemen, thank you so much for joining in. And that's really the point, because if I go back and look at what the policy is proposing, and we'll just put up those graphics. So no CNG auto rickshaws, no three-wheelers which can be CNG or petrol or diesel, starting from Independence Day this year. That's just a couple of months away. And not just that, they're also saying that no CNG or diesel or petrol two-wheelers from next year, which is 15th August 2026. So they're really accelerating the timeline. So in this context, your first thoughts, if I could come to you first, Mr. Venkatraman, will this hurt industry's immediate plans? I mean, this is Delhi going all EV suddenly.
Yeah, thank you for having me. Good morning to all. What is important is health of the people. So we know what's the air quality index in Delhi, and it is important that government takes some steps. Auto is just a portion of it, and we know that there are many other factors which are engaged in bad air quality index, what we have. However, the movement towards EV is a right step, but moving at a speed at which the adaptation will become a challenge is an issue. So first of all, we need to have the ecosystem. I don't think that we have the ecosystem which can take the changes so fast. And therefore, it is necessary that we first engage in the ecosystem development as government, and then put the regulation and policies, which are still in the draft, by the way, into force as quickly as possible. No doubts that we as a nation have to take a leapfrogging steps, but Before that, we need to do our homework. So in my opinion, this seems to be too fast, but it's in the right direction.
Okay, seems to be too fast, but in the right direction. Mr. Malhotra, if you could comment on this, sir. I mean, I don't know how disruptive this can be for existing OEMs. People have capacities. I mean, CNG, whether it's even petrol, diesel, I mean, big capacities. Is it going to be very disruptive specifically for the three-wheeler and the two-wheeler space?
So, let's take two-wheelers and three-wheelers separately. As far as three-wheelers is concerned, this is about 20 years backward story. In Sheila Dikshit's time when the CNG was introduced, and that was seen to be a landmark move. Delhi was far ahead. Now, CNG is everywhere in Delhi as far as three-wheelers is concerned. So this shift, welcome, because definitely EV is a much more purer fuel or much more less polluting fuel than CNG. But I don't think we are absolutely ready for it. Just to take a basic case, Delhi is the largest market for three-wheelers. And today, if you have to combine, slice the market between passenger and commercial application, which is load application, load vehicles, CNG, EV vehicles are just not available. And even CNG charging infrastructure, petrol or EV charging infrastructure still is a constraint. So that's be a big challenge at this point of time. But I think August 25 is a very, very aggressive move. The way government policies follow, the note paper will agree, it will get watered down or get delayed. But I think manufacturers will start thinking of it. That's the positive part. As far as two-wheelers is concerned, one of the challenges today, and probably it will remain till next year, all the EV two-wheelers in the market are basically scooters. There are virtually no motorcycles, EVs available. And 2/3 of the market is motorcycle. And I don't see any dramatic change coming in the next 1 year. So probably we have to wait and watch and we have to look at it. But definitely a step in the right direction. Most companies which manufacture CNG vehicles also have EVs in their portfolio. So they have the opportunity to ramp it up and reduce CNG. But how will it happen? That's a $1 million question. And we don't want the scrappage policy to the way it has happened. The way it is announced and the way it's implemented, it's a very watered down thing. You need to go have clear steps, but go slowly and steadily rather than going hogwash and then not implement it.
Okay, I think we are getting visuals as well of the RBI governor. That's, of course, the big event for us here locally in India. Just minutes away, 10 o'clock is the policy announcement, and we're widely expecting a 25 bips point rate cut. At least some are saying it could perhaps even be as much as 50 basis points. If I could just come back to Mr. Mamilapalli, what would your prescription be? This is still a draft sort of policy, so we need to see if it is, if it is changed and maybe those timelines are relaxed a little bit. What would a realistic assessment be in terms of when to roll this out if you support full EV fleet for two-wheelers and three-wheelers?
See, as I said before, ecosystem is the key. And you are not looking at just the two-wheeler, three-wheeler, but you have to look at the whole auto industry as such. With BS 6.2 emission norms, which was just implemented, and the whole industry have just embraced the new emission norms. And further, we are talking about CNG adaptation, which is, again, well-versed within the NCR region. We should give enough time, at least about 4 to 5 years, at least, for the migration. Anyway, for the passenger car, where we are predominantly in existence, it's very minuscule contribution to the carbon monoxide emissions. So we have to be diligent in what we are doing it. We have other factors which are influencing the air quality index, and that needs to be attended much, much faster than the policies which we are currently putting as draft today.
All right. Okay, gentlemen. Thank you very much for weighing in on this. This is right now a draft proposal. Let's see what the final guidelines look like, and then perhaps we'll have you back to weigh in on them. That's the Delhi EV policy, something that's still within the realm of discussion. Markets actually recovered. This is not too bad. Market is now down just about 80 points from a 150-point dip. There's a lot of buying in FMCG. Look at Lever, look at Nestle. There's buying in ITC. So FMCG is indeed proving to be a bit of a safe haven. Mitesh is back with us. Mitesh, your sense on the overall trade, and definitely a specific word on IT, which is getting hit very hard, and whether you see any trades in FMCG on the upside.
Good morning again. So I think FMCG is something which I like a lot. In fact, last few days, the buying calls have been like, Colgate and HUL, and even right now I have a buy on HUL. You are highlighting ITC, that's also looking very strong on the chart. So that's a defensive pack, I think, which could do well in a market which is slightly choppy and volatile. So FMCG is definitely yes. IT is getting oversold, but I still haven't got any sign of reversal as yet. So, what I would want to do is see if there's some kind of a reversal on the hourly, 2 hourly charts, and then fish for some long side trades with the tight stop loss. But that still is a couple of days away, it seems. On my recommendations, I have, as I mentioned, a buy on HUL. That's a buy with a stop just below levels of 2294 and look for a target of 2360 here. And Hindustan Zinc, I think that's a stock which is a negative call, a sell call. With a stop at about levels of 408 for targets of 385.
All right, that's essentially trades coming through. 80 points lower, 22,451 is where we are at. But our policy coverage begins. And what a really complex, environment for the RBI to have met. And the point is, the meeting started on Monday. We are on Wednesday. And what they would have discussed on Monday, at least from a global angle, that has changed so much. I mean, just look at the US 10-year, which is the risk-free rate. That's moved up since Monday, when they would have sort of started discussions by almost about 30, 35 basis points. So just amazing. But we have a whole host of experts talking to us, to talk to us about what the action could be like, and of course, post-action implications. So that's coming right up. My colleague Ritu will come in, take you through that conversation. And of course, our Lata is at the RBI HQ. Stay tuned.
that this year that the stock has had. This may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet the street remains bullish, and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1350 to as high as 1950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now, in fact, since 2010, the stock has delivered negative annual returns only thrice, and two of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2080 rupees to as high as 3750, but the stock is veering more towards the former right now. On the flip side, Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year, the stock has doubled this year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains constructive, targets of anywhere between 2700 to 3700 on the stock. Now, HDFC Bank, positive returns every year since 2013, but 3 of those last 4 years are returns in single digits. Yet, no analyst on the street has a sell rating on HDFC Bank with price targets ranging up to as high as 2550. Now, FMCG is a sector that is disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street, though, is optimistic, analysts giving targets of up to 3400 rupees on the stock. Staying with consumption, Titan is set for its first negative
Hello and welcome to our special coverage of the Reserve Bank of India's monetary policy, coming to you straight from Mint Street from the RBI headquarters. As policies go, this is a crucial one. It's a time when it's difficult to make any assessment of growth or inflation or even interest rates. You know, on Monday, as Prashant was saying, when the Monetary Policy Committee began its meeting, the US 10-year yield was at 3.95. Today it is at 4.49. I mean, it's a 55 basis point rise in just about 3 days. Yields are all over the place, currencies are all over the place, and growth rate expectations are all over the place. My colleague Ritu Singh joins me from the studios, and we have a whole host of experts. Ritu, good morning. A quick summary of market expectations, please.
Good morning, Lata. Well, we're going into this policy with a unanimous expectation of a rate cut. The majority view, of course, is a 25 basis point rate cut from the MPC. But the question really is what else? Could be a larger rate cut, but that is a very small chance of that happening. Whether the MPC decides to change its stance to accommodative, that is something the street will be watching out for. Our poll also says that there is a high chance of that happening, although a good 40% do believe the RBI will still stick with a neutral stance given the uncertainty in the markets. Now, as far as the terminal repo rate is concerned, these expectations have been moving from policy to policy, and now the expectation of the total rate cuts in this entire cycle is 100 basis points. So another 75 basis points coming, taking the terminal rate to about 5.5%. Apart from that, no additional liquidity easing measures really, because RBI has been taking steps outside, whether that is OMO, VRRs, forex swaps and so on. And it is expected to continue to do that. But any more positive commentary, that will be keenly seen. On the GDP front, some sort of headwinds are expected because of the US tariffs and, other factors. But largely, the street expects for now, the RBI may choose to leave the forecast unchanged at 6.7% for the fiscal. A small section is expecting a slight downward revision. On the CPI front, 4.2% again, likely to be left unchanged, although there is a possibility that RBI lowers it to about 4 to 4.1%. That will also be seen as sort of a dovish tilt. The tone, of course, is likely to be dovish and sort of indicate, the roadmap for future rate cuts. So that's what we're going into the policy with, but never second guess the RBI. We'll see what else comes out.
Absolutely. We have a host of experts to give their views. We have Parul with us, who heads the Treasury Chartered Bank, Kaushik Datt, the Chief Economist from Deutsche Bank. And then we are going to be joined by Indranil Pad of Yes Bank, Lakshmi Iyer of Kotak, Devang Shah of Axis Mutual Fund. But Parul, let me come to you. I think the 10-year is at 6.48 now. What's priced in? And do you think it's just going to be a cut of 25 bips, or it will be cut plus something?
Hi, Lata. Yes, market is going very positive with very high expectations. What's priced in is fully a 25 basis points of rate cut, along with high expectations of a change in stance of accommodative and some dovish tone from the government. That's already priced in, so even after a large move higher in rates overnight in the US market, you see that the market, in fact, India is very much primarily because of positive expectations from upcoming uncertainties.
Yeah, Parul, I don't think we have a very clear line over there. We'll come back to you. Kaushik, I'll just come back to you. I think we'll correct that audio issue. Kaushik, what are the chances that you will get a lower growth rate? It's really impossible to stand with the 6.7% at this juncture. What's the growth rate you are expecting? And will that be seen as dovish?
Lata, good morning. So we have a lower growth forecast of 6.5% for FY26. RBI is at 6.7. Now, one argument could be that RBI could wait for the January-March GDP data to come out on 30th May. Which may again come out with a lot of revisions, and then RBI can take an informed decision to change the forecast in the June policy. So that is one way to think of it. The second is if RBI feels that 6.7 forecast is already a little high, and the tariff developments that have taken place should be, done mark to market, then they could think of bringing it down closer to 6.5%. And that will give a more realistic kind of a picture. And the risk is that the growth of 6.5% could be even lower. If the global growth slows down and we are into a recession by the end of the year, India's growth could fall closer to 6% as well. So whether the RBI does mark to market in this policy itself or they wait for a little bit more time, but the bias to growth is on the downside. And also the bias to inflation for FY26 also is to the downside compared to the 4.2% that RBI has taken at this point of time. The March CPI number is supposed to be around 3.5. And you could easily have FY26 inflation coming closer to 4%, but RBI could keep some buffer and not change that right now, given the heat waves that we are seeing. So 1 or 2 months of bad inflation data can pull it up again. So maybe they could go with unchanged 6.7, 4.2, but the bias is downside for both inflation and growth. And that is why I think this is an opportune time for RBI to change the stance to accommodative, because if they're cutting rates 50 basis points by April, it's no point holding on to the stance of neutral if you know that you're not going to hike rates anytime soon. So it can either be a pause or a rate cut. You don't need to wait till the end of the cycle to change the stance to accommodative. So this is a good time to change the stance to accommodative and give hint to the market that the cycle could be a bit deeper. And RBI is not thinking of any rate hikes or anything. And at this point of time, the focus would be more on supporting growth, given that inflation is already pretty well behaved.
Yeah. Kaushik, I have to interrupt you because we don't have that much time and we have a lot of guests. Imran Irfan, what can make banks cut rates? If the governor were overtly dovish, like he brings down inflation rates or inflation forecast, or if he says we will keep liquidity surplus, I mean, hypothetically, at say 2 lakh crore, let's suppose he gives some assurance, will that bring down deposit rates? What will lead to a deposit cut?
Well, I think banks have already started to cut deposit rates. Immediately after the previous policy, when we had a 25 basis cut, the banks did not react because of the tightness in the liquidity. Now, obviously, we know and see that the RBI is more open to providing liquidity into the system, and there is at least a minimum of 50 basis points. And as your other guests also point out, there could be a deeper rate cut story given the forecast for inflation in the next financial year at about 3.8 to 4%. So given that, I think banks have already started to cut deposit rates, and first quarter we are expecting liquidity to remain adequate, which should to a certain extent bring down the cost of funds. Having said, we will also have to watch out in terms of what is happening to the bond yields. And the bond yields today, even though we have a 25 basis points cut, estimate the bond yields actually have risen. And you have already mentioned the way the volatility in the US treasuries are being experienced. So it will be a sort of a watch episode in terms of how fast the banks could actually react in terms of the rate cutting story of the Reserve Bank of India.
All right. Lakshmi, what are your base case expectations going into the policy? Apart from the rate cut, what are the specific cues in the governor's tone and his speech that you're going to watch out for to indicate the sort of dovishness we should expect going forward?
Yeah, sure. So I think firstly, tariff shock is equal to rate cut therapy. I think that formula is something which central bankers, including RBI, will imbibe today. The second thing is the continuity in terms of rate cuts. So maybe if we started the year, our expectation was no more than 2 rate cuts in the entire year. Now that view is clearly changing given the macro situation, which is pretty, fluid globally. And I'd say that the crux is going to be to see obviously the stance change. Is there a catalyst to do that today? Probably yes. Is it going to be a slam dunk? Maybe not. So I think that is something which we will clearly watch out for in the text. And secondly, as I mentioned, is there going to be continuity in the rate cut cycle, which probably is definitely warranted given the situation. And of course, as I said, we're not really rooting for significant cuts on the GDP growth front, but that could be well the cue in terms of a watchword. But I think dovishness all along should be what markets have baked in. And that's something which will be a text that we all will look forward to.
Okay. Well, Parul, if we can get you, if you're lucky this time, just tell us what we should watch out for. Train our eyes.
So we should just watch out for, one, whether the stance change is happening or not. And second, the tone of the policy. Is the governor giving any indications of inflation being well under control and giving space to the MPC to keep supporting growth through monetary policy channels going forward? So that's the main thing to look out for. A lot of dovishness is priced in. Market is priced in 75 basis points of rate cuts over the next few months. So a dovish tone from the RBI governor will be very important to watch out for.
And Devang, thanks for waiting by. Quickly, what have we not covered? Any other surprises you think that could be in store?
So I think largely all the panelists have covered everything. From our perspective, I think markets have gone significantly dovish into this policy, and markets are expecting a lot from RBI. So our view is that probably there might be a bit of disappointment because RBI might want to keep some of the gunpowder in this uncertain environment where you can have currency or tariff wars coming up.
All right. Thanks, Devang. We have the Reserve Bank of India Governor Sanjay Malhotra. Let's cut in.
The year has begun on an anxious note for the global economy. Some of the concerns of the trade frictions are coming true, unsettling the global community. We at the Reserve Bank, while remaining alert to these global developments, began the year celebrating the completion of 90 years of this august institution since its inception way back on 1st April 1935. The Reserve Bank's journey over the last 9 decades is closely intertwined with the nation's development and progress. As a custodian of monetary and financial stability, the Reserve Bank has evolved itself over the years into a full-service central bank with varied functions facilitating a market economy. Indeed, a very, very long journey full of accomplishments and achievements, something which every RBI is proud of, and something I believe the whole of India and its citizens are also proud of. In this challenging global environment, the Monetary Policy Committee met on the 7th, 8th, and 9th of April today to deliberate and decide on the policy repo rate. The global economic outlook is fast changing. The recent trade tariff-related measures have exacerbated uncertainties, clouding the economic outlook across regions, posing new headwinds for global growth and inflation. Amidst this turbulence, the US dollar has weakened appreciably, bond yields have softened significantly, equity markets are correcting, and crude oil prices have fallen to their lowest in over 3 years. In fact, as we speak, it is about $60 to a barrel. Under these circumstances, central banks are navigating cautiously with signs of policy divergence across jurisdictions, each reflecting their own domestic priorities. The Indian economy has made steady progress towards the goals of price stability and sustained growth. On the inflation front, while the sharper than expected decline in food inflation has given us comfort and confidence, we remain vigilant to the possible risks from global uncertainties and weather disruptions. Growth is improving after a weak performance in the first half of the last financial year, 24-25, although it still remains lower than what we aspire for. And now I come to the decisions of the Monetary Policy Committee. After a detailed assessment of the evolving macroeconomic and financial conditions and outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. Consequently, the standing deposit facility, the SDF rate, under the liquidity adjustment facility shall stand adjusted to 5.75%, and the marginal standing facility rate, or the MSF rate, and the bank rate shall stand adjusted to 6.25%. I shall now briefly set out the rationale for the decisions of the Monetary Policy Committee. The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon. On the other hand, impeded by a challenging global environment, growth is still on a recovery path after an underwhelming performance in the first half of 24-25, which is the last fiscal. In such challenging global economic conditions, the benign inflation outlook and the moderate growth demand that the MPC continues to support growth. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 6%. Moreover, it also decided to change the stance from neutral to accommodative. It also noted that the rapidly evolving situation requires continuous monitoring and assessment of the economic outlook. Let me now dwell a little on the monetary policy stance. This has been a subject of interest for some commentators and market participants. There have been questions as to whether it means a change on the policy rate or whether it signifies our stance on the interest rate or whether it relates to liquidity conditions. From a cross-country perspective, monetary policy stance is typically characterized as accommodative, neutral, or tightening. While an accommodative stance entails easy monetary policy that is geared towards stimulating the economy through softer interest rates, tightening refers to contractionary monetary policy, whereby interest rates are hiked to restrain spending and curb economic activity, all with the objective of reining in inflation. A neutral stance is typically associated with a state of economy which neither calls for stimulating economic activity nor calls for controlling inflation by curtailing demand. Therefore, it provides the flexibility to the central bank and the MPC to move in either direction on the basis of the evolving economic conditions. In our context, the stance of monetary policy signals the intended direction of the policy rates going forward. Accordingly, with respect to the policy rate, which is the mandate of the MPC, today's change in stance from neutral to accommodative means that going forward, absent any shocks, the MPC is considering only two options, that is status quo or a rate cut. Let me also clarify that the stance should not be directly associated with liquidity conditions. While liquidity management is important for monetary policy, including decisions related to policy rate, it is an operating tool with the RBI for various purposes, including monetary policy transmission. Monetary policy decisions to change policy rates do, however, have implications for liquidity management, being the operational tool to carry out the policy changes. To summarize, our stance provides policy rate guidance without any direct guidance on liquidity management. I will, of course, be discussing later our approach to management of liquidity. Before now I share our outlook and assessment of the growth and inflation, I think a few words on the implication of the recent global trade and related policy uncertainties are in order. Let me first highlight the possible implications for growth. First and foremost, uncertainty in itself dampens growth by affecting investment and spending decisions both of businesses and households. Second, the dent on global growth due to trade frictions will also impede domestic growth. Third, higher tariffs shall have a negative impact on net exports. There are, however, I may say, several known unknowns. The impact of relative tariffs vis-a-vis some of the other countries are quite low. Then there is the unknown of the elasticities of our export and import demand and the policy measures adopted by us. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. These are just to name a few. These make the quantification of the adverse impact on growth difficult. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Coming now to our growth outlook. Real GDP, as you are all aware, this year, as per the MOSPI figures, is expected to grow at 6.5%. This is on top of a 9.2% growth rate observed in the previous year, which is 24-25. In 25-26, the current year, prospects of agriculture sector remain bright on the back of healthy reservoir levels and robust crop production. Manufacturing activity is showing signs of revival, with business expectations remaining robust, while services sector activity continues to be resilient. On the demand side, bright prospects of the agriculture sector bode well for rural demand, which continues to be healthy, while urban consumption is gradually picking up with an uptick in discretionary spending. Investment activity has gained traction and is expected to improve further on the back of sustained higher capacity utilization, government's continued thrust on infrastructure spending, healthy balance sheets of banks as well as the corporates, along with the easing of financial conditions. Merchandise exports will be weighed down by global uncertainties, as mentioned earlier, while services exports are expected to remain resilient. Headwinds from global trade disruptions continue to pose downward risks. Taking all these factors into consideration, real GDP is now projected for this fiscal 25-26 at 6.5%, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. While the risks are evenly balanced around these baseline projections, uncertainties remain high in the wake of recent spike in global volatility. You would have noted that the growth projection for the current year has been marked down by 20 basis points relative to our earlier assessment of 6.7% in the February policy. This downward revision essentially reflects the impact of global trade and policy uncertainties, which I had highlighted a little while ago. Coming to inflation, the headline inflation moderated during January-February 2025, following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding Rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of key pulses over that last year. Along with robust Kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations going forward. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are evenly balanced. I now will be speaking on the external sector. India's services exports remained resilient in January-February of this year, driven by software, business, and transportation services. Going forward, net services and remittances receipts are expected to remain in large surplus, partly offsetting the trade deficit. The current account deficit for last year as well as this year, 25-26, are expected to remain well within the sustainable level. On the financing side, gross foreign direct investment, FDI, remained strong during the period of April 24 to January 25. Last year, which is the latest data, period for which we have the latest data, reflecting India's strong macroeconomic fundamentals. Net FDI, however, moderated sharply during this period due to higher repatriations and outward FDI. Net FPI inflows to India stood at $1.7 billion during 24-25, supported by debt inflows as the equity segment recorded net outflows. This is much lower than what we had last year. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to that last year. As on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion, providing an import cover of about 11 months. Overall, India's external sector remains resilient as the key indicators stay robust. I will now be talking about the liquidity and the financial market conditions. System liquidity was in deficit in January 2025, with net injection under the liquidity adjustment facility scaling a peak of more than 3 lakh crore rupees, in fact 3.1 lakh crore rupees on 23rd January 2025. However, as a result of a slew of measures, and I'll not go into the details thereof, you are all aware of them, of the various OMOs, the CRR rate cut, the swaps that we have done. The system liquidity deficit tapered, therefore, during last 2 months of February and March, and further it turned into a surplus on 29th March 2025. Further, coupled with the government spending picking up pace during the latter half of last month, March, the system liquidity further improved and it stood at a surplus of 1.5 lakh crore as on 7th April 2025, and even yesterday it was 1.4 lakh crore rupees of surplus. Reflecting these developments, the weighted average call rate softened and remained near the repo rate since the last policy meeting, the spreads of 3-month CP and 3-month CD rates over the 91-day Treasury bill rate have also softened since the second half of March, suggesting an improvement in liquidity conditions. I would like to mention over here again, I'm reiterating this, I've said this earlier, which is that the Reserve Bank is committed to provide sufficient system liquidity. We will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures to ensure that there is adequate liquidity in the system. Coming to financial stability, well, I do not have much to add from my previous policy statement in February. Things are more or less looking similar. The financial soundness parameters of the banking sector continue to be robust. The liquidity buffer in the banking system is well above the regulatory threshold. Profitability indicators are also healthy, reflecting robust operational efficiency of the system. Similarly, the system-level parameters of NBFCs too are very sound. Now, as has been the practice, I shall be announcing some additional measures. This time I have 6 additional measures to announce to all of you, and these relate to banking regulation, fintech, and payment systems. First, we propose to enable securitization of stressed assets through market-based mechanism. There is already a mechanism of securitization of standard assets. The same is now proposed to extend with modification to stressed assets, and I may add that this is in addition and this is not in lieu of the existing ARC route under the SARFAESI Act of 2002. Second, we have guidelines on co-lending. They are presently applicable only to arrangements between banks and NBFCs. Moreover, they are restricted to priority sector loans. To exploit the huge potential of such lending arrangements, it is proposed now to extend these to all regulated entities and to all loans, priority sector or even outside the priority sector. Third, loans against the collateral of gold jewelry and ornaments, commonly known as gold loans, are extended by regulated entities, both banks and NBFCs, for both consumption and income generation purposes, in order to harmonize guidelines across various types of regulated entities to the extent possible, keeping in view their differential risk-bearing capabilities. We shall issue comprehensive regulations on prudential norms as well as conduct-related aspects for such loans. Fourth, to harmonize the regulations governing non-fund-based facilities across regulated entities, we propose to issue comprehensive guidelines. Instructions related to partial credit enhancement by regulated entities are also proposed to be revised. This is also, if you would recall, a budget announcement relating to NABFID by the Honorable Finance Minister in her budget speech for this year. This is expected to broaden funding sources for infrastructure financing. The draft of these 4 guidelines and regulations are being published today itself for public consultation, and we shall finalize these guidelines based on the feedback received. The other 2 announcements relate to, first of all, PCI to decide in consultation with the banks and other stakeholders the transaction limits in UPI for person-to-merchant transactions. This limit, as you are aware today, is 2 lakh rupees. We will give the freedom to NPCI in consultation with other stakeholders to revise it as per the needs of the economy. I may also clarify over here that the P2P transaction limit, which is 1 lakh rupees as of now, will remain the same, and there is no change with regard to the regulations in regard to P2P or person-to-person payment transaction limits. The other and the last measure that I have to announce today is regarding the regulatory sandbox. We are making it theme neutral and on tap. At present, there are actually 4 themes on which people and businesses can work on this sandbox. Now we are making it theme neutral and on tap. Necessary directions for the implementation of these 2 measures shall be issued separately. To conclude, the global economy is going through a period of exceptional uncertainties. The difficulty to extract signal from a noisy and uncertain environment poses challenges for policy making. Nevertheless, monetary policy can play a vital anchoring role in ensuring that the economy remains on an even keel. In our context, as I mentioned earlier, the growth inflation trajectory demands monetary policy to be growth supportive while being watchful on the inflation front. We are aiming for a non-inflationary growth that is built on the foundations of an improved demand and supply response and sustained macroeconomic balance. As before, we shall remain agile and decisive in our response and put in place policies that are clear, consistent, credible, and in the best interest of the economy. Thank you, Namaskar, and Jai Hind.
Okay, so actually the governor has delivered as the market expected. There is both a rate cut and a change in stance to accommodative. The growth trimming is marginal, not a great deal, but I think the market will take the inflation reduction very, very positively, because that was kind of a clear signal that there is more space to cut rates. Now 550 as the end rate of the repo rate looks like a given. If anything, it could be more, but growth has not been trimmed so much. Let me straight away get to our experts. Well, just as an added point, not much change in the regulatory issues. Maybe gold loans, we are going to see some new rules. But and co-lending, of course, has been liberalized or going to be liberalized a lot more. But nothing earth-shattering coming over there. Let me get to our experts very quickly. Upasana, what's the sense you're getting? Are you now going to change, from 4 rate cuts to something more? What are the first takeaways?
Lata, the kind of uncertainty that is brewing up globally, clearly the governor has highlighted that as well. Of course, the growth revisions are not reflecting that just yet. But having said that, the kind of emphasis that he has put on the global uncertainties, there is clearly much more room for rate cuts than what earlier we were pricing in. In fact, yesterday itself, we had revised down our terminal repo rate to 5 to 5.25. And just to highlight a couple of things, with the governor having talked about the stance change and providing clarity that, they want to have a clear guidance, they want to be growth supportive, and the stance change is suggestive of more support going ahead. I think these are 2-3 points which are very clear that they will be fairly proactive when it comes to addressing the growth challenges, which will definitely be showing up in the months ahead. So this is something which is very important. On the inflation front, clearly, life is much more simpler, comfortable, because, monsoons are expected to be normal. Overall, we are looking at inflation more or less anchoring around 4% handle with a possibility of a slight downside. But of course, we'll have to see the pace of rupee depreciation and the impact of that. But overall, I don't think there's much to worry on the inflation front. So I would say that the governor has delivered in line with expectations with a promise to act on a much more proactive basis going ahead as and when the need be.
Okay. Actually, you're right that for the better part of this year, he expects inflation to remain below 4%, below their mandate. So I think the guess that the real rate, the neutral rate, can go below 5.5 really opens up because it's less than 4%. Rajiv Anand, key takeaways?
I think in a world which is so focused on what's happening to tariffs, I think a central government that is focused on growth by cutting rates, by cutting its stance, I think, is certainly positive. And I think the governor has also picked up the fact that in this tariff environment, oil prices will be down, US interest rates will be down, and I think that is positive for us from an inflation perspective. So all in all, I think it's growth positive. Yes, assets for banks will reprice sooner than later, but I think you will see a fairly sharp move on deposit rates as well. We've already seen non-retail deposits or CDs reprice from about 8% pre 31st March to about 7% today. And I think now you're going to see retail deposit rates also coming down quite quickly and quite sharply.
Okay, that really was going to be my question to Vinay Tonse. I mean, you will set the tone. Mr. Vinay Tonse, Managing Director, State Bank of India, is also with us. Mr. Tonse, you actually set the tone for the market. As Rajiv says, CD rates have already gone down. Now, do you think deposit rates are on their way down, and how much can you cut them? I mean, your loan rates are going to be 50 basis lower than what they were in January. That's a fairly big impact on your margin. Can deposit rates come down, and how much?
Hi, good morning, Lata and the others. Definitely see, looking at how much of transmission has happened on the way up, if you had noticed, with the 250 points up, the transmission was almost similar, right? But now on the downward trend, as of now, we have not seen much inflationary, downward trend on the transmission. But now with the benign inflation, as well as if you look at the liquidity that has come in, right? Liquidity measures that have come in through this, the VRR, the OMO, as well as the foreign dollar swaps. I think now is the time when the transmission will start. And if I can borrow from our ERD report, we will be seeing a similar transmission as what happens in the rate cuts. So this is how it's going to pan out for the banking, which is good.
So, no. When are you, say for instance, in April itself or in May, where do you expect the deposit rates? Are you expecting them to fall by 25 basis, Mr. Tonse?
When are we cut, you ask? Okay, now I think it's not right for me to comment. I will leave it to the ALCO discussions and decision that's going to happen in the next couple of days.
No, I'm not saying your rate. I'm not asking for SBI's rate. I'm just asking generally for the banking system. Rajiv Anand is clearly giving a CD rate.
Yeah, definitely it will.
You mean 25 basis, or it can fall even 0.5% deposit cost?
No, I think 25 now.
Okay. All right. Kaushik,
let us watch out for.
You'll see 25 first? Okay. Kaushik Upasana says that her now repo rate expectation is it will go all the way down to 5/4 of 5, which means 5 rate cuts minimum priced in. Yours?
Expect repo rate to go down so much. We are not in a crisis scenario. Yes, growth is slowing down. Yes, there is a burden of global growth which could slow down. So yes, we can go down to 5.5, but that could be also through a mix of repo rate cut and liquidity. Remember, today the spread between the US 10-year and India 10-year has fallen to 200 basis points only. So you have to keep in mind that interest differential as well. And you cannot keep on cutting rates if the Fed is not cutting rates. So beyond a point, RBI will also have concerns on financial stability. So I think there is a natural hurdle for repo rate to come down if the Fed is not doing much because of inflationary concerns in their own country because of tariff. The other thing is, if you look at CNH or the Chinese currency, it could happen that over the next few weeks and months, you could see CNH depreciating and going towards 750 or higher than that. So it is very clear to us that India is not out of the woods yet as far as currency risk is concerned, given the Chinese policymakers could use FX as a kind of retaliatory tool against the tariffs that have been put in. So you have to balance growth risks along with financial stability risks. RBI has front-loaded rate cuts, February and April, which is a good thing. They have changed the stance to accommodative, which gives them the flexibility to cut rates. And that, as I told you in the pre-policy call, that they're not going to hike. Therefore, the only options are pause or cut. But a accommodative stance doesn't mean that RBI has to come in each policy and deliver a 25 basis points rate cut, because that is how market prices it. There are many other elements which RBI will have to weigh in and then decide. For example, in June policy, RBI may give it a pause, having done back-to-back rate cuts in February and April. So keep that in mind. I think rates can go down to 5.5, but nothing more than that, given unless the Fed is cutting in a big way, which we are not seeing as of now. Let's see what happens with the tariff developments.
Sure. A quick question to the bankers before we move back on to Shobit and the others. Mr. Tonse, the Reserve Bank of India is saying it is going to review the guidelines on gold loans. Now, we've seen some concerns in the past. We've seen action against one of the gold loan companies as well. What are your broader expectations? Where do you think the concerns could be? What sort of changes are you expecting on the regulatory front when it comes to gold loans?
Hi, can you hear me? There was
yes, Mr. Tonse, go ahead.
Yeah, I'll actually wait for the evening. The governor also said that the guidelines would be issued today itself.
Yeah.
Right, but where were the concerns exactly? I think it was about, particularly in some sections of the industry where there was a bit of some breaches were happening, and that was concern for the central banker as well as for the industry. But I would wait for the evening to see actually how the guidelines would pan out. But there is an assurance that it will be a very comprehensive guideline that would be coming. And I think that brings in a lot of harmony.
Sure, but Rajiv, what is your sense? Do you expect some sort of tightening there? What should we expect? The guidelines will, of course, come out later. What's your reading, though?
I think, Ritu, like you rightly said, the RBI has been focused on gold loans from an operational perspective. Remember that gold loans is a very branch-centric business, and so therefore operational risk to that extent is something that the banks need to manage. And I think, like rightly said, the RBI has seen idiosyncratic issues with one or two entities. And so therefore, they've already done a fairly comprehensive audit of gold loans across the banking system. And I think based on the understanding of that audit, we are going to see guidelines. I think it's better to, sort of wait and watch to see what finally comes through.
Okay, sure. Rajiv, the other thing is the co-lending arrangements. So far, the guidelines only spoke about these arrangements on priority sector loans and between banks and NBFCs. Now the RBI is proposing to widen that to all regulated entities and all sorts of loans. What are your expectations here?
I think it's a very positive step. Having said that, it did take the banking system quite some time to get the co-lending structures in place, the technology in place, and getting the right partners to be able to co-lend. But I think the fact that now this is available to assets beyond priority sector, I think is certainly positive. And I think it also gives the opportunity, particularly for NBFCs, to be able to think of this from a liquidity perspective, in addition to what they're already doing. So I think all in all, I think it's a positive measure. Don't expect miracles overnight, but I think over a period of time, we will see this partnership grow.
But Rajiv, do you expect some tightening here, especially when it comes to partnerships with fintechs that we've been seeing with certain banks and NBFCs? Do you expect that to come under the regulatory scanner? Do you expect it to be only extended to regulated entities, so banks and NBFCs only?
I think from what I heard, the governor, I think he mentioned that this will apply to all regulated entities, and so therefore to that extent. The canvas certainly becomes wider, but I think each individual bank will take their call on which entity that they want to work with, because ultimately it is an 80-20, and therefore there is some risk that you're running even in the co-lending space, and so therefore each bank will pick and choose its partners.
Thanks for that. Mr. Tonse, just a one-sentence answer. Are you expecting gold loan rules to get tighter? I think that's what Ritu is driving at.
Tighter but more harmonious.
More harmony. Okay. Well, we don't have a long time to wait. We should get it by end of day. But co-lending will be more helpful, isn't it? As Rajiv says, now you banks have cracked it. So it would mean more lending to the, lower ticket kind of loans because co-lending has been liberalized so much?
Yes, Lata. See, what the benefit I actually see is now this different entities can play to their strengths, right? Because some entities would be finding it easier to raise funds at a cheaper cost, whereas some other entities perhaps have their strengths lying in reaching out to the last mile or, for the strong recovery mechanism that they can have. And this is where the synergies can come in, right? The balance sheets get freed. We have access to lower cost funding as a set together, right? As a partnership. I think this is the best part that comes out, that it is getting extended beyond the priority sector ambit, as well as to all the other regulated entities.
Yeah, point taken. I think dissemination of funds or loans or credit should be better and wider, or so it seems. We will get to know more. Shobit, thank you very much for your patience. What does all this mean to the bond markets? We've seen, I think, on the 10-year, on the new 10-year, just a 1 basis point yield fall. Obviously, there is this big 4.49% US 10-year yield that is an overhang. But broadly, what's the takeaway for a bond guy?
Good morning, Lata. I think the takeaway for bond market is hugely positive. But for the US market reaction, wherein yields have gone so much higher, our bond yields would have declined far more. So we are held back in a way because of the volatility in the global market, especially on the bond global 10-year US yields. I think once that settles down, our market will react positively. I think all praise to the new governor. RBI has, clearly shown a shift in strategy, both on handling FX as well as on providing liquidity. I think the proactive measures, the quantum of liquidity which RBI has provided, the transmission this time around would be far better. We would expect yields to go down. I think once the global markets settle down, we'll see bond yields clearly on the downward path.
Oh, okay. Yeah, of course. Once the US gives you a little more space. Let me come back to Kaushik. I'm once again taken by what Upasana is saying, Kaushik. For at the moment, the real rate is 200 basis points because you are looking at an inflation for the next, 8 months below the 4% mark. So it's a 200 basis point real rate. Do you not think that there is probably, the governor is telling us that there is scope for more rate cuts than just up to 5.5%, or perhaps even a double rate cut at some point, maybe the next one?
I think that is the interpretation that we should be taking. I mean, people can take different interpretation out of this accommodative stance. Way back in February when I did the call with you, I told you that April would be a good time to change the stance. They've changed it, but I also qualified it by saying that that doesn't mean that every policy you have to cut rates or, it has to be a very deep cycle. All RBI is saying is that we will not hike rates from here on, or we are not considering. It can either be a pause or it can be a cut in rates. Now, the question that you are asking, the 8 months real rates would be 200 basis points. Remember that we are going through so much of uncertainty. And what if, inflation in US keeps on staying high? You cannot take such a short-term view. You have to take a little longer-term view and think about financial stability. And also the bigger point, RBI has done back-to-back 2 rate cuts. Now the focus should be on to see how the transmission is happening to the real economy. The focus should be on liquidity, to see the rates actually falling before delivering another rate cut. The central bank cannot keep on giving rate cuts if the transmission is not happening to the extent that they want it to be. So now you have to give it some time for the bankers to reduce the rates, the questions that you're asking on deposits and other things, whether it actually comes down. We know that in May, RBI will give a big dividend. In April, they have already announced OMOs, the durable liquidity is positive. If that leads to short-term rates coming to the SDF window kind of a thing, you already have an effective easing more than the repo rate that is at 6% currently after the rate cut. So I think the time would be, this time RBI should pause a bit, think what they have done, and then what the impact is happening on the real economy. Then look at the GDP number, look at what's happening globally, and then they can do a rate cut in August. And if needed, they can do more. But remember, we are not in a scenario yet when RBI is saying growth forecast is 6.5%. It is still pretty high, and 6.5% and 4% inflation. You cannot just consider for the next 6 months. You have to consider for the next 12 months. And the deeper RBI cuts, remember, there'll be pressure on RBI to reverse it also sooner. And that is not a very good strategy for the economy to be, cutting rates deep, and then within 6 months, if there is a pressure on RBI to reverse it, if something is going wrong on inflation, 6 to 9 months down the line. So I would say cut cautiously, hold it for a longer time so that you give stability to the economy, and the transmission can happen in the meantime for the real rates to kind of get support.
Okay. Very quickly, Upasana, is 6.5 too ambitious as a GDP growth rate? Do you think by the time we come to May, we may get a lower number?
Lata, we remain fairly bearish on the second and the third. Second and the third quarter looks very difficult right now, wherein I think there's going to be the entire impact of this tariff war on growth estimates, which will be felt much more visibly. And we are looking at a range of 5.8 to 6.2% GDP growth, depending on the scale of the problem that will be unfolding over the next few months. And that's why we are much more bearish on the second and the third quarter. Now, having said that, I just want to point out one more thing, that we have seen that in the last few months, rupee has been fairly volatile, and RBI has let it be. In the event of CNY devaluation or consistent depreciation, it is probably in our favor to let rupee depreciate and manage the competitive edge in an environment when the whole world is fighting for with respect to the tariff tensions. So I don't think there's too much to worry yet about, because current account deficit remains well in check. Crude oil prices are there, which will offset. There is scope for probably OMCs to cut the diesel and the petrol prices by 5 to 7 rupees a litre if needed. So there are different cushions that Indian economy still has. And hence, I still feel that having real rates closer to 100, 125 basis is not such a tall task in an environment wherein global growth, and hence Indian growth, is looking fairly fragile at this point.
No, what's your growth number?
We are at 5.8 to 6.2. You can say 6% as the midpoint. So we have revised it down from 6.5 to 6%.
All right. Okay. Mr. Tonse, considering that people are revising their growth lower, how will credit growth look like this year, FY26?
Lata, nominal growth rate, say around 10 is what has been the estimate, right? Suppose even if it goes down a little, looking at the normal multiplier, I would say that it would still be in the vicinity of 11.75 to 12. Credit growth.
Right. I just want to quickly highlight for our viewers, we've also got the monetary policy report that the RBI releases twice a year. And according to that, inflation is seen at averaging about 4.3% in FY27, and real GDP growth for FY27 is seen at 6.7%. This is still the MPR. Of course, we'll see how those numbers come out. And a quick word as well on co-lending guidelines. Now, on the gold loan front, Lata, while RBI's discomfort has been clear, on co-lending, I just wanted to highlight, the current rules, which are 2018 and 2020 circulars, only deal with co-lending between banks and NBFCs. Regulations are silent on NBFC to NBFC co-lending, which is very much prevalent in the market. So we'll have to see if the RBI comes out with tighter guidelines on this. Apart from this, there's an older, sort of CRISIL report that says, while co-lending guidelines, of course, deal with priority sectors so far, it says 34% of the 1 lakh crore AUM was in personal loans alone. So I think expect some tightening there, some more, guidelines around which banks and NBFCs can, enter into such partnerships. So that is one of the important things to watch out for. Quick word again, Rajiv, in light of this, for Axis Bank itself, give us a sense of, how large your co-lending book is, if it's with NBFCs, any fintechs, and apart from PSL, do you also have co-lending agreements in other areas or other segments?
So for us, Ritu, we have a whole bunch of partners on the co-lending side. We've been at it for the last couple of years or so. It's not a very big book, but and it is predominantly around PSL.
All right, and Mr. Tonse, for SBI, if you could give us some clarity on the kind of partnerships you have.
Ritu, yes, as I think something similar to what Rajiv was mentioning. We have been having partners for quite some time now, but because of certain integration issues and also our anxieties on underwriting, which would also be around going forward, we need to have the right sort of partner. Otherwise, if going back to the size of the portfolio, it is nothing really to write home about. And we will definitely be looking at what more we can do with the new guidelines that come in. It would definitely, as I was mentioning, repeating that, it would definitely give a lot of us strengths which we can play upon. I think that's the advantage that comes out of it. Going beyond the central lending.
Okay, Kaushik, quick word, just going through the governor's comments again, where he says the stance provides policy rate guidance without any direct guidance on liquidity management. What do you make of that remark?
So I think what he's trying to say is that just because the rate stance is accommodative, it should not mean that the liquidity stance, when you say accommodative, that it should fall on the lower end of the corridor. Basically, if you say accommodative, then your short-term rate should be between the SDF and the repo rate. So I think what he's trying to say is that liquidity will be sufficient, but don't expect short-term rates to fall on the SDF kind of window, and it'll probably stay closer to the repo rate. So the rate stance, the accommodative stance is more in terms of rates, which basically neutral meant that you could consider hiking, you could consider pause, and you can consider cutting. In case of accommodative, it can be only pause and cutting, but don't try to kind of expect that liquidity will be so much sufficient that the short-term rates will fall to the SDF rate. That is what he's probably hinting at. I have to look at it more closely. Our view is that liquidity will be quite sufficient in May after the dividend, and actually you could have a situation where short-term rates could fall temporarily between the SDF and the repo rate. Let's see whether RBI allows that or not. But the point that you also made about the NPR report and the question that Lata was asking, that how do you look at real interest rates, because the next 8 months is looking very good on inflation. Therefore, real rates would be more than 150 basis points if you don't cut below 550 or lower. My point is, when you're doing monetary policy today, you're going to look not just for the next 6 months, you're going to take the next 12 months into consideration. And that's where the FY27 forecast that you talked about, inflation at 4.3 and growth at 6.7.
6.7, yeah.
Yeah, unless they revise it down at those kind of growth estimates, you're not supposed to have repo rate coming down to 5%. That's my limited point. Now, if the growth forecast itself changes because of global economy going into recession, and in October, they'll present the NPR report again. Over there, if they mark it down, then you can talk about terminal repo rate going down to 5% or 5.25. But with this kind of forecast, I don't think it goes down below 550.
Okay, Upasana, in light of the monetary policy report's forecast on inflation for FY27, 4.3, GDP 6.7%, are your expectations of what the terminal repo rate could be also get changed?
No, I think Ritu, what we need to keep in mind is, like Kaushik said, I agree. With the current forecast, you may consider this as a tall task to get the repo rate terminal closer to 5.25. But as I said before, we are expecting 6% growth in FY26. And we will be probably closer to 6.25 only into next year as well. And that is the reason we believe that the terminal rate will be lower, closer to 5.25. We do believe that there's a significant downside to RBI's GDP forecast, both for FY26 and 27.
Okay, thanks for that, Upasana. Well, you know, it clearly looks like the market is convinced that the gold loan rules are getting stricter. I mean, there's a fairly steep fall in all the gold loan stocks. Can we just bring up Muthoot, Manappuram, and maybe even Catholic Syrian Bank, CSB Bank on the screen? There seem to be sharp cuts. What is your sense, Rajiv? The market is guessing right? Stricter rules?
No, I think one of the things, Lata, that is possible, which is what the market is perhaps worried about, is the LTVs. LTVs for NBFCs is higher than banks, and I think the governor spoke about aligning across all regulated entities, and so therefore perhaps the market is assuming that LTVs for NBFCs, which I think, if I'm not mistaken, is 75% today, is 90% today, will go to 75% like all banks, or all banks and NBFCs will be at 90%.
Okay.
So I think perhaps that alignment of LTVs is what the markets are worried about for NBFCs.
Okay. Mr. Tonse, you want to add to it? The stocks are falling, so I think the market is guessing like Rajiv is. Your thoughts?
You remember what I said a little earlier, that I would rather wait. I think the markets also should rather wait for the guidelines to come before, deciding either way the direction they take, right?
Okay. Your job is to lend loans after you look at the rules. The market has to take a position before the news. You always buy the rumor and sell the news. In this case, I think they are selling the rumor and probably will buy the news. We'll have to wait and see. But there is a bit of a worry, and I think there could be a justification, because gold prices have run up very high, run up very swiftly. So loans given at this juncture, in case the inevitable happens or the expected happens and gold prices peak off, then at 90% loan to value, a lot of gold companies could be finding their collateral shorter than the loans they sent. Maybe that's what they're thinking about, but all this is guesswork. Let me tell all our viewers that, like Mr. Tonse, we are also waiting for the rules, and we're just trying to read through from the stock prices whether the rules get tighter, and Rajiv's guess seems to be a very good one. I think we can wind up on the special monetary policy broadcast. Shobit Malhotra, any last words in terms of a bond dealer? Anything you want to ask the governor?
Well, I think governor has delivered as per market expectations, no doubt, in terms of providing liquidity, in terms of accommodative stance, rate cut. So I think all expectations of the market have been met. This time around, I think transmission would be far better. I think we just need to be patient with letting global markets settle down in terms of the high degree of volatility which we are seeing, and thereafter we will see fairly good decline in bond yields and overall market performing as per expectations.
Okay. Thank you very much, Shobit Malhotra, Vinay Tonse, Rajiv Anand, Upasana and Kaushik for parsing the monetary policy with us and helping us understand it better. As Ritu and all our guests have been saying, the governor has delivered exactly as the market wanted. A rate cut would not have been enough. A rate cut plus a stance change has certainly made the market happy. And we have to wait and see what the regulatory rules are. One of them looks like it furthers dissemination of credit, because you don't have to do co-lending only between banks and NBFCs. You can do it with NBFCs and NBFCs, or so it seems. That's what the new rules will say. And you don't have to only lend priority sector loans. You can lend all kinds of loans. So this is something the market will be very happy about, especially NBFCs. But I think one of the points that we have not mentioned in terms of the ultimate positive that comes from this statement is that it is very short. We normally have 17 points in the monetary policy statement. This one, I think, has only 7 points. So 100 marks for brevity for the governor. That's it on this. Okay, it's not 7 points, it is 9 points. But the last one is just announcing when is the next monetary policy. So 100 marks for brevity for the new governor. That's it on this special coverage of the monetary policy statement. But this is part 1. You will have part 2 of the coverage starting at 12 when the governor will address the media and take press questions. And we will have guests joining us to parse the statements that come out from the press conference. That's at 12 o'clock. From me and Ritu, thank you very much for joining. We'll see you at 12.
2016, and since 2016 the gains have ranged between 10% to as high as 150% on the stock. The street though expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is the worst year for Nestle since 2002, and the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now banks make an appearance here with IndusInd Bank, positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, and is the 5th time in the last 7 years that the stock has had negative returns. Yet 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so, and analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and it's 150 points lower on the Nifty at 11 o'clock. The Sensex is down close to about 400 points as we speak, in the red for the key benchmark indices, but there's so much news flow to navigate. The big overarching headline is that Trump's sweeping tariffs have come into effect. US is now taxing China at 104%, and China is not backing down. Their latest commentary seems to suggest that they will fight till the end. Asia is bearing the brunt of this selling pressure as the trade war seems to enter the next leg the next leg. Shanghai is only down close to about 0.3%. So despite being in the eye of the storm and in the epicenter, the Chinese markets have actually been relative outperformers, in a way sort of de-risked from the rest of the economy. Hang Seng is down 1.7%. Taiwan, Nikkei down 5 and 4% respectively. And so many markets on a year-to-date basis, the Taiwan and Japan particularly, are down more than 20% on a year-to-date basis. And as this trade war seems to be rapidly escalating back home in India, it's IT, metals and pharma which are bearing the biggest brunt of the selling pressure. The Nifty IT index is down close to about 3%. And not to forget, back home over here, we've got the RBI policy on expected lines, cut interest rates by 25 basis points. They've changed the stance to accommodative, and we'll have gold loan companies to watch out for.
Absolutely. Good morning, Nima. Like you mentioned, week handover, two very important events, sweeping tariffs, that came into effect a few hours ago. And along with that, the RBI policy, the MPC committee, along expected lines, going ahead and cutting policy rates by close to 25 basis points. Let's have a look at the impact post-policy. The Nifty now down almost 160 points, and what are the stocks that are under significant pressure? The entire gold loan lending pack. So names like Muthoot Finance, Manappuram Finance, remember that particular stock is in the F&O ban today, IIFL Finance, all three of these stocks that have direct gold loan lending practices are under pressure. What has the RBI said? Well, they have said that they're going to go ahead and review the guidelines in terms of gold loan lending. So at this point of time, it is still unclear, but we are expecting a lot more clarity from the RBI later today when these practices are made public. Now, along with that, which are the other stocks that are seeing pressure? The entire NBFC pack up. So names like Chola Fin, Shriram, Bajaj Fin, all of these stocks too under significant pressure. In fact, Chola is down almost 5%. The other stock that's taken a bit of a knock is SBI Cards. Well, some commentary in terms of going ahead and relooking the limit in terms of P2P lending is something that has ensured that SBI Cards too has remained in focus. And, from last night or from last evening, the entire pharma pack under renewed pressure. Tariffs are definitely here to stay, especially when it comes to the pharma pack. So names like Loris, look at that, almost 5% lower. The entire pharma pack, Aurobindo, Ipca, all of these stocks under significant pressure, Rima.
Well, that's the picture at 11 o'clock. As always, we'll invite Ajay Srivastava from Dimensions Corporate Finance Services to join us on the show. Ajay, make sense of all the news flow for us, and what should investors do?
I think, there is more news flow than anyone can reasonably expect to handle. So in which case, I think you just go back and relax, because there's nothing you can do. Events are moving faster than you can evaluate. Things are volatile at this point of time. And you know what, Rima, one thing stands out. And I think that's the most important thing which amazes me. No other global leader or a company or a country has ever come out with a radical policies to balance out what's happening in America. America has done what it has to do to protect its interest. But whether it's China, India, you look at UK, France, none of them have done anything at all. What stops us from having a large GST cut? You do change the regulations, free up the economy. And on top of that, we have RBI again saying, I've got a new gold loan. Anything which works well, the regulatory scenario in all the developing countries means go tap it, change it, and I'm going to take you out. So if you look at India's history, we had a capital gains tax, we had a huge pressure on F&O, trading volume, margins have been put, change of this, settlement date changes. You name the interventions, but the big ticket is missing. You need to match America. America has done grand stuff, actually. We may not like it, but from their perspective, they've done what they could. The biggest economic moves have been made. It's up to the countries to respond now, and each of the country can only be blamed itself if it doesn't respond to what's happening in America. So investors, I think you brace and wait and see whether your government, and it goes for any country, will respond to what's happening in America in a more constructive way. It's not happened so far. Will it happen? I do not know. But today was a gold loan regulation for RBI was disappointing. It was not required. But again, we need to push the levers of anything which goes well. That's the beauty of bureaucrats. Find me a good thing. I'll tell you how to unfix it.
So what would you do then with gold loan companies like Muthoot Finance, Manappuram, Chola, IIFL Finance? All of them, as you can see on your screen, are reacting, and they're worried about what might come out in terms of these comprehensive guidelines. You clearly don't like the idea of them being regulated. What are you most worried about, and what would the advice be on these stocks?
I think RBI is going to be pushing the gold loans towards the banks. The banks have been the biggest loser in the last 5 years on gold loan. They just couldn't get their act together. They're lazy bunch of banks we have in India. And what RBI is trying to do, and I guess we are all guessing, nobody knows what the regulation looks like, so we're all guessing it. My guess is that the regulatory nudge will be that let the banks become more competitive by bringing out pressure on the gold loan companies. I think net, this is what RBI has done in the last 10 years or 20 years. This is what they will do to get the bank a little more competitive edge in the market, but using the regulatory levers. There's nothing else needs to be done. The guideline was changed last year. We had a weighted measures on gold, the gold price saying you penalize the companies which flouted the law. It was doing well. If you go around the country, people had very easy access to gold loan. There's nothing you need to do. It was working quite well. So my only guess is the nudge is going to be move the business away from gold loan companies to the banks. That's my only guess. Nothing else was required in my view, and we'll wait and see what the guidelines unearth, something, which is totally, we didn't look at it or it was hidden under the carpet, but I doubt it. It's all about push the business to the banks.
Ajay, take your point completely on board. However, are you a little surprised in terms of the reaction, given the fact that the new norms are still to be notified? The RBI said there will be a comprehensive set of regulations that come into impact. One of the key points, like you mentioned, could be the fact that they could nudge more gold loans towards banking sector. What could be some of the other aspects that RBI is looking at? Are they worried about the lending practices itself from NBFCs?
See, Vivek, the market is fragile. You're putting into a mysterious regulatory point just when the market is most fragile at this point. Investors are literally at tenterhooks. People have just started to build back a little bit yesterday, and next morning you throw. So it's not about just the regulatory, it's also about timing. You got to be a little smart about, doing these things in a market where investors, companies, etc., are more confident of the future and they can absorb regulatory changes. Once you throw a bombshell in an already, it's like saying that let me pour some more kerosene in the fire and let's see the fun. No, its reaction is overdone. I think nobody knows the guidelines, so selling off is the thing. But just market is fragile too. It cannot take any change. That's all it's telling you. And I think we need to recognize that this market needs a cooler hand, a saner hand, a stable hand, not changes at this point of time in a regulatory scenario.
Ajay, own any IT in your portfolio or in your client's portfolio?
Zero, absolute zero IT. And I think the reason was different, not because of the tariff, but the reason was the growth rates were looking very anemic in the US. And, Indian companies have not really done what it is. And number three is, thanks to our guidelines, we can invest directly into technology companies across the world. So Indian technology companies were not the most attractive bets at this point of time. So we have zero at this point of time. But having said that, there may be a time which will come when we will come back and buy it. But let's ride out this uncertainty which is killing us at this point of time. And maybe there will be, the GCCs, the capability centers might get a leg up thanks to the US tax cut which are coming into place or should come into place. So, in this volatile environment, you should rather stick as a concept we have stuck to domestic industries, relatively unaffected by what's happening in the US tariff barriers, export, import. So, the only safety is buy India, make India, consume India is, I think, the safer place to be at this point.
Understand that, Ajay. Ajay, if we could, once again look at the BFSI pack. Post-policy today, there were expectations that NBFCs actually stand to gain from the rate cut. But what we've actually seen is quite a bit of a sell-off even amongst the NBFCs, gold loan NBFCs aside. So at the current juncture, how do you view NBFCs and also your view on banks?
NBFCs have always been the poor cousins in the banking environment. And unluckily, as I told, same issue with RBI is that it just nudges everything towards the way of the bank. So NBFCs have by and large been uncompetitive in the scenario. Only maybe 2 or 3 have been able to thrive and survive, the larger ones, if you look at it. But apart from that, the whole industry has plagued with underperformance. And not that they have done great justice. Some NPAs come out, something come out. MFI, you see what's happened to the merger of MFI with banks. They have been a disaster. So, the point still remains that the regulatory overhang favors the banks at this point of time. NBFCs are volatile because regulatory changes can change dramatically. And number 3, of course, is that as the economy starts to slow down, and which is very visible at this point of time, NBFCs are left with lending to segment which they should not be lending to, and the risk is going up now in their business. So what was a good borrower last year may not be a good borrower this year. I think that's what is happening today. that the quality of borrowers is going down. And in an environment where the wealth impact, Vivek, look at the wealth impact. Look at if you were an investor, was sitting with a portfolio surplus last year, you were willing to spend money and you were willing to borrow money and invest or consume. Today, when you sit 1 year down the line with your portfolio devastated, economic uncertainty, would you be a willing borrower to buy for consumer durable cars or houses and so on and so forth? I think propensity to consume is going to go down with all the volatility and wealth impact, and that will first hit the people who used to borrow from NBFCs and who used to pay a little higher rate than the banks. Therefore, they were a little less credit worthy. And I think that's what's going to play out now in the next 6 to 9 months till the thing stabilizes. The NBFC's borrowing population, I think, will shrink and the quality will deteriorate.
The negative wealth effect has got to start hurting at some point of time. But Ajay, what about staples? The only sector today which is strongly in the green is Nifty FMCG, 1.5% higher. It falls in the bucket of Consume India. RBI's inflation projections for the first 3 quarters of FY26 are below 4%. And plus, there was that budget boost. So in your domestic-oriented portfolio, does FMCG find its way?
Unluckily, there's very little we have in the FMCG for the simple reason that the competitive intensity has become huge in the local market. And that's where it is hurting everybody. It's not the demand will not go up, it will go up. But look at the number of new players coming to place. The quick commerce players are coming directly. The newer players are coming. The malls are coming. The Reliance retail kind of stuff are making their own product at this point of time. So, so the environment is getting so crowded on a 6 to 10% base of economy. Every day we find a new player coming and a new segment. Look at the products. We want chemical-free soaps, chemical-free detergents, where Hindustan Liver doesn't have the product. You want more organic stuff, and it's selling. You go to Amazon, you're selling. Companies like Two Brothers are selling crazily out there, but they will not buy an atta from a large company in India. So, the market is getting fragmented, is getting into different areas where people are not able to do it. That's why the edge with the FMCG had is gone today. This competition is killing everybody in the market today, and the new players are entering. So in the Consume India leg, I would still say hotels, hospitals, aviation. I think the 3 legs to this one, which continues to grow and be safer bets for you. FMCG is going to say serious competition from all around them. There can be a temporary 1-2% blip up, but if you're in equity, you need to be at 20% return expectation. If you want to make 8-10% or 12%, you might as well buy a gilt fund. It will give you 10-12%. So investors have a choice. You want 10-12%, just buy a gilt fund. It will give you that return. You want 12 to 14%, you go buy a power transmission REIT, will give you the return. But if you're in equity, you not to look at 20-24% return, and that's not going to come from FMCG.
Completely take that point, Ajay. Ajay, one sector that's been in the midst of very heavy news flow and largely negative has been the pharma pack. You spoke about domestic-facing hospitals as something that you'd like to own, but how do you look at the pharma pack, especially generics that supply significant volumes to the US market?
Again, Vivek, they're very good companies, okay? And we had large investment. Today, we have almost zero. But the point remains that uncertainty is killing the investor at this point of time, and you don't need to worry about being late to the party. You have enough time to go back in pharma. Nothing wrong in the companies, very strong companies, almost debt-free companies. Cash flow is humongous. Everything is good. But again, the point is the uncertainty of tariff. How will they react to it? What will happen? Almost 50 to 60% sales of most companies are to the US market at this point of time. How will they diversify away? We don't know the answers at this point. So I think it would be wise to just wait and watch. But let me tell, they are excellent companies. You cannot duplicate them. Even if America wants to shift it to America, it cannot happen. The production capacities cannot be set up overnight, certified. It takes a pharma plant literally 5 to 7 years to stabilize and get certified. So it's not something which you can switch, or it's not like assembling phones. You can start it next morning. This is a different business. So owning this company is a very good idea. They're very good companies. But as I said, just wait a week, 10 days. Let's see where the play comes from the US side, and we will know the answers. But long term, it's an excellent thing to own these companies. They'll give the best return. Domestic market, which is 40% of these companies, is doing reasonably well. It's not grown so much because maybe we're getting healthier, except for people in Delhi where we are dying of pollution, but others are going healthier at our cost. but I think it's a good place to own yourself. Just wait 10 days and see where the tariff comes.
Got that. Thank you very much for that. Some buying is emerging in the, domestic two-wheeler names. So Hero MotoCorp, Bajaj Auto back in the green with a gain of about 1%. That intraday will come up for you on your screen. On the other side is Commodity Corner. Manisha Gupta joins in to tell us what's buzzing.
Case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for $9.56 billion in electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports through all of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcomp, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to the state's export engine. And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in partnership with global electronics manufacturer Flex.
Cisco's partnership and the announcement
to the CNBC TV18 special. The global markets have been in a state of mayhem ever since President Trump decided to go through with his tariff policies. In fact, 9:30 a.m. today, India's tariffs have kicked in at 26%. The other worrying aspect that's come in overnight is President Trump reiterating the call on tariffing pharmaceuticals. Remember, pharmaceuticals have been exempt so far, but this is the second time in the last few days that President Trump has talked about tariffing pharmaceuticals like we've never seen before, in his words. President Trump also speaking at a dinner last night and claiming that countries were calling him up, leaders were calling him up to try and get deals done. The USTR, of course, making it clear at this point in time that there will be no exclusions to what has been proposed by the US as far as tariffs are concerned. But to talk us through what we should now expect as far as America's intent to do business with the world is concerned, the impact of all all of this on the global economy, and more importantly, how India finds itself positioned in the global markets, is noted economist and a very vocal critic of the tariff policies, Jeffrey Sachs. Thank you very, very much for joining us here on CNBC TV18. A lot has happened over the last few days. A lot has happened overnight, as I pointed out. As you look at these tariffs and playing themselves out, what worries you the most today?
If something wipes out $10 trillion of market capitalization in 2 days, you're probably on the wrong track. The United States is on the path of wrecking the world economy once again. I say once again because the U.S. has a bad habit of wrecking the world economy. It did it in 1930 with tariff increases, the infamous Smoot-Hawley tariffs, which were one of the major provocations that led to the worldwide Great Depression of the 1930s. It did it in 2008 by blundering in its forced bankruptcy of Lehman Brothers on September 14th, 2008, and that put the world into a tailspin, the Great Recession. Now it's doing it a third time. This is out of the fervid imagination of one person. This is not U.S. policy. This is not congressional policy. This is not U.S. public policy. This is Donald Trump's policy. He is single-handedly wrecking the world economy. And I think the damage is going to be done before it gets undone. So we're not in a good situation. The markets are not the only ones telling us that. We're hearing from business people all over the world that long-made value chains, supply chains for critical commodities, for consumer goods, for industrial products, for making automobiles, for making smartphones, you name it, are being profoundly disrupted. And we have somebody laughing as the world economy burns, and that is our president. So this is not at all a case with the silver lining, unfortunately.
Well, it doesn't look like there is any silver lining at this point in time, Professor Sachs. But, you know, you talked about the wrecking ball approach that President Trump seems to have taken and the impact it's going to have as far as global growth is concerned. But let's talk about America. You know, Larry Fink saying we're already in a recession. Bill Ackman, one of the biggest supporters of President Trump, coming out and saying we're headed into a long winter now as far as the economy is concerned. The impact so far is largely been felt in the financial markets. When do you start to see this impact the real economy?
If the survey data are correct, we're going to see it in consumer purchases declining sharply in the coming months because consumer sentiments are falling through the floor. That means that we're going to have a significant demand shock in addition to all the multiple supply shocks of disruption of global supply chains. These businessmen expected to be making fortunes at a business-friendly administration. For them to be speaking out after they invested so much money to buy the presidency for this person is also indicative of their state of mind. So I think what we're hearing, again, I'm not a short-term macro forecaster, but we're hearing that the odds now are odds on for a U.S. recession in 2025.
Odds on a U.S. recession in 2025. But let's talk about the latest development with respect to China. And the president saying that China is going to be tariffed higher, another 50%, which takes the total quantum to over 100%. China saying it will retaliate with countermeasures. Now, do you believe that the possibility of China selling U.S. bonds, it holds about $800 billion in U.S. bonds directly, you know, there are many in the market who believe that that will be the option of last resort. How do you believe China is likely to play this out?
China, of course, has been diminishing the share of its foreign exchange reserves held in dollars for several years now. China is not naive when it sees that the U.S. has confiscated the reserves of several countries now in which the U.S. has geopolitical opposition. So the U.S. took and froze, of course, the more than $300 billion of Russian reserves, technically in Belgium and Euroclear. The U.S. grabbed the foreign exchange reserves of Venezuela. It did the same for Iran. It did the same for Afghanistan. It did the same for North Korea. The U.S. weaponized the dollar well before this latest round of trade hand grenades. So China already has been diminished when you have this kind of obstreperous and unstable government at what is now the core of the payment system in the world. So China definitely will not just sit there with its Forex reserves in dollars. Whether it will act abruptly in a reaction or whether it will gradually continue the direction of sell-off, I don't know. But it will continue in the direction of disgorging itself of U.S.-denominated assets.
You know, the question is whether this is the end of American exceptionalism, and you certainly seem to believe that it is. But is it also the end of China's isolationism? Has the Trump administration, the unintended consequences of this tariff policy, as well as the way that he's going about addressing friends and foes, will it push people to actually re-engage with China?
Well, first, it's not the end of American exceptionalism, and what America is doing is absolutely exceptional, just exceptionally damaging. So it's the end of
a different kind of exceptionalism.
It's the end of American leadership, I would say. It's the end of other countries looking to the United States as a stabilizer, as a rule-based order, although that was quite frayed already, but now no one could utter those words with regard to the United States. Similarly, China was not in any way isolationist. It was the major trade partner of probably 150 countries in the world. But China has aimed for the last decades to be a responsible participant in the international system, not to put its head out too far in leadership. Deng Xiaoping famously advised China, bide your time, keep your head down. We need to rebuild after a long century and a half of economic difficulty, what they call the century of humiliation. And so Deng Xiaoping said, keep your head down. Now China can't quite keep its head down. China is under direct attack by the Trump policies, and this is one of the core dimensions of the Trump policy. Part is protecting American economy in a very naive and, I think, doomed to fail way. But part of it also is a hostile action vis-a-vis China especially, which is that China must be broken in its global success story because it's a competitor with the United States. So China now has to take a more leadership role. I think China will have to enable the renminbi to play a more international currency role. It's been very gradual, step by step, but I think it's going to have to accelerate. China, I think, will accelerate the calls for the BRICS, of which, of course, India is a founding crucial member, to play a somewhat of a balancing role to the United States in the international scene, especially calling on the BRICS to reinforce their open trade with each other, because after all, the BRICS is more than 40% of the world economy. It's about half the world population. It matters a lot. And so I think that grouping is going to play a more important role. So I believe that China reflected on this and said, we're not going to be bullied, we're not going to be blackmailed, we're not going to be cornered by the United States. And so the brawl is very real right now and very dangerous.
Real and dangerous. You're absolutely right in pointing that out. But Jeffrey Sachs, you know, as we look at the negotiations that are likely to take shape. And President Trump, pardon my language, saying last night at a dinner that leaders are calling him up and, in his words, to kiss my ass.
No, it's not your language, it's his
It's not my language, it's his
Right.
language, and I want to be clear about that. You know, and I'm trying to look at this from the perspective of countries that are trying to negotiate agreements with the US, including countries like India. What should we be mindful of?
Don't trust that there's going to be some breakthrough. India's vision is, well, the U.S. hates China, so India will, in a way, replace China in the value chains. Companies like Apple or others who are investing heavily in India, they'll produce in India rather than producing in China, and they'll export to the United States. Don't count on it. It sounds plausible, but Donald Trump's idea is to stop international value chains, period. He says, of course, he's an economic illiterate, but he says that we're going to bring all of that production back home, that the hollowing out of American industry has to end. So his idea, yes, he hates China. He wants to confront China. But his idea is not that India is going to be a massive supplier to the United States, because if that were to happen, and it could very well happen in an open trading regime, the U.S. would turn on India exactly the same way.
So don't take the relationship for granted.
Don't even expect there to be an agreement this fall. By all means.
The External Affairs Minister, who was speaking at the summit this morning, said that we've had more engagement with the US in the last few weeks than we've had with the EU in the last few years. He, in fact, went so far as to say that he doesn't see a reason why an agreement can't be in place before fall. You're suggesting that don't expect that to be the case.
I'm not disputing his optimism. I'm just saying don't count on this. The U.S. is in turmoil. The U.S. Has been likened to China's Cultural Revolution in the 1960s. We are in a cultural revolution right now. We are in a political meltdown right now. Very odd, sounds weird. The United States doesn't exactly give that image, but remember that what's happening is not based on law. It's not based on congressional action. It's not based on public debate. It's not based on public policy. This is a one-man show right now. Weird for us, by the way. We don't have one-person rule in the United States. But people can go online. It's quite interesting and a little frightening to read the executive order which launched this trade war a few days ago. Says, by the powers invested in me as President of the United States, and then it lists 3 emergency actions. I declare an emergency. Are you kidding? I might expect that of some tin pot dictatorship. I don't want to insult the tin. It's crazy that the United States acts this way. A $30 trillion economy, and one person stands up by the emergency powers vested in me. This also has a term that I can't use in polite company, but it is nonsense. It is illegal. It is unconstitutional, not only reckless. It is completely against our laws and our Constitution. Whether that matters or not, I don't know. Are the courts going to stand up, or are they going to?
What about Congress?
Congress is pathetic right now. The problem is Donald Trump came back into office in a system that was already so corrupt that it's brittle. Why corrupt? Because the 2024 elections had $16 billion changing hands, visibly. We're a corrupt political system based on large campaign donations or contributions, so-called, that are legal, but is nothing but corruption. Who bought this government? Elon and his friends in Silicon Valley and some of the Wall Street people. Maybe they have purchasers' regret right now, But they bought this election. They paid for it fair and square. They think they own this government. Maybe they don't really own the government. But the politics are deeply corrupt. So all Congress people care about is their donors. Now, if their donors, by the way, tell them we got a crazy guy making all of these crazy emergency decrees and this has to stop, it's possible that Congress will come back to life. But it's been a doormat up until now. The president is taking congressional authority. Article 1, Section 8 of the U.S. Constitution says that tariffs are a congressional responsibility. If you look at Article 2, which defines the president's responsibilities, believe me, it doesn't say that the president can set duties or tariffs or taxes. We had a whole revolution against England on this exact basis, that no one person could set taxation. But Congress has been completely a doormat up until now. Maybe their donors will start to tell them, we don't like one person rule, in which case we'll start seeing some congressmen act.
Well, you know, Democrat Senator Ron Biden has said that he would push for a vote on the issue of tariffs. So do you believe that that could be possibly the pause, the speed breaker in the kind of action that we're seeing?
There are several possible speed breakers. One is that the courts could just declare this is completely unconstitutional, which it is, by the way. Yes, a president can have emergency powers if there's a Category 5 hurricane, if there's a massive forest fire, if the United States is under military attack or terrorist attack, not for 20 years of trade deficit. Sorry, that's not an emergency. That is an economic condition. It's not an emergency. So what Trump has done is plainly illegal. And there are some lawsuits starting, and we don't know whether the judges, many of whom have been appointed by Trump, are going to follow through. So that's one possible break. The second possible break is Congress itself. We already saw 3 Republican senators side with the Democrats to vote against the tariffs on Canada, because these senators in the Republican side had some particular interests in the Canadian-U.S. trade. But it's a sign that already in the Senate side, at least, there's a break. Congress is much more pathetic. These people who go every 2 years for elections, they're really corrupted and pathetic. But maybe on the House side, which is crucial in this, there are only a few votes on the Republican side, and maybe there are a few honest Republicans who will say, we don't want the whole economy to come crashing down. That's another possible break. The next possible break, by the way, is I doubt that there's a single advisor around Trump who really believes in this, other than one crazy guy named Peter Navarro. Other than that, I don't think the Treasury Secretary believes in this at all. Most of the advisors know that this is completely shambolic and reckless. They're making excuses. You know, it's very hard to contradict the boss in general, but it's very hard to contradict Trump in particular. But Elon Musk, you know, he was our prime minister, at least for the first 3 months of the year. He's saying that it makes no sense. We should have
a very public spat with Peter Navarro.
for zero. I don't know how much longer Musk is going to last in Washington. He's going to go back to SpaceX and Tesla, I'm pretty sure, pretty quickly. But inside, everybody knows this is reckless. But nobody tells the boss. This is the emperor has no clothes. I hate the image, but anyway, this is really the situation right now. They're all afraid, but maybe something will prevail inside.
As we wait for some of these scenarios to play themselves out, if at all they do, I want to come back to your point that you were making on India to say that we must not take the U.S. friendship or the relationship for granted, especially as India has its own aspirations of making India. It is poised to be the 3rd largest economy. And I go back again to the negotiating table because the agreement is at this stage in conversation between both sides. What should be the red lines from the India perspective?
One overarching point don't be played by the United States. Don't get into the rhetoric, by the way, which some politicians are using here, that, in fact, some politician said in India recently, this is China's fault. My God, don't fall into that trap. Don't do with Trump the words you used, to use that kind of rhetoric to divide India's role in the world, to play the game of Trump, to believe you're going to have some special relationship with Trump. There are no special relationships with Trump. Trump has one great love, Donald Trump. No other. And India is not going to be a competing suitor for that. India, and I know this is quite unpopular in India, but it's really true. India really needs normal relations with China. And India should appreciate this is a great civilization, and this is a country that's going to play a huge role in the world in the 21st century. I mean, a huge role in the world on all sorts of things, on culture, on economy, on technology, on global peace, an enormous role. India should play that role respectfully and carefully, and that means good relations with China. It means good relations with Russia. It means good relations with Europe. It means good relations with Africa. Yes, have good relations with the U.S., but don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement. And purely on the economic side, the hostility now inside India to dealing with China in trade is not beneficial for India. India is on the cusp of huge advances in technology, but that's not against China. China-India tie-ups in different sectors would be hugely beneficial here and for China as well. And so the whole idea that this is an enemy on this side and America's the friend on the other side, that's the main thing that I'm really warning against. The second thing that I want to warn against is, by all means, try to negotiate, but don't be surprised if it doesn't work, and don't count on it. Look for multiple options. Don't think that the rescue point is we cut the deal with the U.S. Maybe yes. I think likely no. Maybe I'll be proved wrong, and I'll be happy if I'm proved wrong, but don't count on it. Make a multilateral trading arrangement, promote trade with the rest of the world, including China, including Russia. Don't let the United States say, no, that one's against. That's a sanction. Don't trade with Iran. Don't trade with Russia. India's been very good at that in the last year. Also, as a footnote, India's a little bit been dragging its feet inside the BRICS, saying, this alternative payments mechanisms, we don't want to get into that. The Americans don't like it. We'll keep with the dollar and so forth. That's another related area where India should understand, be careful. Don't depend on the dollar. The rupee should be an international currency. The renminbi should be an international currency. The BRICS should have multi-currency payments mechanisms. The BRICS should not be vulnerable to U.S. unilateral sanctions, which are plainly illegal and plainly destructive. So my main point is India should be a great power, and it should act like one, not taking sides, but rather saying we need global order and global peace.
Well, Jeffrey Sachs, before I let you go, Donald Trump has come up with a new term, the panican. So, I would imagine that you would be squarely put in that camp by him. Are you not concerned about the fact that you're very vocally criticizing the Trump administration's policies?
Look, the world is 8 billion people. We've got a lot of challenges. We can't have one person rule. in the world, in my country, period. We've had one of my students dragged off out of his house a couple of weeks ago by unmarked police, so-called, without a judicial warrant. And this student is still in detention in Louisiana. The courts haven't even issued a writ of habeas corpus yet. It's shocking to me. His wife is 8.5 months pregnant right now. We can't have one-person rule in this world. We can't tolerate it. We can't play the game. We can't humor craziness. We have to be straightforward adults. This is my view of things.
Jeffrey Sachs, always a pleasure. Thank you very much for joining us here on CNBC TV18. Appreciate your time, and we look forward to hearing more from you. This is a developing story, and it's not done by a long shot. So we look forward to hearing more from you on how this plays out. But thanks very much for joining us here.
Great to be with you
today. That's Jeffrey Sachs. We are going to take a break here, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.
Huge difference, not just for Flex in India, but also an industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing is more down the value chain coming in, more components down the value chain. The entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's output. Right? We would definitely want to go up.
The groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn has committed 13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanath.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over-leveraging of customers to credit costs to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, X of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023, and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equitas Small Finance.
Welcome back. Once again, the Nifty IT index and individual stocks are bearing the brunt of the selling pressure. 2.5% gone for the day. This month, Month of April, it's down 12%, and now the year-to-date loss for the Nifty IT index stands at about 25%. And individual IT names like Hexaware, 5.5% gone. Wipro, top casualty in the frontline IT pack, 4.5% gone after Jefferies downgraded it to an underperform and slashed the target price by more than 30% to 210. Coforge, Persistent, these are high growth but expensive stocks, which are also seeing some amount of profit booking. But all eyes will be on TCS tomorrow. It's a market holiday, but TCS will be reporting numbers. A press conference is scheduled at 5:30 p.m. and these are the numbers. Dollar revenue growth seen down 0.8%. Constant currency growth is likely to be flat on a sequential basis. But the problem is that the BSNL contract, it was a large contract and that's slowly ramping down, which means the incremental contribution from BSNL is steadily coming down. If you strip out the BSNL contract, the X of that, the international revenue growth, according to some analysts, should be up close to about 1%. Margins could inch up to 24.8%, aided by rupee depreciation. Profits up nearly 1.5%. But that said, the numbers this time will be fairly meaningless because these are backdated numbers. All the uncertainty is what lies ahead on account of tariff uncertainty, where the US dips into the recession. So from the company doesn't give you a quantitative guidance. So they're not Infosys, which comes out and says, well, we're going to grow 2 to 4%, but we could try and gauge the corporate behavior. Are deal ramp-ups happening on time? What are tech budgets looking like? If they've been finalized, are they willing to spend that amount? What about decision-making? Are projects being put on hold? Is there a deferral in that, or maybe even a cancellation? So you can gauge the corporate behavior from the management in terms of commentary. Also, the CEO last quarter in January, 3 months back, spoke about some early signs of revival in discretionary spending in some vertical. Those were his exact words, early signs of revival. I guess that's pushed out of the window, but we'll want an update on that. And also the company had sort of said that CY25 will be better than CY24 for the international markets. That's X of BSNL. So, what happens to this commentary? I'm presuming, again, that's also going to be sort of thrown out of the window. But I think the street will watch the commentary, the macro environment, from the management. The stock is trading at about 22, 23 times PE after the recent correction. So it's come off significantly, but it's closer to its, 5-year average valuation multiple now.
Thank you so much, Reema. All of the IT stocks, like you just said, almost 20% lower in 2025. So they're going into this particular earnings season, relatively under-owned. But, let's have a look at the markets. What's actually recovered and recovered very sharply is the entire FMCG pack. RBI Governor Cummins, number one in terms of easing inflation, number two in terms of it being a normal monsoon year, has actually ensured that all of the FMCG stocks have recovered quite sharply. So you pull up names like Nestle, Hindustan Unilever, Colgate-Palmolive, even a name like Britannia, all of these stocks actually are trading near the day's highest point. The other stock that's doing quite well is actually Indigo. Some news flow as far as Interglobe Aviation is concerned, and falling crude oil prices seen as a positive. So Indigo too doing quite well as far as today's trading session is concerned. But with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.
Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, the underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of their borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized. Hence, incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising
Well, hello and welcome to Halftime Report. We have the Reserve Bank of India that has just announced its monetary policy decision, cutting the repo rate as widely expected by 25 basis points and also giving a stance change from neutral to accommodative, indicating that the Reserve Bank of India will either cut rates or pause, but not hike rates from here on. We've been speaking to various analysts and economists through the course of the morning to understand what this implies. It is a dovish policy. There's lots more that was announced as well on the banking front, whether that is draft regulations that are to be out on gold loans and also for co-lending arrangements between all the regulated entities, not just banks and NBFCs, and for all segments, not just priority sector. So those and many more important announcements coming in from the RBI policy. We can see the Reserve Bank of India governor and the deputy governor sitting to address the media. We'll take a look at what they have to say.
For this financial year and in this new setup, friends, we have with us Governor Reserve Bank of India, Shri Sanjay Malhotra, Deputy Governors, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Executive Directors, Dr. Rajiv Ranjan and Dr. Ajit Joshi, as also other colleagues from Reserve Bank. Sir, with your permission, we'll move directly to questions and answers. Yes. So before we begin, I'll request all of you to please wait for your turn. Before asking question, please switch on the mic which is in front of you, because otherwise people who are listening to this live feed would not be able to listen to you. And also request to switch it off once your query is over. In interest of time, as I always request, please stick to one question per person, and we'll see if time permits we can take the other one. Sir, there are 26 people from media today, and with your permission, we can commence the question and answer. I'll request Mr. Laltendu from The Hindu to ask his question.
Thank you very much, Putin sir, Governor sir, good afternoon, and everybody good afternoon. Sir, my question is about the trade war. You already made a reference in your statement about the noisy trade war that is happening. It started with reciprocal tariff, then retaliatory tariff, then again counter-retaliatory tariff. I could call it a revenge tariff. So whether we should be worried about or not, and what is your assessment of the situation, sir? Thank you.
I think this question, we fairly covered in my statement as to what its impact really is going to be globally as well as for the Indian economy. Globally, you are aware that most of the forecasts now for the GDP growth rate have, for the global growth rate have come down, by at least 20 to 30 basis points, not only for this year, even, for next year. And similarly, inflation, there is mixed response globally for inflation, especially for US. It's projected forecast to go up because of the tariffs that they will be imposing. For other countries, the impact would be different, depending on the situation that they are in. For India, we have given, our assessment. As you can see, the growth rate we have reduced by 20 basis points this year, primarily arising out of the uncertainties, the various channels through which this moves, and also, I elaborated in detail in my statement. And on the inflation front, we have said, it can move actually both ways because of the surplus, because of the demand that is going to shrink as a result of the trade tariff friction. It may help. On the inflation front. You are seeing that the crude prices have also gone down. So all in all, more than inflation, we are concerned about its impact on growth. And accordingly, you can read the statement for further details. Thank you.
Thank you, sir. Next we'll have Lata from CNBC.
Thank you very much for the opportunity. Governor, you had said that the real rate for you should be 150 basis points in a previous conference. Now, per your forecast, throughout this year, inflation is going to be below 4%. In which case, the real rate today is actually 200 basis points. So do you think there is a chance for a double rate cut should have been already, like a 50 basis? Because we're very far away from that 150 real rate. We are at 200. And do you think the real rate itself should be 5/4 because you are expecting inflation to be even below 4%? How would you assess that? And just a related question, liquidity in the past, the Reserve Bank has guided on the liquidity amount. That helps transmission, basically. They have said that we want liquidity to be 1 to 1.5% of NDTL or negative 1 to 1.5% of NDTL. Would you want to give the bankers some comfort zone like that? My liquidity threshold is 2 lakh crore or some percentage of deposits so that transmission happens.
So this figure of 1.5%, I mean, I don't recall, having made it. Maybe some of my predecessors may have made that statement. I think from studies that we have, the real rate is to be in the range of, different studies are there, from 1.1% to 1.9%. So 1.5% is quite a plausible, real rate or a natural real rate, as you call it, over there. Insofar as the policy rate is concerned now, going forward, we have, as you can see, we have changed the stance from neutral to accommodative. So obviously, the trend is going to be downwards. As regards inflation, the average is 4% this year. The average next year, we really don't know, right?
The calendar year, it is below 4.
For the calendar year, yes, it is below 4. But for the next quarter, for the first quarter, it is more than 4%. We will look at, the evolving situation as we have already mentioned, and basis our forecast and outlook for the growth and the inflation. As you are aware, these are uncertain times, and so we will take a call as to where the policy rate should actually move to. With regard to liquidity, I already made a mention in the statement without giving any numbers over there that we will keep it sufficiently in surplus. I again reiterate, that we will provide sufficient liquidity for the purposes of monetary policy transmission. I don't want to give a number, really, as to what kind of a surplus, but sufficiently in surplus. And you mentioned, linking it to NDTL. Well, yes, that is the kind of number, about 1% or so in the surplus range now that, we are on the easing cycle. That is the kind of, number that we will be looking at. And we'll keep it sufficiently, surplus. The aim really is to look at the policy rate. So if we are able to transmit it, to the overnight rate, hopefully it will then transfer to the other short-term, medium-term, and the long-term interest rates. Transmission, you are aware, it takes a little while. It's not over. It will not happen, immediately. We have seen it in the past, that transmission, when we increased it by the repo rate by 250 basis points, it took 6 to 9 months at least, for the interest rates to decrease in response to the policy repo rate decrease. And they also, did not decrease to a corresponding amount. The decrease was about 204 basis points only, as against the 250 basis points increase in the repo rate. So we are watchful. We will provide sufficient liquidity to the system so that this transmission of the policy rate into the interest rate happens quickly. Thank you.
Thank you, sir. Moving on to Mr. Vishwanath from NDTV Profit.
Thank you for the opportunity, Governor. I must say, happy to be back in this room. It's looking a little better now. I wanted to ask you, since you mentioned transmission, I just wanted to get a view that there was a view from the RBI, or at least reports suggested that there was a view from the RBI that credit deposit ratios at banks were, private banks were way too high, and that they needed to come down. Now that we are talking about transmission, eventually, obviously, that will have to translate to higher lending. Are you happy with the credit deposit ratio at this point in time? And the second part is then there's a view that RBI will have to do, or the monetary policy will have to do the heavy lifting in supporting the economy in the current macroeconomic setup. Do you agree with that? Do you think that you have a bigger responsibility to manage in the current scenario?
So coming to your first question, CD ratio, see, when we were in the districts, then we would look at CD ratio basically to see as to whether the credit as a percentage, of the deposits is sufficient, whether, the lending is going on sufficiently. And at that point of time, I'm talking about 25, 30 years, we used to think that 70, 75%, is very good. So some regions, have low because they are savers. Some, where there are more of borrowers, you have high CD ratios. Coming, to your question, CD ratio, well, we do not have, any such prescription of a CD ratio. You are aware that there are no regulations for CD ratio. And however, we do have regulations for asset liability management. That's more important. We have regulations for liquidity management. And there are regulations for liquidity, for the short term in the form of the LCR guidelines that you are aware of over the 30-day period, requiring banks to maintain, and even NBFCs to maintain high-quality liquid assets. And similarly, for a longer one-year duration, there is this NSFR, NFSR ratio that we have prescribed. There is no ratio or no guideline with regard to CD. The banks have to be actually mindful of managing their asset liability, which is important. They have to be mindful and ensure that they have liquidity, both short-term and sufficient funds, over medium and long-term, so that there are no mismatches and there are no liquidity-related issues. So they can look at, their own assets, liabilities, and make a business plan according to them. We do not have any prescription for CD ratio. It is for the banks to decide. Your second question, it's a joint effort. Who does more of the heavy lifting, etc. It's a joint effort. The government has done its bit, I think, in the budget that you saw recently. A large number of measures, whether it is in terms of the increased capex, whether it is in terms of the tax rebates on the personal income tax side. And we will also, we have reduced repo rates. We have changed the stance going forward, which means that the direction of the policy repo rate is downwards. Where it will reach, Lata, of course, asked that question. We really don't know. I'm Sanjay, but I'm not Sanjay of Mahabharat to be able to, foresee that far. I do not have that that divine vision, that he had. But we will jointly, try to manage the growth and the inflation dynamic in our country.
थैंक यू सर. अब मैं ईटी स्वदेश के अनुराग शाह को आमंत्रित करता हूँ.
नमस्ते सर. सर, जो पर्सनल लोन पे आरबीआई की चिंता थी, अब उस किस तरह का रुख है? क्योंकि हमने FY25 में देखा है कि सबसे बड़ा सेगमेंट जो है पर्सनल लोन का रहा है. तो अब जिस तरह से सर पर्सनल लोन के अंदर ही टेक्नोलॉजी बदल रही है और अलग अलग सेगमेंट भी उभर के बाहर आ रहे हैं, जिसमें हमने देखा है कि जो आम लोग हैं उसमें हिस्सा ले रहे हैं, जैसे हेल्थ केयर हो गया, इंश्योरेंस प्रीमियम वगैरह भी पर्सनल लोन के हिस्से में आ रहा है और वहाँ पे बड़ी अमाउंट पे ब्याज भी वसूला जा रहा है. तो क्या जो आज को लेंडिंग से जुड़ा हुआ जो आपने ऐलान किया है वहाँ पर राहत देते हुए उस संदर्भ में है, या फिर एक अलग सेगमेंट बनाया जा सकता है जहाँ पर जो जरूरी चीज़ों से जुड़ा हुआ लोन लोग लेते हैं उन्हें राहत दी जा सके? और सर दूसरा छोटा सा सवाल होगा सर, जो आरबीआई का पहले रुख था कि जो बैंकों की सब्सिडरी है, इंश्योरेंस सब्सिडरी, वहाँ पे 20% तक ही आप हिस्सा अलाउ कर रहे थे, लेकिन हमने पिछले 3-4 महीने में देखा है एक बैंक को 26% तक 2 कंपनियों में अलाउ किया है. अभी एक बैंक ने 30% तक भी हिस्सा खरीदा है. तो क्या रुख थोड़ा बदला है?
आपका पहला प्रश्न की चिंता है तो चिंता नहीं है, कोई चिंता नहीं है. देयर इज़ नो वरी. जो है हमारा जो सिस्टम है वो काफ़ी अच्छा सुदृढ़ है और काफ़ी मजबूत है. चाहे वो टोटल आप बैंकिंग सेक्टर, एनबीएफसी सेक्टर के बारे में बात करें या चाहे आप जो पर्सनल लोन के बारे में आपने बात की. मैं यहाँ पे ये आपको स्पष्ट करना चाहता हूँ कि पर्सनल लोन्स के लिए जो हमने रिस्क वेट बढ़ाया था हाल ही में 125% किया था, वो उसे एक बढ़ोतरी के रूप में नहीं देखना चाहिए, क्योंकि कोविड से पूर्व के पहले का जो रिस्क वेट था, जो हमने कोविड के समय में एक रिस्क वेट क्रेडिट को और अधिक बढ़ाने के लिए हमने वो रिस्क वेट कम किया था, तो उस लेवल को, उस रिस्क वेट को हमने वापस उस स्तर के ऊपर में हम लेकर के गए. हमने उसको बढ़ाया नहीं है. हमने जो उसका ओरिजिनल जो उसका स्तर था उस स्तर के ऊपर में हम लेकर के आए. दूसरी बात मैं यहाँ पे ये भी कहना चाहूँगा कि उसका जो रिस्क वेट है आज के दिन में, यदि जैसा कि कुछ लोग ऐसा मांग करते हैं कि इसको कम करना चाहिए, तो फिर उसी प्रकार से फिर जो दूसरे जो पर्सनल लोन है, क्योंकि जो हमने रिस्क वेट बढ़ाया वो बेसिकली जो अनसिक्योर्ड जो पर्सनल लोन्स थे उनके लिए बढ़ाया 125%, जो वापस से पुराना स्तर किया. तो फिर आप तो ये बात तो मानेंगे कि जो सिक्योर्ड लोन है और जो एक अनसिक्योर्ड लोन है उसमें रिस्क वेट में कुछ फ़र्क तो रहना चाहिए. तो वो फ़र्क जो पहले 25% था उसको हमने वापस से हम लाए हैं. कोई चिंता का कोई, लेकिन आज के दिन में हमारे लिए इसमें कोई विषय नहीं है. दूसरा आपने जो प्रश्न किया कि इंश्योरेंस कंपनीज के लिए कुछ बैंक्स का जो उसके अंदर निवेश है उसके प्रतिशत को हमने शायद बढ़ाया है. जहाँ तक मेरी जानकारी है इसमें कोई बढ़ोतरी नहीं हुई है. पहले भी कोई प्रतिशत इसके अंदर में निश्चित नहीं था. आज के दिन में कोई प्रतिशत निश्चित इसके लिए नहीं है और इसमें कोई बदलाव हमने नहीं किया है. बैंक्स, एनबीएफसीज, बैंक्स, इंश्योरेंस कंपनीज में निवेश कर सकते हैं. वो 51% या उससे अधिक भी निवेश कर सकते हैं और उससे कम भी निवेश, जैसा 30% आपने कहा, वहाँ पे भी कर सकते हैं. कुछ इसके अंदर में बदलाव हम लोग ज़रूर हमने पहले उसके लिए हमने ड्राफ्ट रेगुलेशंस हमने पब्लिश किए हुए हैं. उसमें भी इस संदर्भ में कोई बदलाव प्रस्तावित नहीं है. ओवरऑल क्या किस प्रकार से स्वरूप होना चाहिए, किस प्रकार से बैंक्स अन्य सब्सिडरीज में और कंपनीज में निवेश कर सकते हैं, उसके बारे में हम शीघ्र ही उचित निर्णय लेंगे.
धन्यवाद सर. नेक्स्ट विल बी मिस्टर मयूर शेट्टी फ्रॉम द टाइम्स ऑफ इंडिया.
Thank you, sir. Governor, I had a question on the gold loans development measures that you mentioned. You said there will be a harmonization of rules, but will that be tightening of by making them more tighter or making them easing the LTV?
In my statement, I never said tightening. I said the word used is harmonization. The markets are reading it the way they will read, read it based on emotions, etc. Someone said, I think Benjamin Graham, that it is the stock market is a voting machine in the short run, and in the long run it's a weighing machine. So let's wait. I think for the guidelines will be issued soon. There is no, to our mind, there is no tightening. It is a rationalization only. It's broadly an extension of whatever on the conduct side primarily, whatever were the guidelines for NBFCs, those have been extended now to the banking sector also. You will shortly, we will publish. And these are draft guidelines, subject to further consultation and then finalization.
And so clarification on the 1% NDTL. So you're saying that the goal is to have 1% surplus liquidity in the system around, that's around 2.7 lakh crore.
I would not like to, pin myself down to, 1% exactly, but yeah, that is, the kind of range, near about, that range. If more is required, we'll do more. If less is required, we will do less. Main aim, as I mentioned, is to ensure proper transmission of the repo rate into the interest rates.
Thank you.
Thank you, sir. Next is Mr. Manojit from the Business Standard.
Good afternoon. Thank you. You said an interesting thing that stance should not be directly associated.
Did you want to add on the gold loan, or we wait for the publication?
No, I think, sir, you have covered it. The circular will be, draft circular will be out in public domain very shortly. I think you can see the details there.
Okay. Yeah, sorry.
Yeah. RBI said this earlier, but not in as many words, that the stance should not be directly associated with liquidity conditions. If I understand correctly, you are aiming to have a surplus liquidity of around 1% of NDTL. So what does you mean by this? I'm aware that the liquidity framework is being revised now. Can you throw some light? What are the considerations for the revised liquidity framework?
Let's wait. See, right now under the liquidity framework, we are primarily looking at the overnight rate in the money market, and so whether it should continue to remain the same for the purposes of the transmission of policy. Repo rate, whether it should be that we should be targeting, or we should be targeting something else. That is something that we are consulting the various stakeholders, and shortly, we will come out. I really don't have, any specific answer, because that matter is still being deliberated. Would you like to add something on this?
Nothing. I think once we finalize, we are at this point of time discussing the issues. As Governor said, one of the things is what should be the target rate. You know that call volumes had come down significantly compared to other overnight volumes. And as usual, for any revision of framework or rethink of a framework or review of a framework, we would look at all the tools that we use. Currently, we use a range of tools of different maturities, variable, fixed, and all that. We'll look at those rates and see what changes are required.
No, but the objective is also to speed up transmission. Transmission now take 2 quarters. Is the objective also to speed up transmission? Do you expect banks to transmit this 50 basis point on a more, on an earlier? What are your thoughts on that?
Yeah, obviously one would like, that the transmission happens as quickly as possible, but then it should not be disruptive. So how do we do that is something, again, I think this committee will look into it, and we will take a call. Early, I will not be able to give a date because I have not reviewed it with my team, but we are looking to do it, as early as possible.
Thank you, sir. Next, we'll have Ms. Swati from Reuters.
Thanks a lot, sir. So since tariffs have been the theme and something that was largely discussed, so just wanted to understand, China would most likely use, yuan depreciation as a tool, to get back at the US in the tariff war now. We've also seen, FPI outflows from India in April. We could see the balance of surplus being negative. What would the RBI's currency management strategy be? Because the rupee would definitely be impacted by what happens to the yuan going ahead. And in the same way, so when we've seen previous periods of crisis like the GFC, COVID, etc., we saw a lot more collaboration and coordination between global central banks. Is that something that is happening even now? Is there an effort being done on that? Thank you.
My understanding is, that the impact of these tariffs on India vis-a-vis some of the other countries, you mentioned China and some of the smaller countries, is much less. Our exports overall, about 12% of GDP, less than 1%, I think, for 2%, I think, for America, for USA. You compare it with some other countries, even China. China is about 19%. Germany is 37% exports overall, and even EU, is 30% plus. So our and smaller countries, have in about 80%. I'm not talking about those countries, Vietnam, Taiwan, etc. So to that extent, we are better placed than some of the other countries. That's why you are seeing that the these reciprocal tariffs on India are lower than, some of these countries, because our surplus vis-a-vis those countries is much less. And so we have, in some ways, I mentioned it in my statement also, that we have a comparative advantage. We may have, a comparative advantage vis-a-vis some of these countries insofar as the USA is concerned. But overall, of course, it is certainly still, a growth dampener. And insofar as the currency management is concerned, as you know, we do not actually intervene in the currency management. It's only, for excessive or disruptive volatility that we do so. We do not try to manage or target any rate or band or level of the Indian rupee.
Just clarifying that. So it's fair to say that, if there is a depreciating pressure on the rupee, RBI will let it slide. Is it fair to say that if globally currencies are falling and emerging market currencies are falling?
As I mentioned, if there is excessive, we don't, target any level. We do not target any level. I think the markets in India are quite deep, quite wide, and the market forces best know what the levels should be. Having said that, any excessive volatility, if it requires an intervention, we will not be found wanting. We will certainly intervene wherever it is required.
Thank you, sir. I'll request everybody to stick to one question only, so that everybody gets a chance to ask. So next, I'll request Mr. Ashish from PTI to ask his question.
Thank you, sir. So you mentioned about you can't possibly predict the way forward on the rates. But sir, what would be the chance if major central banks really continue to hold for long? You have taken a shift with the stance, but will it allow us the room to cut further?
I mentioned in my policy statement that, what the impact really could be on the globally, of these global tariffs, etc., and uncertainties, what the impact could be on India. And primarily, we believe that the domestic inflation and growth is what is going to drive and determine our stance and our policy repo rate. So we'll continue to look at our domestic, while being vigilant, of course, and they will have certainly an impact. The global environment will have an impact. But as I mentioned, we are in a better position because our export, import, our interconnectedness with the outside world vis-a-vis some of the smaller economies and even China, larger economies, is much less.
Thank you, sir. Next, we'll have Mr. Anup from Bloomberg.
Governor, the tariffs have set in. Do you expect a currency war in the region, considering that we have different rates of tariffs here? And how will you respond in such a situation?
Understand what you mean by a currency war?
Competitive devaluation of currencies, sir.
I really don't know, what will happen on the currencies. Our currency is quite stable. As I mentioned, we have sufficient reserves. Almost 700 billion, US dollars now, inching up over there. And our deficits are also, again, very sustainable, both this year and going forward, the next year, 1%. So I really don't think, we are under any kind of a stressful position. Again, I mentioned, that's, I think, relevant over here, that our interconnectedness is on, especially, the trade side is less. Capital flows, again, we need good growth to come in over here. That will help. And we'll see, as the situation evolves.
Thank you, sir. Moving on, we'll have Ankur from ET Now.
Thank you so much for giving me a chance. Governor, we have seen in the past that Reserve Bank of India has been little concerned about the co-lending arrangements, and there has been few scrutinies also. Today you have announced that the arrangement between banks and NBFC that will be extended to all other regulated entities, and also priority sector lending was the first preference earlier. Now you are saying that all other loans can also be utilized. Is there a shift of stance of Reserve Bank of India on these norms, both priority sector lending, because I saw that there were norms which were revised where thresholds were increased earlier in PSL norms, and now this arrangement between banks and other entities in co-lending?
I don't understand, the shift that you are talking about. I'll request the DG to come in case there is a shift. But I believe that the co-lending arrangement has actually helped in the priority sector lending, because it was restricted to priority sector lending, and now what we are doing is expanding it to the other segments outside the priority sector lending as well. Moreover, we are expanding it. Right now it was, only REs, only, the banks and the NBFCs which could enter into this arrangement. Now 2 banks together can also enter into this arrangement. The benefit, basically of co-lending is that on the one hand, you get benefit, the borrowers, get benefit of lower interest rates, because the banks have funds at lower rates. And what they don't have in reach is compensated, is provided by the NBFCs. So it's a win-win, primarily for the banks and NBFCs. So we are expanding it. You want to add something on the co-lending? Has there been a change in our staff? I thought, we have been...
Nothing much, sir. I don't think there has been any change in the stance. It is essentially, as you said, we are expanding the participants by extending this to all regulated entities. And we are also seeking to extend the coverage beyond the PSL, and also a bit of harmonization in terms of when more players come and more segments open up, there has got to be more clear guidelines. So the guidelines will be soon out, and we will take again the feedback, and in case if it requires to be fine-tuned, we will do. But it has been a beneficial arrangement for the market. While the AUM is not yet significant, probably by broad-basing the participants and the segments, we expect this to pick up. So it will be, the guidelines will be more facilitative in terms of ensuring that the borrower ultimately gets the benefit of someone who has a cost advantage, someone who has a reach. The benefit of both should reach the ultimate end consumer. That's our intent.
Thank you, sirs. अब मैं जी बिजनेस से एकता सूरी को आमंत्रित करूंगा कि वो अपना प्रश्न पूछें.
गुड आफ्टरनून सर। सर आपने हाल ही में बहुत बार ये एक दो बार जगह आपने ये बोला कि KYC जो है वो कस्टमर्स के लिए ईज आउट प्रोसेस होना चाहिए, बार बार उन्हें फ़ोन नहीं आना चाहिए। तो इसको लेकर सर क्या हम एक्सपेक्ट कर सकते हैं, क्योंकि CKYC में बहुत सी इनडिस्क्रिपेंसीज हैं, बहुत सा रेपिटेशन है, डेटा पुराना है, और दूसरा ये कि बैंक्स में ट्रस्ट होने के लिए अब फ्रॉड, डिजिटल फ्रॉड्स बहुत ज़्यादा बढ़ रहे हैं, लेकिन कस्टमर्स आज भी जब बैंक में जाते हैं एक जेन्युइन फ्रॉड को लेकर भी, तो भी पैसा वापस मिलने में बहुत दिक्कत आती है। तो वहाँ क्या कोई स्टांस जो है कड़े हो सकते हैं, म्यूल हंटर जो है वो मदद कर रहा है, या फिर IC4 के साथ अगर APIs बैंक अपने इंटीग्रेट कर रहे हैं उस प्रोसेस में कुछ तेज़ी आ रही है, तो यहाँ हम क्या देख सकते हैं जो कस्टमर के लिए और ईजी हो बैंकिंग करना और ट्रस्ट वर्दी हो, कुछ विश्वास बढ़े?
KYC हमारे लिए एक निश्चित रूप से हमारे लिए प्राथमिकता है कि किस प्रकार से हम KYC की जो पूरी प्रक्रिया है उसको हम सस्ता बनाएं एक और दूसरी ओर जो है उसको हम सुगम बनाएं। सरल, सुगम और सस्ता किस प्रकार से बना सकते हैं, ये हमारी एक प्राथमिकता है। और इसके लिए हमें बैंक्स और जो सरसाए है, जो CKYCR जिसका आपने जिक्र किया, उसको मेंटेन करता है, उनके साथ में तालमेल बढ़ा करके इसको और अधिक सुगम करने की हमारे को निश्चित रूप से इसमें आवश्यकता है। इसके बारे में मैंने पहले भी कहा है, लेकिन ये उतना आसान कार्य नहीं है क्योंकि इतनी अधिक संख्या में हमारी रेगुलेटेड एंटिटीज़ हैं जो कि भिन्न भिन्न स्थानों के ऊपर में KYC कर रही हैं। तो किस प्रकार से ये एक यूनिफाइड डेटाबेस हो जिसके अंदर में एक व्यक्ति का, यदि कोई भी रेगुलेटेड एंटिटी चाहे किसी भी नियामक आयोग, किसी भी रेगुलेटर के अंतर्गत आती हो, उसका यदि KYC हो जाता है तो पुनः दूसरे रेगुलेटेड एंटिटी को उसको KYC करने की आवश्यकता नहीं पड़े। CKYC सरसाई CKYCR को अपग्रेड कर रहा है। CKYCR 2.0 के लिए उसने कदम उठाए हैं। 100 करोड़ के करीब अभी उसके अंदर उनके पास में रिकॉर्ड्स हैं, तो ये काफ़ी अच्छी संख्या उनके पास में ऑलरेडी हो चुकी है, जिसको हम आगे इसको हम लीवरेज कर सकते हैं। क्वालिटी के इश्यूज जैसे आपने बताया हैं उसको हमारे को इम्प्रूव करना पड़ेगा, लेकिन हमारा यही प्रयास रहेगा कि किस प्रकार से ऑलरेडी भारत सरकार ने अब ये निर्देश दिए हैं, एक नियम बनाया है उन्होंने, और हमने भी अपने निर्देश सभी रेगुलेटेड एंटिटीज़ को दिए हैं कि उसकी पालना की जाए कि KYC करने से पूर्व CKYCR को पहले वो चेक करें, वो देखें कि CKYCR में यदि डॉक्यूमेंट्स ऑलरेडी मौजूद हैं, KYC अगर ऑलरेडी पहले से हुआ है तो उसको पुनः KYC डॉक्यूमेंट्स न लेने पड़े। तो ये निर्देशों की, नियमों की पालना होने में निश्चित रूप से थोड़ा समय लगता है क्योंकि बैंक्स को अपना सिस्टम में बदलाव करना पड़ेगा, उनके IT सिस्टम में बदलाव करना, तो उसको वो बदलाव की प्रक्रिया जारी है क्योंकि ये हमारी प्राथमिकता है, भारत सरकार की प्राथमिकता है। मुझे ये विश्वास है कि निश्चित रूप से आने वाले समय में KYC और अधिक सुगम, सरल, सस्ता होगा। फ्रॉड के लिए हमने विभिन्न कदम उठाए हैं। मैं निवेदन करूंगा अगर आप अनुमति दें अंग्रेजी में और हिंदी में मिस्टर स्वामीनाथन को कि वो जो है आपको विस्तार से इसके बारे में कि फ्रॉड के लिए हमने क्या क्या, म्यूल हंटर की क्या स्थिति है। मैं आई रिक्वेस्ट DG स्वामीनाथन, हमने म्यूल हंटर की क्या हमारी आगे के लिए एक साल में हम कहाँ तक म्यूल हंटर में कहाँ पहुँचना चाहते हैं, कहाँ पे हम आज के दिन में आपने म्यूल हंटर का कई सारे प्रश्न आपने एक साथ पूछ लिए तो ये कई सारे प्रश्नों का जवाब देने के लिए let me get my team in.
Just to sum up on the responses, basically digital frauds has been a major concern for all of us, and we have been working to ensure that the fraud risk management and the proactive risk management systems that are operational at the bank level are improvised so that frauds can be prevented. Well, of course, you also mentioned about if it occurs, what should be the compensation. There are limiting liability guidelines that are already in place. What we also have to bear in mind is that such money moves very fast and it doesn't remain in the control of the regulated entities oftentimes. But wherever possible, they are being impounded and being refunded, while success rates depends on how quickly the complaint is lodged and how quickly it is acted upon. You also mentioned about I4C integration. Today we have all the banks have very actively, proactively integrated with the I4C system, and all the banks have also been mandated to have a 24/7 helpline and dedicated officials who will handle these calls, so that any point in time the action is taken very quickly. Golden hour is what believed in the medical system. The same thing is what we believe in digital frauds as well. We should adopt. The third is in terms of Mule Hunter. The pilots have been extremely successful. The results that are coming out in terms of having the whole system level data, the fraud prevention system in the banks work on their own bank data, while the Mule Hunter facilitates system level data. The pilots that we have done with the large banks have been highly successful. The outcomes are almost near real time, and the models have proved to be effective. But these are AI/ML based models. They need time to learn. They need more data to digest and then become more successful. So we will take this pilot into production as quickly as possible. Innovation Hub has been working with the large banks have been participating. It is our intention that we become as near real time as possible to ensure frauds are prevented as much as possible, and should a fraud occur, and recover as much and as quickly as possible. That's the aim, but this will be a journey, because we have to remember that the fraudsters are always one step ahead. So we are invariably on a catch-up game, but we will probably catch up better.
Dhanyavad sir, thank you sir. Next we'll have Gopika from the Mint.
Thank you, sir. Good afternoon, Governor. Since the time you took charge, we've seen 3 crises at 3 different institutions, one at a private sector bank, a new cooperative bank, and a housing finance company. What are the key, these 3 crises have happened under RBI's nose over a long period of time. What is RBI's learnings from this? And secondly, in the private sector bank, IndusInd Bank per se, RBI would have received the internal review report. Are there any concerns that we have to be worried about? And the management has been allowed to continue. So could you tell us your views on this?
Individual entities, you are aware, we don't get into, the specifics of the individual entities. At a system level, I would say that, and I mentioned this even in my statement, whether it is the cooperative banks, whether it is the NBFCs or the scheduled commercial banks, etc. System level, we are very, very safe, secure, robust. The system is resilient. The other thing is that let's keep in mind that it's a very, very large system. There are a large number of players, almost 10,000 NBFCs. There are about 1,500 cooperative banks. So I was looking at data in last 8 or 9 years, some 70 cooperative banks out of 1,500 cooperative banks. So that makes it about, you can calculate. So it's very small, in numbers it may seem, So these things will happen. Our effort is to minimize the impact, to minimize them. And I think it is quite it's a reasonable, it's quite low. It's quite low. If you look at, I will not have data to support that, but I would tend to believe that, and I would not call them, total failures also. So I'm not, these are episodes. These are episodes, right? They're not even failures. These episodes will happen. We have to ensure through various means that these events, incidents happen lesser in frequency. They happen lesser in frequency. And for that, we have various tools. We have the regulations. We have our supervision. The banks themselves, have multiple layers. They have 3 layers: the business unit layer, their compliance layer, then their audit. So all of them, we have to all work together and continuously try to improve the systems.
Thank you, sir. May I have Ms. Sangeeta Mehta from Economic Times?
Thank you, sir. Thank you. Sir, related to Gopika's question, on IndusInd, can RBI take any action on auditors? I mean, because they've been saying that this is happening for 5 to 7 years. And how did it miss how did auditors miss this completely?
Individual, as I mentioned, I would not like to get into any individual entity or an individual auditor or anyone. We have good systems in place to be able to detect wherever possible, as early as possible, non-compliances, risks, and then we take preemptive as well as wherever required corrective action. Yeah.
Just to supplement on what Governor said in terms of both the questions, without getting into any particular entity, one is, of course, we never waste a good crisis. There will be learnings, and the supervisory tools will get better with each episode as they play out. It's our intention to minimize and, more importantly, ensure that the customers remain protected, even if accidents play out. So in each of these crises, we have taken adequate steps to ensure that the customer inconvenience is minimized and customer money is protected to the extent as much as possible, so that these episodes are dealt with independently. Coming to your question, essentially whenever such failures happen, it is part, while of course we take risk mitigants in terms of protecting the customers, on the other side we also direct the boards to ensure that proper forensic and accountability studies are held, and then whomsoever is accountable, whether they are internal, external or service providers, all of them will get covered in that, and actions will play out, and it will take its due course in terms of if there were any lapses, and they will be dealt with appropriately. I don't want to say in specific reference to any particular episode, but in every episode there will be, apart from the repair that gets carried out, there will also be an accountability which will follow. So we'll wait for that outcome. We don't need to speculate about that here. That will be.
Is it forensic and one more report?
For the accountability as
accountability to report.
Part of that, essentially to see whether there were any lapses, and if lapses, then who should be held accountable, is something which is part of every such episode that plays out. We are more concerned in terms of ensuring that the rectification is done as expeditiously as possible, and then there is no loss or inconvenience to the customers. These are our priorities essentially. That's something which we deal with on priority, then deal with fixing people.
Thank you, sir. Thank you, sir. Sir, with your kind permission, last 4 questions.
Yes.
Thank you, sir. Towards the right, sir, we'll have Mr. Piyush from Hindu Business Line. Oh, sorry, towards the left. Yeah.
Good afternoon, Governor, DGs. Thanks, Punit, sir. Sir, on gold loan, essentially, NBFCs have LTV of around 70 to 80%, and banks have around 60 to 70%. So when you say you will harmonize the norms, will you bring that to a common level? Separately, sir, you spoke about failures of the relative lesser number of failures of banks. In terms of NICB, you've given some relaxation as well. But have you assessed, sir, what is the actually, the fraud that happened, the amount, and will you actually let the bank to, accept customers again? I mean, will you remove the restriction, or the impact is so severe that you may not be able to do so? Thanks. Also, just a clarification, the accommodator stance, is it, is it unanimous, or there was a...
I mentioned it in my statement that it is unanimous.
There's no mention in the statement.
So it was unanimous. We missed that part. So it was unanimous. Certainly all the members voted, all the members decided unanimously. There was no vote on that, but all of them decided unanimously that they feel that going forward, the trajectory is actually an easing trajectory. LTV, you will soon, have the guidelines. Let's not speculate. You will soon have, the guidelines with respect to the gold loans. And what was your other question that you had?
NICB, sir, will you remove the
entities? We don't get into our effort. What is there? DG Swaminathan has already mentioned, what our effort is to protect, the consumers, the customers, to protect their interests. And going forward, see, how best we can salvage the situation and improve the situation. That's our effort for all entities. And similar will be the case, even in this case.
Thank you, sir. And now towards the right, Mr. Siddharth from Infosys Media.
Thank you, sir. Afternoon, Governor. The RBI has assumed an exchange rate of 86 per dollar for FY26 in its CPI GDP projections, and that there'll be no major structural policy changes. Are we to take from that the RBI expects very little pressure on the rupee from the ongoing tariff war, if you want to call it, and that India and the US may not be able to strike an agreement of any sort in this year? Second, on liquidity, why is the RBI still conducting VRRs when there is so much surplus liquidity, excess of almost 1.5 lakh crores? Is there any threshold? Is there any framework governing that? Or is it that you think the distribution is skewed and there's increased preference for holding on to liquidity from banks? Thank you.
Your second question first. Liquidity, the VRR, actually, it is one particular entity or a bank may need, liquidity while the whole system is in surplus. Of course, we would like, that the banks amongst themselves lend and borrow so that, this VRR, and I think in my last statement also, I made a mention of this, so that we don't have to do this. But still some banks prefer, to come to the Reserve Bank. And so that's why, we don't want to curtail that opportunity for them. So that's why, that is there. The second question, is a very difficult question, as to what, going forward the exchange rate is going to be, and how things are going to play out. I already mentioned, I really, we believe, that 80, so this is our baseline assumption, and we have said, that there are risks, on the both sides, and you have seen it. In the past 3-4 months also, rupee going, one end and then, going the other end. So you really don't know, how so uncertain that you really can't take a bet on what's going to happen in the near or in the, medium term.
All right, so that was the top brass at the Reserve Bank of India addressing the media after that monetary policy press conference. Apart from the policy decision, which was reiterated with the rationing, behind it, some of the important comments coming in from the Reserve Bank of India is one on the gold loans. Now, while the RBI did not divulge too many details, it said the draft guidelines on gold loans will be issued very shortly, and to wait for that. What the governor made very clear is that the RBI did not say anywhere in his statement that they will look to tighten the gold loan rules. They merely said they will harmonize it. In the governor's words in the press conference, he said, let's wait for the guidelines, which will be issued soon. To our mind, there is no tightening of gold loan rules. There is a rationalization of rules. He also said the harmonization is largely on the conduct side only. And these are issues that the RBI has previously highlighted even in its September 30th circular. On co-lending, again, more positive commentary coming in from the RBI governor as well as the deputy governor, where they said the idea very much is to expand the ecosystem whereby more partnerships can happen between NBFCs and bank and NBFCs, not limited to priority sector loans, but to other loans as well. The idea is for the customers to benefit from the lower cost of borrowing that larger entities like banks have. So those are some of the additional comments coming in from the governor. Also on IndusInd Bank, RBI refused to speak about individual entities, but they did indicate that they are awaiting, the results of the audit. And generally speaking, if there were follies, they will be taken into account, actions will be taken, and the interest really is to protect the customers. So those are some of the additional highlights coming in from the RBI press conference. We have to slip into a short break right now, but we will get back with a host of experts to decode this policy after this short break.
At Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sachin Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steel makers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC TV18, Mumbai. Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC TV18.
Celebrating 25 years of CNBC TV18.
Welcome back. We continue our coverage of the RBI's monetary policy, and we have a whole host of experts joining in again to help us decode the findings from this policy. Umesh Revankar, Executive VC, Shriram Finance; Neeraj Gambhir, Group Executive and Head of Treasury, Markets and Wholesale Banking Products at Axis Bank; Pranjal Bhandari, Chief India Economist at HSBC; and we also have Ashish Vaidya, the MD and Head of Treasury and Markets at DBS Bank of India, India with us. Gentlemen, Pranjal, thank you very much for your time here. Mr. Revankar, quickly to start with you, we heard more from the governor when it comes to gold loans. He said the idea is not to tighten the norms, the idea is to harmonize the norms, and of course highlighting some of the conduct-related concerns that the Reserve Bank of India has had. Now for Shriram Finance, if you could just tell us, your gold loan portfolio, of course, was about 6,000 odd crores or so, 2.5% of your AUM. What sort of changes are you expecting here, reading from what the governor has said?
No, the way we understand is for past 1 year, RBI has been talking about the gold loan, and the direction has already been given. So I think the direction is already in the. Everyone knows about the direction given by the RBI and is open. I don't really think there is significant. There will be a significant difference in what RBI has been talking for nearly 1 year and the new guidelines. It will be more to support and to encourage gold loan by the formal segment, because if you understand well, there is a large informal segment that has been involved in gold loan financing, and more and more formalizing is only going to help the borrower and to regulate the overall activity. So I think RBI is going to become more supportive of the formal segment, extending the gold loan with the banks and NBFC put together.
And Mr. Revankar, a quick word on the co-lending pact, which has now been extended to all regulated entities, which includes now NBFC to NBFCs and beyond just the priority sector. What sort of partnerships did you already have in space? How much additional credit do you think this could unlock? Because the AUM for co-lending isn't that large for the industry yet. Mr. Revankar?
Yeah. It's to me, okay. I thought this was
Yes.
No, I believe they're expanding the co-lending arrangement with beyond the PSL, because most of the co-lending arrangements was for acquiring PSL assets, and RBI is trying to expand it beyond the PSL and also other regulated entities to widen and deepen the credit from the bank. That is going to be very helpful. There will be more meaningful participation from all the regulated entities in deepening the credit.
All right. Well, Pranjul, your quick takeaways from the policy along expected lines, that 25 basis point cut and shift in stance. What is your base case? How many more rate cuts do you expect to see through the course of this cycle?
Yeah, thank you very much. So, look, I must say that this is as dovish as it can possibly get. Markets had so many expectations going into this policy, rate cut, liquidity assurance, stance change, forecast cuts, that I was actually getting nervous this morning, but it seems like the upside has delivered on all of those fronts. I think what really stood out for me was the assurance that came, with some of the policy actions. In the presser, we spoke about this 1% NDTL liquidity that will be there. I think that's sort of an important assurance that the market was looking for. And when you think about rates, I think the assurance came from the fact that, they've not just reduced forecasts, they've also said that the stance has changed to accommodative, and also said that this stance change is actually applicable only to rates and not to liquidity, which means that liquidity easing will not substitute rate cuts. So you will see both running parallelly, liquidity easing and also rate cuts. So given all of this and a very clear dovish bend, my sense is that, we're going to see 2 more rate cuts. I have one in June and the other in August. And that takes the policy rate to 5.5%, which is my forecast of neutral repo rate at this point of time. And then you recalibrate then. If summer monsoons and all of that have gone well, if growth is still very weak, maybe you can dip below neutral, but that's not my central forecast right now. My central forecast is 2 more rate cuts, taking the repo rate to 5.5%.
All right. And Neeraj Gambhir, what is your sense? You think the rates could dip below neutral, or is that not a very likely scenario?
No, I think given the forward-looking view that RBI has given on inflation, that we're probably close to 4% for this year on average basis, and certain quarters we're going to be below 4. I think it's fair to estimate that we'll have a policy rate settle down at somewhere close to 5.5% over the next 6 odd months or so. Provided a whole host of other things play out. I mean, there is a lot of uncertainty in the global environment, so we need to be mindful of that. But yes, I think 5.5% as the terminal repo rate for now is what seems like a kind of a fair assessment. I also feel that there is a lot that the Reserve Bank has done in terms of liquidity provision over the last month or so. Our statement has always been that we need a lot more on the liquidity side than on the rate side for the rates to be transmitted in the system. So far, there has not been much of a transmission because we were in the last month of the quarter. March usually is very tight. Now we are beginning to see some impact on the bulk deposit rates, on the money market rates. And I think with the clarity that the governor has given today on the forward-looking view of the policy by way of changing the policy stance, I think is also going to be very, very important for the markets in terms of transmitting these rates. So I feel that now the entire real rates in the economy will start adjusting towards the policy rate, or taking cue from the policy rate will start adjusting there. So I think that's where I see the impact of this policy.
And, quickly, Neeraj, just to follow up, even on the deposit front, you think now with the lending rates coming down, there is some headroom there for banks to readjust?
So it's very interesting that over the last 3 or 4 years, the bank's balance sheets have changed structurally. A large part of the balance sheet is now linked to external benchmark, which is repo in most of the bank's case. So it basically means that roughly 50% of your asset side reprices very, very quickly after the policy rate is changed. But the liability side, usually takes time to reprice. So banks obviously would want to have a faster repricing of the liability side. And as the signaling from the Reserve Bank and the liquidity provision from the Reserve Bank becomes very consistent and efficient, it's easier for the banks to do that. So I would expect, therefore, now the transmission to happen on the deposit rate side as well, both on the wholesale side as well as on the retail side. It could be a matter of a few weeks or maybe a month or so when you see a significant impact of this on the deposit side. Remember, policy rate has been cut by 50 basis points effectively now, but we haven't seen any change in the retail deposit rates. So I think there is a lot that needs to be done.
Yes, and that is a space we'll closely watch. Ashish, quickly, what were the hits and misses for you, and what are your expectations on the terminal rates?
So I think policy clearly on the expected lines and more or less in tune with what's globally happening in terms of demand supply dynamics. On a very broad basis, I would think that the way you should look at tariffs is a tax on consumption. So that basically means that the consumption or the biggest consumer in the world is actually going to cut down on consumption, which basically means structurally we are looking at lower consumption and accordingly accompanied by a lower rate scenario across the world where most of the central banks will actually pivot towards lower rates. I also have a thinking that while positive real rates and all the discussions that happened around it is in a phenomenal growth scenario, I think in a consumption starved scenario, we will somewhere in the world pivot towards neutral to a negative real rate scenario to manage the growth inflation dynamics. My sense would be obviously in the initial phase, like Pranjul mentioned, about 5.5. But I think that the overall scenario that is emerging for me is that the growth is going to take a massive hit across the world, and we are going to pivot towards a much lower sort of terminal rate. And I think likewise, I think the entire fixed income space will do quite okay and quite well over the next few quarters and years.
Okay. I guess bankers will be very happy. Thank you very much, gentlemen and Ritu, for continuing this conversation. I caught only the last part of it. But for me, one of the big takeaways from the press conference was the governor more or less admitting that their ballpark revenue, their ballpark liquidity surplus is 1% of NDTL. Neeraj, was the reading right? And does that give some sense of, security and confidence? How would you react to it?
No, this has been, I think, from the banking system and broader market, this has been a constant feedback to Reserve Bank that transmission does require surplus liquidity in the system, and the surplus liquidity has to be meaningful. Now, whether it's 1% of NDTL or 2% of NDTL, it's a matter of debate. But I think their acknowledgement of the fact that you need to now shift the system into surplus liquidity. Actually, the system was in surplus liquidity, overall durable liquidity. It moved into deficit on account of the FX intervention and related, effects. And now they have brought it back into surplus in some senses. I think we need to have this surplus sustained for a meaningful period of time to make sure that the transmission happens, to make sure that the bank deposit rates, come off, and associated, impact on the lending rate also happens. So I think that acknowledgement is certainly very, in some senses, assuring for the market.
Okay, now what difference does it make to you? Today, I thought the big takeaway from the press conference was, I will keep 2 lakh crore surplus. Did you get that feeling? And how will that change your behavior?
So there is a perceptible change in banks' behavior in terms of pricing of their liabilities, depending upon whether the banks on any given day are lenders to the Reserve Bank versus borrowers from the Reserve Bank. And it has been an experience over the last, I would say, 20, 30 years in this country that if you make the banking system surplus, i.e. banks are on a daily basis lending to the Reserve Bank instead of borrowing from Reserve Bank, the reprice of the liabilities happens much faster. The reprice on the asset side also happens much faster. So I think it's a function of how fast behaviorally how the transmission happens in the system, whether you're in surplus or in deficit. It is an established thing now. So I think Reserve Bank is acknowledging that. And I think if they do it, then we will see banks willing to cut rates on the deposit side and pass that off onto the asset side as well.
Okay, same question to you, Ashish. I thought he gave away that we will keep 2 lakh crore surplus or 1% of NDTL. What difference will that make to you?
No, absolutely. So I think the past few months' action of RBI in terms of the decisive way where they brought in liquidity and the fact that he has reiterated that even now, I think is a very clear indication. And like Neeraj mentioned, right, when you want to transmit the rate lower, you keep the system in surplus liquidity. And given the dynamics of most of the assets being priced off the repo rate, I think the transmission this time is going to be quite faster. Like you mentioned, last time it was about 6 to 9 months. I think this time it's going to be far quicker. And hence, I think everywhere it's going to become much more clearer. And the bankers will have a lot of confidence to reduce the deposit rates.
Pranjal, any takeaway in terms of whether they will reduce the growth even further and the therefore the natural real rate goes below 5.5? I think you were answering that to Ritu.
Yeah, so look, my sense is that this is not the last we are seeing of the GDP cut. If you look, it's only a 20 basis points GDP forecast cut they've done from 6.7 to 6.5% for FY26. If you look at the MPR, even for global growth, they've only brought it down from 3.2% to 3%. I think across the world, forecasters will be bringing down their growth forecast even more. And my sense is that in the next couple of meetings, once we know what are the tariff rates that are going to stick, my sense is RBI will actually lower its growth forecast for not just FY26, but also FY27. So from that perspective, yes, this is not the last word on growth. Even on inflation, I think the numbers obviously were heartening that they cut the growth forecast, but what was more heartening was the qualitative statement because, for the first time in many years, RBI saying that inflation is durably aligning with target of 4%. And they also said we are seeing a durable decline in food inflation. This durable decline is a word that was sort of not coming by for last many years. So I think from both, further growth forecast cuts, inflation qualitative assessment, my sense is that it's a very, very dovish policy at this point of time. But if your question is if they're going to cut a lot more, look, we already discussed this. I think they can cut twice more in June and August, taking the repo rate to 5.5, which is my estimate of neutral repo rate. And then at that point, you assess. If you think that growth is actually very weak, then of course you can dip below neutral. But that's not my central forecast right now. But I would say the risk is that they will cut even below 5.5%.
Okay, the risk is. Okay, that seemed to be my takeaway as well. Mr. Revankar, my only question to you is, with this, co-lending liberalized both in terms of entities and products, are you seeing a whole new world open out for you?
No, definitely yes, in the sense, but see, it will be very gradual. I don't think there will be a host of activity happening because co-lending is in the for last 4 to 5 years, and the speeding up of co-lending has happened gradually. So I think it will happen gradually. And definitely it will help more entities to get access to banks' credit. And that will help to deepen the credit into the various segments which are not covered right now. So it was mostly focused on PSL targets by the bank. I think it will get expanded. That's a good news. I think many of the smaller NBFCs now can be assured, and also the other entities can be assured of bank line of credit.
Okay, over to you, Ritu.
Well, broadly, I think that was the takeaway even from the Reserve Bank of India governor on co-lending and gold loans. Perhaps the markets overreacted a bit. The idea is more harmonization and rationalization. But quick word, Mr. Revankar, going ahead, life gets better. Your borrowing rates come down.
Definitely, yes. The transmission is yet to happen for the first 25 basis point cut. I think normally it takes 3 to 6 months to happen. And I think as we are looking forward for further cut, I think it will happen over the period. And we are happy if there is a 25 to 50 basis point cut so that we can pass on that benefit to the customers. And ultimately, the borrowers, especially middle class family borrowers who buy real estate property or to vehicles, they normally look at the interest rate because interest rate makes a decision for them. Their decision making depends upon the rate. And I think once that happens, I think there will be more demand for other goods because home is the first demand that creates a demand. Then other things will follow. So I think that's where I believe as the rate reduces, the more borrowing or more credit offtake will happen, and that should help to grow the credit.
Okay. Just a final question, Neeraj. When is the first deposit rate cut coming?
I'm hoping as soon as, yeah, of course. I'm hoping as soon as banks.
No. Hope is not a data point. I mean, what is your
I guess pretty soon. I would say pretty soon. In fact, if you ask me, the deposit rate cutting cycle has already started because we have seen in the bulk deposit market, the rates come down by approximately 50-60 basis points. I think the issue is that when banks find the confidence to do the retail deposit cuts.
Okay. All right, we'll have to leave it at that. I think the governor will be very happy to hear that. Ritu and our guests, thank you very much indeed for joining us and helping us understand the monetary policy better. It's a policy that seems to tick all the expectation boxes of the market in terms of rate cuts, stands, and from the press conference, an assurance of 1% of NDTL as liquidity, which means about 2 lakh crore of liquidity surplus was more or less assured. The more he spoke about it, the more it seemed that that's a given. On the gold loans, we should know shortly, but it does look like it may not be very penalizing. The word used was they are rationalizing rules. They didn't necessarily say they are tightening. So we will have to wait and hope. Thank you very much for joining us in this special broadcast on the monetary policy coming to you from the Reserve Bank of India headquarters. After a break, it will be back to news. Business Lunch will take the action forward.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown, and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour.
Stocks dip as a US tariff kicks in and US-China trade war escalates. IT, realty and metals are the big drags while FMCG ekes out gains. The Reserve Bank of India has cut the benchmark repo rate by 25 basis points to support growth. It also revises its stance to accommodative from neutral, signaling easing to stimulate growth. RBI marks down its growth projections for FY26 by 20 basis points to 6.5% from 6.7% in the light of global trade uncertainties. It, however, moderates its inflation expectations to 4% from 4.2% for this fiscal. RBI will release new draft rules for gold loan, but the governor clarifies that he did not indicate tighter norms, helping spooked stocks of lenders recover. The central bank is also opening a co-lending to all regulated entities and for all kinds of loans. US reciprocal tariffs kick in on April 9th with the levy of China's revised up to 104%. And while several trade partners are hopeful of striking deals with the United States to ease the levy's, risk of a standoff with China rises. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwal, and thank you so much for tuning in. Let's take a quick look at what the Indian markets are doing as of now. Nifty has seen some bit of a recovery from the day's lowest point, as of now trading with cuts of almost 0.5%. 22,400 is what it's managing to hold on to. Nifty Bank is also down 0.5% in trade, recovered from the day's lowest point. Among the sectors, FMCG as well as auto, that's managing to hold on to some bit of a gain in today's trading session. Top sectoral gain is there. FMCG up more than 1.6%, and auto is recovered from the day's low and now trading with gains of 0.5% in trade. IT is the top sectoral loser. We had a note that came in from Jefferies as well, where they've cut IT companies' targets by 5 to 35%. So keep an eye out on IT companies and where they are headed. Nifty IT as of now is down 1.8%. PSU Banks also seeing some bit of a brunt in today's trading session, down 1.8% in trade. But yes, that's what we are seeing in terms of the Indian markets. But let's look at the other global markets as well. European markets, they have opened up with cuts coming in the range of around 2 to 3% today is what we're watching out for. Whether you look at the FTSE, CAC or the DAX, all of them have opened up with some bit of a cut because of Trump's reciprocal tariffs that are taking effect today. Now, moving on to the Asian markets. On the other side, we've seen some of these Asian markets recover from the day's lowest point. So look at Hang Seng. Look at Shanghai, the Taiwan index also seeing some bit of a recovery coming in there. All these have seen a sharp recovery from the day's lowest point. US futures also are seeing a recovery following China's response to the tariffs that we're seeing. China's white paper states that US will not solve its own problems by raising tariffs and that China is willing to communicate with the United States on important issues in the economy and trade. China firmly opposes the unilateral bullying restrictive measures imposed by the United States and reiterated commitment to take measures to safeguard their legitimate rights and interests. And as this trade war tension is increasing and rising, especially between China and the United States, there are possibilities that China may hit back by selling US bonds. Prashant is joining in with us to now explain this further to us. Prashant?
Well, thanks very much for that. This is the question. Will China hit back at Trump's tariffs by pulling, as what one guest in the morning told us, the nuclear option? That is, selling US treasuries, US bonds basically. According to many, it's the most powerful weapon in China's arsenal. I mean, it's not new. Every time there are these tensions, back in 2018 also, I remember, this was put out there. Will China dump its holdings of US bonds? So let's just quickly take a look at this, right? Will China retaliate by selling US bonds or not? Not just with words or counter tariffs, but real pain in the bond market. Now, a move like this could serve as a powerful financial market deterrent, much like weakening of the yuan's daily fixing. I mean, the last fix, not today's, but yesterday's fix showed that China is willing to tolerate lower yuan to increase the competitiveness for its goods. It will also, a move like this, when you dump bonds, yields shoot up. It will raise the cost of funding for US government and, of course, send that message that don't take our restraint for granted. Such a move, and how big is China's holdings of US government bonds? Let's just take a quick look. The last number I have is this. China holds, and if you can move the graphic along, is about China's holding of US bonds is about $760 billion. That is, just pure China. There are some reports which suggest that, you have to take some proxy holdings, etc., and then it becomes over 1 trillion, but direct holding about $760 billion. This graphic is also interesting. China's ownership of US government bonds as a percentage of total foreign ownership of US treasuries is about 8.9% now. What was the peak? It was 28% in 2011. Remember, foreign investors own about 30% of the entire US debt. So, these are very large numbers, and that's the reason why this comes up off and on. Now, the point also is this. If China decides to sell, US, of course, hurts. But China also hurts, simply because it is one of the largest holders. A fire sale could devalue its own reserves. This is basically quite similar to how a large shareholder in a equity, in a company, when they sell stock, the stock can crash. Liquidity evaporates. There are not that many buyers. In this case, of course, if something like this happens, the Fed will have to step in, open up QE and suck in all these extra bonds which are coming in and hand over dollars to China. That's, of course, in the extreme kind of scenario. One line of thinking is also this. Why sell? According to the numbers that I have, 60% of foreign holdings of US government bonds are in between the 0 to 5 year tenor. So they're not very long tenure bonds. They're between 0 to 5, max 5, 60%. And I'm assuming China's numbers are also the same. Simply run these bonds down. Don't reinvest when they come up for maturity. Don't buy more. So, your exposure automatically reduces. In any case, China's reserves, the trend there has seen one clear thing. They're buying more gold and they are buying lesser and lesser US government bonds. So this has anyway been happening over the years. Now, while we're only talking about China here, the bigger longer term question is this. Will we see overall foreign demand for US treasuries also more permanently impacted, caused by all this nastiness, for the lack of a better word, on tariffs and trade? Coming back to China, the Chinese central bank, the PBOC, the People's Bank of China, has a longer-term goal which is very public. They want to diversify their reserves, move away from US dollar and reallocate into other G10 currencies. That pivot also now makes more fundamental sense because, the rate differential between US and G10 countries has been narrowing. So there is a fundamental aspect to that as well, which we need to take into account. Now, that's basically what we have. We will have to watch this space closely. China doesn't have to sell substantial portion of US bonds. A small but chunky sale could make the point to Trump and his advisors that we will match you in escalating this trade war step by step. Back to you.
Okay, Prashant, thank you so much for that. An interesting update coming in there. One stock I do want to highlight right now is Muthoot Finance. Let's pull that up because that's recovered from the day's lowest point after, on the loan guidelines coming in and more clarity coming in that, yes, he's not said that there would be negative comments or tightening in terms of those gold loans. So because of that government, RBI governor's commentary coming in on that front, we have seen that recovery coming in from the day's lowest point as of now for Muthoot Finance. So interesting to watch out for that one. And US futures, let's talk about that as well. US futures, that is seen a bit of a recovery coming in this trading session as well. As of now, what we're seeing, look at the Dow futures. 3/10, 4/10 of an uptake, S&P futures, all of them are trading with gains, right? So futures, US futures indicating that bit of a positive start coming in there, and that's interesting to watch out for. Now, obviously, that commentary that's coming from China and which we're talking about as well is something that's a factor that's coming into play as well. So yes, that's what we're watching out for in today's trading session. All these US futures indices are seeing a recovery. We're seeing that some bit of a recovery came in for the Indian market as well. But that's all the time we have on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Up next, you have Midcap Radar.
On YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Esteemed guests.
Good afternoon. You're watching Midcap Radar live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Patakia. With me, as always, is Vivek Iyer. Unimpressed are the markets. Besides the rate cut, the change in stance, no recovery seen from lower levels. A slight recovery, but still significantly in the red is the index as well. The Nifty Bank too still in the red. The Dow futures, though, have recovered substantially from the lows. They were down 900 at one point and now trading in the positive territory after China urged dialogue to resolve the tariff issues. But the big event of the focus point of at the start of the show today is the fact that Indigo has announced a common loyalty program between Indigo Blue Chip and Accor Life Limitless members. Now, Interglobe Group has partnered with Accor to create a fast-growing hospitality enterprise. Mangalam caught up with Sebastian Bazin, the group chairman and CEO of Accor, and Rahul Bhatia, the MD at Interglobe Enterprises, to discuss about the tie-up. He began by asking about how hospitality and industry is managing demand amidst the trade uncertainties around the world. Listen in.
Well, there's certainly no uncertainty when it comes to India. I can tell you, and I'm probably going to be right for the next 20 years, you're going to have a fast-growing travel hospitality market being developed in India, only because you are 30 years late. And you finally got today the infrastructures, the financial industry, the telecom industry, the travel industry actually who being built up for the last 10 years. And it's just time now to scale it, to go faster, but you have to do it in a local way, unified forces, agility, focus, but I can guarantee you it's going to be probably maybe a double-digit growth demand for the next 10 years to go, domestically and internationally for Indian traveling abroad.
All right, double-digit demand for Indian hospitality industry for the next 10 years. Do you concur that the Indian hospitality, travel and hotel industry is fairly resilient to any sort of global shocks?
Well, in many ways, I think Interglobe demonstrates that it's long on India, and we are certainly very long on Accor. And to your earlier point, this arrangement has got nothing to do with what may happen in the short term. In the long term, the growth in India is only going to go one way.
All right, so in that case, if you could just, let's talk about this arrangement itself. You have been partners for the last 20 years. Now, with this formalized commitment, if you could give us a sense of what's the goal here? What's the investment that you are planning to make? And does it have anything to do with a listed Indigo player when it comes to, you investing in a business like this, Rahul?
So we had several moving parts in our relationship over the years. We had a development company, we had a management company, we had a separate investment in a portfolio alongside GIC, and all of that is getting consolidated under one unified business, which will have a clear limit of where it needs to go. Insofar as Indigo is concerned, Indigo has nothing to do with this arrangement. This is purely something between Interglobe and Accor.
And the funding for this, what are the kind of investments that you have earmarked?
Well, we've put hundreds of millions over the last 15 years together. So what we decided that, again, there's so many interests from so many real estate developers locally in India who really want to take advantage of the brand, the distribution, and the demand. I guess by putting all the operational technology together, the management, the leadership, the development, the governance, don't you worry, there's a lot of interested party who wants basically to take the benefit of what we're putting together. They will invest, each of them separately, different brand experience, all the money needed, and if needs be, there's probably going to be a few occasions where we're going to be deciding to do it ourselves. But it's really a question of multiplying the growth that we've begun during the last 15 years 5 times faster. And we could only do this if we simplify ourselves in terms of government and leadership, and that's what we're being announcing today.
All right, and tell us a little about the announcement with Tribo as well. You guys have made an investment in Tribo to be their largest shareholder. Together, you will be growing. Give us a sense of that.
Sebastian, you want to take it?
Yeah, Tribo has been actually created by Sid Gupta and 2 of his co-founders. It is today recognized as the best, fastest travel technology software existing. And he's been connecting within almost like 5 hours one hotel, and he's going from today 850 hotels under his tutorship. So we've been watching them for the last 5 years. We've been investing 5 years ago when it was like a venture capital investment. And now we realize they are the best equipped to do customer reservation system and property management system together. They are good, they are fast, they are young, they are advanced in technology. It's super important for both of us to connect Tribo technology to our own basically governance and development. And we also trusting Tribo to go faster on 2 brands where they're going to have a master franchise for Ibis and Mercure. So it's kind of actually a dual track, master franchise for 2 brands and technology provider for CRS.
Could you give us some numbers then? You have about 70 properties in India as of now. Under this partnership, what is it that you're targeting in the very near term, the medium and long term?
Well, it took us 18 years to go to 100 properties, 70 open, 40 to be open. That's great, but that's not good enough. So we promised the market we're going to go, as of today, 5 times faster, because we aim to have 300 properties in less than 5 years from today. So we're going to go from 5 or 6 opening a year probably to 25 to 35 opening per year. So it's we know what we're actually undertaking, and I hope it's going to be better in the years to come. We in France have 2,000 hotels, and France is the size of less than 5% of India. So somebody in India will have well over 1,000 hotels in the near future. We just want to be one of them, so one of the leaders in this country.
What are the synergies that you see between the Interglobe Group and the Accor Group? If you could give us a sense on how y'all would, allow them to grow at 5 times the pace, or enable them to grow at 5 times the pace that they've been growing so far.
So operationally, Accor is a world-class operation. They understand how to operate and manage hotels. We think we understand India and what it takes to do business in the country. And I think that complementarity will go a long way between the two of us. The other thing that you have to also take into account is the relationship between the two companies is time-tested. We've been together for just over 20 years. And nothing can stand the test of time if it was not built on respect for each other, a common shared vision, and what we believe we can do going forward. So that's the bedrock of the future, and we are terribly excited about it.
You're a rare voice, and we speak through you for the industry as well, and this be the hospitality industry as well as the aviation industry. From where you see things as right now, there is a fair amount of promise, but there are a lot of challenges as well. Where do you think are the challenges, and what are you doing to overcome them in both aviation and hospitality?
So my simple view on this is the greater the complexity, the greater is the opportunity. And if you can navigate through that complexity and essentially create a moat for yourself, it'll see you through for a very long period of time. And we believe that in the hospitality space, what we are embarking on, a renewed vow between Accor and Interglobe, I think by 2030, you would have actually created a moat, and then the flywheel just keeps running.
Well, a very interesting conversation there with the top honchos of Indigo. But we'll now slip into a short break. Shweta Daptardar from Elara Securities joins us on the other side to discuss RBI's move to review guidelines on gold loans.
Above all today, we express our deepest gratitude to our visionary Prime Minister, Shri Narendra Bhai Modi ji. Pandit Deen Dayal Energy University owes its very birth to his extraordinary vision. All of you are benefiting from what Narendra Bhai thought in the early 2000s. And when he called me and said in 2005 that we have to build one of the finest institutions in Gujarat, right? And that is what we have achieved from 2007 onwards. So we will always be grateful to our Prime Minister. Long before he became Prime Minister, he foresaw that India needed Atmanirbharta in energy. Over 20 years ago, he told me he wanted Gujarat to lead the nation in energy and energy products. He also told me that Gujarat should take the lead in cultivating world-class human resources needed to achieve India's clean energy ambition. That is how he helped establish this pioneering university. Friends, there are many things that we learn from our beloved Prime Minister. Let me mention just 2 lessons here for all of us. 1, Modi ji never lets a good idea go to waste. His Man Ki Baat inevitably becomes his Man Ka Sankalp. His Sankalp is always Vajra Sankalp. His determination is as hard as a diamond. He does not rest with simply making a Sankalp. He knows how to turn his Sankalp into success. In the last 10 years, the world has seen how he especially chooses impossible-looking tasks and transforms them into reality. This, for all of us, is lesson number 1. Lesson number 2 is about his boundless energy. Narendra Bhai Modi's name stands for Anant Shakti, infinite energy. Since PDEU is an energy-focused university, all of us should learn to be as energetic as our Prime Minister. People often ask the question, where does Modi ji take rest? Or does he rest at all? I can tell you that I know the answer to this question. The answer lies in what Pandit Deen Dayal Upadhyay ji has said, who is the founder and whose name this university bears, has said about rest or Vishranti. He has said, Kaam mein badlav hi Vishranti hai. Change of work is itself rest. And I think this is our Prime Minister's motto. This should be our motto, dear students, also. Therefore, when we think about these two lessons,
Welcome back to Midcap Radar. Well, RBI is set to release new draft rules for gold loans. The RBI governor has since clarified that he did not indicate tighter norms helping spook stocks of gold loan lenders recover. The central bank is also opening up co-lending to all regulated entities and for all kinds of loans. To discuss more on this, we are now joined by Shweta Daptardar, Vice President of Diversified Financials at Elara Securities. Thank you so much, Shweta, for joining us. First up, we have to talk about the gold loan segment. What do you make of the comments? Have you done any sensitivity analysis of what could be the likely comments, especially if there is any tweaking as far as LTV norms are concerned? And what kind of impact do you see on gold loan lenders?
Yeah, hello, good afternoon. So we have analyzed the impact of the implications of RBI guidelines. But the good part is, like you also rightly mentioned, RBI has clarified that they would be just maintaining rationalization of the norms, and there is no tightening that we can be expecting. So point number 1, something which RBI had bigger concerns about is the LTVs, the on-book LTVs and the exit LTVs exceeding the origination LTVs, leading to higher over-indebtedness at the borrower level. So I think, but if you go by the norms, it has always been 75% LTV for all regulated entities. But due to definitely the underlying price value inflation, the exit LTVs continue to remain on the higher side. So I think we are expecting largely RBI giving a clarification on the same. But if you look at the stocks per se, so there have been regulatory lapses by the end of few entities. However, the market leader, the topmost player in the space, that is Muthoot Finance, and we also pulled out the con call transcripts which clearly highlighted, because we were unable to reach to the management. So Muthoot time and again has clearly highlighted that they have been largely in adherence with most of the norms. And given the fact that stock, despite being pretty sacrosanct, has seen correction today, and in fact it also recovered in the second half. But having said that, we continue to maintain a positive stance on the market leader and definitely would look at the guidelines whenever the comprehension comes through.
Shweta, good afternoon. Thank you for joining in. What may be tightening to the street may not be tightening for the RBI governor, right? That line of tightening may be subjective, but depending on what the draft guidelines come in, right? But if at all there are some kind of draft guidelines that go against these gold financiers, who do you think among the three of them is most at risk? Because Muthoot has the highest gold loan AUM, almost all of its book is on gold loans. So who is the most at risk here?
Yeah, so like I already mentioned, Muthoot largely in our assessment is much more
in line or aligning its practices in line with regulatory requirements. Manappuram Finance and IFL Finance, which are other two key players in the space. So Manappuram has almost 50% of its book on the gold lending side, whereas IFL is around 21 odd percent. So these are the other two key players in the space. And time and again, we have already seen certain regulatory hurdles encompassing the business impediments for both of these names. So definitely, whenever the guidelines would come through, we would sort of articulate for all the players, but we believe it more so might impact the other two key names.
Okay. Shweta, let's move on from gold loan financials and we'll await what are the exact draft regulations that do come about. We also want to talk to you about NBFCs at large. Are you a little surprised at the kind of sell-off that NBFCs have seen today, given the fact that the rate cut is generally seen quite positively, especially in the near term for NBFCs? Secondly, your view as far as expansion of co-lending agreements are concerned between NBFC and banks. Do you see that as a material positive? And lastly, if you do have a view on the likelihood that there could be an increase as far as the 1 lakh or 2 lakh rupee limit is concerned between customers as well as merchants, your view?
Yes, so answering to your first question, NBFCs definitely surprisingly saw a correction today. But we have to also understand the fact that in anticipation of rate cuts, most of the movement have already happened as far as the entire NBFC pack is concerned. We certainly believe more than rate cuts, what would drive the credit offtake or whether what would push the credit offtake for NBFCs has more to do with the liquidity scenario, how the liquidity scenario unfolds, and the boost which RBI is offering time and again on that front. So we also put out in our preview note, which we released recently, that the spreads between the corporate bond yields as well as the 10-year GSEC yields have been narrowing, putting forth a very favorable environment, a very favorable funding environment for NBFCs. So I think that is something which we are closely tracking. Your second question it was in terms of gold lending norms. So like I said, while it's very clear now that the comprehensive nature of the gold lending norms would be more to do with rationalization and harmonization than any changes in particular, we certainly believe most of the anomalies now would be corrected as far as both banks and NBFCs are concerned. We still maintain our positive stance on the entire gold lending space. As far as the third question is concerned, so in terms of the increase in limit, see, I think where the RBI concerns are emanating from is more to do with the fintech-led arrangements as far as the co-lending arrangements are concerned. So time and again, a larger part of fintech loans have happened through unsecured personal loans, which have grown at almost 50 to 60% rate year-on-year basis in past 1.5 to 2 years. So
Shweta, if I could just interrupt,
risk, which largely emanates from this particular channel, I think that's where the concern is coming from the RBI front.
Shweta, do you have a view on the development at HUDCO that's come about today? I understand you do have coverage on HUDCO. Have you had a chance to look at the development? And very quickly, if you could give us the implications.
Yes, so it's a very positive implication for HUDCO in terms of net interest margins getting positively boosted now with this arrangement. But it's a long way to go. But the good part is HUDCO has now joined the bandwagon of PFC, REC, who are amongst very few companies who are now eligible to raise money at as low as anywhere between 4.5%, 5.5% interest rates through this inclusion of 54 EC bonds. But we have to also acknowledge the fact that this process is slightly long drawn. So by the end of FY26, you might not see a very strong implication on margins due to this arrangement, but definitely going forward, FY27, slowly and gradually, as the 54 EC quantum increases for HUDCO, more and more positives to flow in terms of margins.
All right, Shweta, thank you so much for spending time and joining us today on this conversation on a whole host of subjects with regards to the announcements made in the RBI policy as well as the developments on HUDCO. Take a short break, more on the markets on the other side. Stay tuned.
ideas into action and how to work tirelessly, we cannot escape the conclusion that Narendra Modi ji is not only India's Pradhan Mantri, but for us and this university, he is our Gurudev, our respected teacher, and we will follow his learnings.
आज जैन समाज का एक कार्यक्रम था बड़ौत में सीपीएल स्कूल में, जो पिछले 30 सालों से हर साल होता है। और यहाँ पे एक वुडन स्ट्रक्चर था जो कोलैप्स हो गया और अराउंड 40 लोग जो हैं वो घायल हुए हैं और उन सभी को 108 की एम्बुलेंस समय वहाँ पर मौके पर पहुँच गई थी, सबको हॉस्पिटल पहुँचा दिया गया है और 20 लोगों का प्रथम उपचार करके उनको घर भेज दिया गया है। बाकी 20 लोगों का उपचार अभी चल रहा है।
We must aim higher. Within a couple of years, India will emerge as the third largest economy in the world. No power on earth can stop India's growth trajectory. I can clearly foresee that India will become the most prosperous nation in the world before the end of this century. But India, with other large economies, also has a big responsibility. We must not allow economic growth endanger planet Earth and further worsen the climate crisis. Therefore, the transition from fossil fuels to clean and green energy has to be accelerated. I am supremely confident that green technologies and green enterprises can reverse the ecological degradation and indeed make our planet more beautiful, more
30 points lower on the index, the broader markets too in the red, but the bigger trigger is the Dow futures that are seeing some very, very wild swings right now. At one moment they were positive of 50 points, now they are down 200. So keep an eye out on the Dow futures and the implications that we can see later this evening. But with that, we call time on this edition of Midcap Radar. Vivek and I take your leave from the team that put this show together. Thank you so much for watching. Your stocks on the other side.
for future generations. Our Prime Minister wants India to become the greenest nation in the world. For this purpose, India is also transforming itself into a deep tech nation with advanced manufacturing capabilities. This is the context in which PDEU should see its future role and responsibility. My dear PDEU family, therefore, here are my 3 expectations from all of you in the PDEU family. My first expectation, PDEU should further improve the quality of research and make it application-driven. We should specially focus on newer areas like bioenergy, which have the potential to help our farmers and boost employment opportunities. My second expectation, we should simultaneously increase our internal strengths and also forge national and global collaborations so as to enhance our leading position in research and academics. My third expectation, the intersection of green energy, green materials, and artificial intelligence is going to shape the future of humanity. I would like PDEU to gain a leading position in this synergy. Talking of artificial intelligence, I have a piece of advice to our young students. You must be good at using AI as a tool of learning, but do not give up your own critical thinking. चैट जीपीटी का ज़रूर से इस्तेमाल करो, लेकिन याद रखो, आर्टिफिशियल बुद्धि से नहीं, खुद की बुद्धि से हम आगे बढ़ेंगे और आप आगे बढ़ सकते हैं.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. A quick look at what the market is doing as of now. We're seeing that the Nifty has recovered a bit from the day's lowest point. So yes, as of now, trading with cuts of almost 0.6%, some bit of a decline that we've seen in the last few minutes, but still off the day's lowest point is as of now what the Nifty is holding on to, just around the 22,400 mark. So keep an eye out on that. Let's look at the Nifty Bank and what's that doing in today's trading session as well. It was down almost 0.6% when I last checked. As of now, also almost those levels of the day's lowest point. Top sectoral gainers, we do have the FMCG and the auto pack that is managing to hold on to good gains. So both these are the top sectoral gainers, while in terms of losers, we do have the IT as well as the banking side. PSU banks specifically are seeing some bit of a pressure specifically in today's trading session. Do not forget pharma. That also sees cuts of more than 1% in this today's trading session, waiting out for more clarity in terms of Trump tariff and where that is headed as well is something that we'll keep a close eye on. As of now, Nifty Pharma also down 1.6% in today's trade. Yes, that's how the market setup is looking like as of now. But this is a show where we solve all your stock-related queries, and that is what we'll be doing. So today, our experts are Asta Jain, research analyst at Hem Securities, and Saumil Mehta, head of alternate research at Capital Market Strategy, to solve all those doubts that you have sent us. Saumil, Asta, good afternoon. afternoon, and thank you so much for joining us, as always, on your stocks. We'll get started with the queries for today, right? And this first query we have is coming in on Titan. Rishabh Nair is writing to us from Kerala. They're holding 30 shares of Titan. This is at a price of 2,700 rupees. So they're making a profit on this one. The stock is at around 3,180 rupees per share as of now. Wants to know whether he should continue to hold this, sell, or book his profits. Asta, first, let me take this to you, because we did have those updates that came in from Titan as well. Quarterly updates doesn't seem bad, right? They were saying about growth being supported by the surge in gold prices. So where are we seeing Titan headed from here on, and what should the viewer do?
Hi, good afternoon to all of you. See, talking about this counter, I think one should remain invested in this stock with a price target at the immediate level to be 3250 to 3300. Now, talking about the fundamentals of the counter, yes, business updates are looking very promising. And in fact, management has maintained its EBIT guidance in their con call after the Q3 FY25 result declaration. So we have found that also very attractive. In fact, the revenue growth was very strong in Q3 FY25. So looking after all these factors, I think Titan is well poised to show more upside from here. 3250 to 3300 are the immediate targets which we are attributing to this counter and recommending a hold.
Okay, a hold is what you're recommending for Titan as of now. Somil, good afternoon. And on the charts, Titan, what are we watching out for, right? Last 6 months, very muted performance is what we've seen coming in. So now what are we watching out for? Or rally is what we could see coming in?
I think since the start of 2024, the stock has been trending in a very broad range. The higher end is 3,900 and the lower end is around 3,000 levels. This stock has taken support multiple times around this lower end, which is 3,000 levels, and it has again started moving outside. It is already closing about 20 and 40 daily moving average. I think this is a positive sign for this stock, and this is the first time it is happening after a long time, as in after probably 2 or 3 weeks now. So it's a positive sign. I'll be expecting a short-term target of 33.50, and the stop loss would be around 3070.
Okay, so keep an eye on those levels over there for Titan. Let's move on to the next query for today. We have Jagriti Chauhan, who's writing to us from Chandigarh. She's holding 30 shares of Bajaj Auto. This is at a price of 4,500 rupees per share. So she's making a good amount of profits on this one, right? 7,500 around that level is what the stock is trading at. Wants to know if she should continue to stay invested in this one or book her profits. Bajaj Auto, what are they looking like in terms of fundamentals? Asa?
Yes, so first of all, want to give the recommendation, which is hold with a price target of 7,900. Now, talking about this counter, we have seen the results in the quarter gone by were not very attractive, and there were reasons behind it. The product mix was not good, and now they are focusing on the 125cc segment, which is a high margin segment for the company. So I think that can act as a cushion for this counter as of now. If I talk about the fundamentals, and our idea is, in fact, the domestic industry is also poised to grow 6 to 7% from here, which can again benefit this counter. So overall, because now I don't want to comment on exports, although management was very much optimistic in their con call regarding the exports. But right now, looking after the market condition, I think domestic market conditions are looking better than export. And in fact, their focus on high margin segment will definitely yield good results to them. So recommending a hold with a price target of 7,900.
Recommending a hold and a price target of 7,900 rupees is what you're saying. March sales numbers also were largely in line. Not much excitement, but they were in line with the street expectations. But Somil, on the charts and technicals, right, what are we watching out for in terms of Bajaj Auto? When you're looking at it for 2025, the stock is seeing cuts of almost 10 to 13%. YTD is what I'm looking at. Underperformed its peers. So what can we watch out for? Do we expect, are you also expecting a run up now coming in, given that last 6-7 months we've seen a sharp correction?
This stock is struggling to go above 40 daily moving average, which is very negative for the stock. It's been last 6 months that it's been struggling to go above 40 daily moving average. There was only one time when it closed above 40 daily moving average, and since then it has been just going down, making low tops, low bottom, trading below all the averages. The momentum indicator on the higher time frame are on the sell side still I think the lows which you've made around 7,100, it will be retested again. And I think my medium-term target would be around 7,000 levels. On the higher side, the stop loss or the resistance would be around 7,790 and 8,090.
Okay. Keep an eye out over the levels over there for Bajaj Auto. Let's move on to the next query. This is coming from Mayank Srivastav, writing to us from New Delhi. He's holding 50 shares of Delivery at a price of 300 rupees per share. He's a long-term investor and wants to know whether he should continue to hold or book out of this one. He's making some bit of a loss here. Asta Delivery, what is the view on the fundamentals? What are you watching out for here?
So I think with the recent acquisition of Ecom Express, I think this company is now well placed to cater the major market share in the 3PL segment. So I think that will really help the company, because I think if I include these both counters, that is Ecom Express as well as Delivery, so they both collectively target around 97% of PIN codes in India. So again, a very strong point for Delivery to show good performance going ahead. Maybe the financial performance will show the results after 1 or 2 quarters, but we are quite optimistic on this counter. So I am recommending a hold on this counter. Immediate price target which I would like to give is around 270 to 280. Short-term targets or medium-term targets can be set at around those levels, but the long-term targets are around 300. Yes.
Okay. Long-term targets 300 for Delivery. So yes, keep an eye out on that. That's almost the buying price of the viewer. So yes, maybe sell at what you bought. But on the technicals, Somil, what are you watching out for? Do you expect that the viewer will be able to make above the 300 anytime in the medium to long term?
It doesn't look like it is. It's been taking resistance at 20 and 40 daily moving average every time it bounces back. Right now, it has made a small flag pattern. It has already broken down. The daily momentum indicator has given a fresh sell signal. I don't think so. Anything positive in the very short term. Short term, I'll be expecting a target of around 220, 210 probably. And on the higher side, the resistance, one single resistance, which will be very crucial, is 277. If it goes about 277, then probably things can change. But at the moment, sell on rise would be the strategy.
Okay. Sell on rise is the strategy for Delivery, coming in from Somil as well. Next query for today, we have Nikhil Mehra, who's writing to us from Noida. 2,500 shares of IOB is what they're holding, and this is at a price of 50 rupees per share. Wants to know the long-term story on the stock. IOB as a bet, Asta, that's the one to hold on, or maybe look at some other banks. What's your view coming in for this one?
So I would like to prefer BOB over IOB, that is Bank of Baroda. I think in the public sector banking space, this bank is looking better in the stock performance wise if I compare it with the IOB. So there are two choices, either to exit from this counter and make a fresh entry into BOB, or to remain partially invested in this counter and make partial exit by investing in BOB. So this is what we are recommending right now. So partially exit and partially switch towards BOB.
Okay, and your view on IOB, Somil?
It's negative, definitely. My next target on this stock for in the medium term outlook would be around 29 levels. I would agree with Asta that the viewer should shift to BOB or probably Union Bank. Union Bank is a better bet. Federal Bank is also a good one. So my suggestion would be to exit.
Okay, suggestion is to exit from IOB from both our experts for today. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. After the break, we'll be taking more of your stock-related queries, so stay tuned in. Welcome back. You're watching Your Stocks on CNBC TV18. Now let's move on to the next query for today. This is on Industars. We have Rahul Malhotra, who's writing to us from New Delhi. He's holding 80 shares of Industars. It's at a price of 220 rupees per share. Wants to know the prospect of his holdings. And Asta, obviously we have seen those recent developments come in for Vodafone Idea as well. And a lot of people are asking now on Industars. So what should they now be doing with Industars, and where do you see this headed from here on?
So Indus Towers is looking very, very strong to us. First of all, want to give buy as well as hold, both the recommendation for this counter, and we are setting the price target of around 410 at the initial level. Talking about the fundamentals of this counter, with the strong tower addition and the network expansion, I think this company has got very strong towers count now, and that will really help the company in posting very good set of numbers going ahead. So this counter is one of the counter which we are recommending to our clients as well at this point of the time. Indus Tower is looking a good buying opportunity at current level. So recommending a hold as well as buy with a price target of 410.
Okay, keep an eye out. 410 is the target, is what Asta has mentioned. Somil, what are you keeping an eye out on in terms of targets for Industars? Latest developments coming in there, positive signs coming in for the company as well?
Definitely positive in the short term and the medium term. It's trading above all the averages, above 200 daily moving average as well. So making high tops, high bottoms. So my targets on this stock would be around 412 for now in the medium term outlook. If it closes above 412, then probably it would go towards 500 levels, so 466 plus levels. But please keep a very strict stop loss around 336 in the medium term outlook for a positional call. 336 would be a very crucial support. If it breaks down, then it can give us very sharp declines because there is a small consolidation going on. If this consolidation breaks on the downside, then the next leg would be very sharp.
Okay, surely keeping an eye out on those levels over there for the stock. But let's move on to the next query now for today. This is coming actually two stocks that the viewer wants to know about, Dixon as well as Sagility. Munira Julu, who is writing to us from Tamil Nadu, she wants to know whether he should invest in Dixon Tech and Sagility. He's not got any investments as of now here, long-term investor. Asta, your view coming in first on Dixon as well as Sagility on the fundamentals. What are you watching out for here? EMS players and specifically Dixon in the recent time has seen a bit of a fall coming in. Not much of excitement there in terms of the run-up that we've seen in the past few years, right? So what should one be doing with both these stocks? Should they look to invest?
For Sagility, I would like to suggest just wait for some more time. Now, the reason is we know that this company provides technology-enabled solutions to the US healthcare industry, and the kind of news flow is going on, the world markets are poised on. I think right now, I think it is not a good time to enter into this counter. Let this counter stabilize more, maybe at around the level of 35 to 33. We can see some sort of stability. And then one should make a fresh entry because I think news flow will definitely impact this counter going ahead also. So rather than investing at this moment of a time, better to invest at the lower levels of around 33 to 35. Now talking about Dixon Tech in any ways is looking good to us, and we are recommending because we are very much positive on the company's prospects, and we are recommending a hold on this counter. Initial price target is we are setting is at around 14,000 level, not a bigger targets we are giving for this counter, looking after the market conditions as of now.
Okay, and Somil, your view on both these stocks for the long term?
Dixon, I like Dixon. It is forming a ending diagonal pattern. It may consolidate in this area for some time between 12,000 and 13,500. However, this ending diagonal pattern, I think, will break out on the upside because the momentum indicator on the higher time frame has positive divergence, and I think on the upside I'll be at least targeting 15,700 and above that 17,600. So these are the levels I'll be looking out for. However, the stop loss should be around 12,000 levels.
Okay, keep an eye out on those levels over there for Dixon Technologies. Let's move on to the next query, Tata Tech. Now, Mohammed Ganesh, who's writing to us from Kerala. 20 shares of Tata Technologies, holding at a price of 1,000 rupees per share, wants to know the right time to exit the stock as well, right? Because right now he's making a loss here. And Tata Technologies, this also is a query that's coming up a lot. It's not done anything since specifically after its IPO. So what should one be doing now with Tata Technologies? Asta, on the fundamentals, if they're making such a big loss, what should they watch out for?
So I think one can wait at least for some more time, because in Q3 FY25 the performance was good result-wise, and now we are expecting that more momentum in the OEM space, especially in the automotive and aerospace. So that will help the company in coming months. So rather than making losses by exiting this counter, it's better to wait for some more time, let the results come in, and we are quite optimistic on that front as well. So recommending a hold with the price target at the initial level of around 720 to 730 odd levels.
Okay, and Tata Tech on the technicals, what's your view?
I think a very weak stock, never closed above 40 daily moving average, which is a very, very negative sign for the stock. Till the time it does not start making those high tops, high bottom above all the averages, which is 20 and 40, I think if the stock closes above 735, and probably that will be the time to buy into the stock. But at this point of time, my suggestion would be to exit or sell the stock.
Okay, let's move on to the next query. Bharat Forge, this is the stock that we'll talk about. Ashish Sen has written to us from New Delhi. 30 shares of Bharat Forge, price is 600 rupees per share. What he's talking about, and he's concerned about tariff issues coming into play, right? Trump tariffs, the impact on the auto sector. So what should he do now with Bharat Forge, and how should he play the story? Asta, your view first.
I think Bharat Forge is a good candidate to remain invested in for the price target of 1,050, 1,080. Now, talking about this counter, we are seeing that there is a good order intake in the defense sector that will help this company to show good performance in the coming quarters. So we are positive on this counter, and we are recommending a hold on this counter with a price target of 1,050 to 1,080 at the initial levels.
Okay, and Bharat Forge on the technicals, what are you watching out for? Is there some worry because of these Trump tariffs? And does it make sense to just exit this one, maybe look at something else?
I think at this point of time, in the very, very short term, I'll be looking to buy this stock for a small bounce till 1,050 levels. But I think in the medium term outlook, it is looking negative because it's been making low top, slow bottom on the weekly charts as well. Momentum indicator in the higher degrees on the sell side. So if it goes above 1,050 or 1,100, I think that will be the time to buy. But at this point of time, in the medium term outlook, you can exit this stock and probably wait for a reversal sign or a close above crucial averages.
Okay, thank you so much for that view coming in there as well, Somil. But on that note, we'll wind down this edition of Your Stocks on CNBC TV18. So thank you so much, Somil, as well as Asta, for joining in with us. And thank you so much, viewers, for sending us your queries. But with that, we'll close this. And up next, you're closing well.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
The Hang Seng, that's down almost 2.9%, almost 3% in trade. Taiwan index, that's down 1.75%.
Equity markets sold off and the close finally. S&P was down about 1.6, NASDAQ down about 2% or so.
I think it's very difficult for both parties to walk back from it.
The Nifty, 22,400. So it's 170 odd points down. The Sensex is down 500, 73,726.
I think most of the companies will refrain from giving guidance in this uncertain environment
to reduce the policy repo rate by 25 basis points to 6% with immediate effect.
The big overarching headline is the Trump sweeping tariffs have come into effect.
China is not naive when it sees that the U.S. has confiscated the reserves of several countries.
Would you want to give the bankers some comfort zone like that? My liquidity threshold is 2 lakh crore or some percentage of deposits.
1.5% is quite a plausible, real rate or a natural real rate.
Now, the point also is this. If China decides to sell, US, of course, hurts.
The Dow futures, though, have recovered substantially from the lows. They were down 900 at one point and now trading in the positive territory.
Okay, last hour before a trading holiday, which I think everyone is looking forward to with some gusto. Much needed. Markets are exhausted. I can say I am exhausted, and I think most of my co-anchors are exhausted as well. But we have to get through the next 1 hour. Markets doing much better. This is Closing Bell. We are coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant, Nigel and Rima with me today. Guys, hi, good afternoon.
Hi, afternoon. You know what I was thinking? Typically, you always have this counter on, right? Like you've got so many working hours left, and then you've got, a longish weekend, a holiday for 3 days. So I thought if you have that in 1 hour today, and then Friday you've got to work, and then off till Tuesday.
I'll tell you what, these truncated weeks would have been much better for investors, traders, if it wasn't for Mr. T, right? But now you need to keep an eye out on the screen as well, find out what he's saying next. But as you said, Rima, in the next few trading sessions, I think we're working less and we have, a larger number of holidays. It's always good.
Well,
I think tomorrow is a
right?
holiday,
Yeah.
Monday is a holiday.
Yeah.
So you basically...
And the next Friday is a holiday.
So basically you come in on Friday and then you come straight on Tuesday.
Or you can just come back.
Someone's got to plan on mine.
All right. Well, enough about holidays, but I think that's essentially the state of markets, right? Absolutely frayed and exhausted. I think, we are exhausted commenting on what's coming because it's so much is coming in terms of news flow, reporting essentially on it. And of course, if you're in the market and if you're active and if you're trading, it of course has been exhausting as well. But much better screen on headlines, on headline indices, and basically you can look at the Nifty, it's a 0.5% cut, much better compared to the rest of the world in that sense. And it's been that way actually from the morning. So no point was it looking like, like a 2-3% down day. Global markets, by the way, also are off the lows in their own. They're still worse off than India, but they all are off. Of course, tariff headlines remain paramount. That one headline from China, that white paper, them sort of seeming conciliatory and saying, well, let's talk, etc. That basically caused a bit of a recovery in US futures. Declines outnumber advances 2:1. So market breadth is not all that great. PSU banks, IT and metals are the big losers. FMCG is the sole sector which is higher at this point, and we'll talk about FMCG more in just a bit. None of the levels, and the levels all remain the same on the upside and the downside. We're basically in that range. None have been hit, at least not so far. Rima.
Well, markets are relatively well behaved. The Nifty, the mid-cap index has recovered 1.3% from the day's low. The small-cap index in the red, but again, off nearly 1% from the day's low. So it staged a bit of a recovery as the second half of the trading session has progressed. A quick word on the way Asia closed. The Taiwanese markets ended with a cut of 5.8%. The Japanese index lower by 3.9%. And now on a year-to-date basis, These two indices are down more than 20%. On one side of the Atlantic, the DAX and the FTSE, all three of them down between 2 to 3%. Sweeping tariffs come into effect. For so far, it was talking about the threat of the tariffs. Now we're looking at the impact of the tariffs. So Europe is down between 2 to 3%. On the other side of the Atlantic, we've got the Dow futures, which is currently down close to about 250 points. Sectorally, IT continues to bear the brunt of the selling pressure. The Nifty IT index is down 2%. This month, it's down 12%. Pharma continues to see some pressure. The Nifty Pharma Index 1.5% lower. FMCG, that's the lone warrior in the green. Names like Britannia, Nestle, HUL, Tata Consumer. Top 4 Nifty gainers are all belonging to the Nifty FMCG pack. And then you've got gold loan companies like Muthoot Finance, a bit wary and a bit nervous ahead of what might come out later today in terms of guidelines.
Well, that's right. And I think a couple of stocks, though, that are moved to the high point of the day in this bleakish market setup. You have IDBI Bank that suddenly spiked up. The volumes are very, very large on that one. Currently, that one has moved to the high point of the day. The intraday chart will tell you the picture. Wasn't doing anything much. And Sunny, there's a big volume spike on that one. We'll find out whether or not there is any kind of news flow. For the time being, Mitesh Thakkar is waiting by. Hi, Mitesh. An hour before we get into that holiday, and we have expiry as well that will play out. What's the call? The Nifty is down 150 points. You need to take on both, though, that the Nifty actually has been a relative outperformer amongst the global markets as well. What's the level you're looking at?
So I think if you look at the daily movement today, both the Nifty as well as the Bank Nifty, I think, post that opening, I think it started to contract a bit, and the indicators which were on the, suggesting rising volatility have also started to turn sideways and flat. My idea is that I think we might now look at some kind of a sideways ranged activity developing because the directional index, the directional indicators are losing steam. And on the Nifty, I would look at 22,250, 200 as the downside and 22,600, 700 as the upside range. So broadly, I think that's the kind of boundaries I'm looking at. Similarly, on the Bank Nifty, it's about 50,000, 50,100, roughly about 50,750, 800. So that should be the area for the next few days before some kind of a clear directional bias emerges. On the stock side, I have one buy and one sell. MGL for me is a sell to stop at about 1270. Would look for targets of around 1200 over here. And MFSL, I think, that's a stock which is trading near the day's high, and there's a pivot at about 1165, only 4 or 5 rupees higher from current levels. So buy about 1167, 68, keep a stop at about 1150 and look for targets of 1200 plus.
Okay, all right, got that. Well, just one stock I want to highlight, Mastech, that's up closer around 15% as we speak. I'm looking at an article online, Rima. I think the UK government is looking to invest 760 million into new health data devices. So I guess that's the reason why that stock has moved. And it's moved on very, very large volumes, currently up at the high point of the day, up 15%.
Indeed, Mastech gets a lot of the revenue from the US government. NHS in particular is a big client. UK. What did I say? US. Sorry, from UK. So the street is watching for this one.
All right. Well, I think let's talk about that. One sector. Actually, this is one stock where the impact is being seen. I'm talking about Muthoot Finance, right? And this is the RBI policy. The policy, of course, was largely in line with expectations. It's not really been able to move markets except the gold loan stock, Muthoot, on the downside. Ritu is here to tell us what the RBI said and what is coming. Ritu, over to you.
Well, Prashant, the gold loan revised draft rules are expected later today. But, here's what we know so far on the back of which these stocks are reacting. One, RBI said it is going to comprehensively review the existing guidelines and come up with a new draft circular that is also going to, cover conduct-related issues. I'll get to that in just a bit. The idea, it said, is to harmonize regulations across all regulated entities, keeping in mind their own risk-taking capabilities. And the governor clarifying the idea is not to tighten regulations, but to rationalize them. And that, that is something that sort of helps some of the stocks recover later in trade. The draft guidelines are going to be issued for public comments today, and then the final guidelines will be framed. Now, what are the shortcomings or conduct-related issues that RBI is talking talking about. If you remember, in September when RBI had come out with some, sort of guidelines on the gold loan circular, it had said it had observed shortcomings when it comes to third-party use for sourcing of these loans, the valuation of gold being done sometimes without the customer being present, weakness in monitoring the loan-to-value ratio, which is 75%, incorrect application of risk weights when it comes to assessing gold loans. So there were various irregularities that RBI had spotted, and perhaps those are some of the things that it will look to sort of, clarify on in this new circular. Also keep in mind that gold loan is the fastest growing loan segment across any category. Now, it is classified under the personal loan segment, but as of the latest data from RBI end of Feb, in the sectoral deployment, you'll see gold loans grew by almost 87% over the previous year, while the industry average credit growth rate has been 10-11%. So perhaps that's why you're seeing RBI act on that segment. Now, secondly, on the co-lending arrangements. Now, so far, the 2018 and the 2020 RBI guidelines on co-lending only dealt with co-lending arrangements between banks and NBFCs limited to the priority sector. Now, what the RBI is proposing to do is broaden the scope of the guidelines, so include all regulated entities, which means that regulatory grey area that existed when it came to co-lending agreements between two NBFCs or two banks, that will be addressed, and banks can form these partnerships beyond priority sector loans as well. So the idea is to just broaden the base. Again, just a reminder, both are going to be draft guidelines. There will be public comments that will be sought, as is the case, before final rules are spelled out.
Okay, all right. Thanks a lot for that, Ritu. Well, let's get in Prakash Diwan to give us a take. Hi, Prakash. Good afternoon. Good to see you win. Well, Muthoot today at one point of time was down 10%. From that stage, a bit of a recovery. It's the leader in the pack, and if there is any kind of movement in the organized players, then it always is the largest player. It always stands to gain. But in uncertain times, it pulls back a little bit. So going by the kind of growth outlook, going by the return ratios as well, do you think it's favorable at around this 2,100 odd mark?
Good afternoon, Nigel. So, very clearly, this is one player that's weathered many storms. I don't think you need to kind of be worried about how things will pan out. It's too early, it's too premature to assume that it will be negative or unfavorable. And that's exactly why that 10% lower circuit to the current levels, the move that you saw after the RBI governor's statement. It's very clear there's a huge market that's opening up on gold loans. Muthoot, Manappuram, some of the banks have helped formalize that. Now it needs to get standardized. So there's a lot of subjectivity in the approach that is taken. And I think the RBI is probably looking at, as Ritu also explained, more of rationalization, making it much more objective, transparent, and fair to the consumer. So, all of that behaves very well for the largest player. And to be honest, at this level, you don't really see much of a risk. Whatever impact was to happen has happened. And in fact, it could only be more favorable than what most of us anticipate. And it's not, you could buy it after the announcement, but idea is that if you want to participate in this segment, it's probably one of the best proxies. Or you take up a bank which also is very aggressive, like Catholic Syrian, to some extent. Even SBI has got a very fast-growing portfolio, but then the other things move it in a very different way. So I'm sure people who want to allocate could probably do it to a bank which is leading the way in terms of this thing, or even Federal Bank. All of their gold loan portfolios have started inching up very, very distinctly. So I'm quite positive on the space. I wouldn't be in a hurry. Let's wait for the guidelines to be out, and then you can take a call. From a longer term, Muthoot definitely stands out as one of the better ones.
Prakash, can't not ask you about IT. Once again, it's the top sectoral loser. And today, Jefferies has slashed the target prices. We're talking about cuts of about 25, 30, 35% on some of these best performing stocks. Just pull up the target price picture by Jefferies now. On the large cap space for Wipro, their target price is down from 310 to 210. That's a 32% fall. On TCS, their stock price, the target price has come down by 27% to 3,300. On mid caps, target price cut on Infosys, Coforge. These were some of the stocks that the street was betting on hopes of a higher growth, and now they've lowered the target price significantly. LTI Mindtree has seen the sharpest fall of 37%. According to Jefferies, the stocks which are best placed are companies like Infosys, where you have some growth visibility, companies like Sagility, which are least exposed because they get 100% of their revenues from pharma, though pharma now is also going to come under the, perhaps come under the ambit of the tariffs. But they like Infosys, Coforge and Sagility. They've downgraded TCS today to a hold because of limited growth. They've downgraded LTI Mindtree and Infosys on account of its high discretionary exposure. But Wipro is the one which is taking a knock today. Wipro is downgraded to an underperform, and their target price of 210 still implies a cut of about 11% from the current levels. Look at the growth estimates that Jefferies has put out for Wipro. In FY26, they're saying the company will degrow, minus 0.5%. In FY27, the top line will go up only 1.7%. There will be margin pressure and the EPS growth will be 2.2%. So they've assigned a target multiple of about 16 times for Wipro. But this is a company which, according to their forecasts, will only grow 2.2% in terms of an EPS growth. So, Prakash, with that kind of, growth forecasts, what does one do with the stock?
So brilliantly summarized, Rima. I think even Jefferies wouldn't have been able to explain it so well. But remember, some of these targets that they're talking about, for instance, TCS, is anecdotally, it's already below the target price. So what these percentile numbers tell you in terms of, targets from where they believe, their earlier ratings were, it's probably a catch-up. The reality is that, and this is very funny, we are talking about the US administration, imposing tariffs on the rest of the world, and we thought the rest of the world is crying because of that and is getting hurt. But look at the US market itself. I mean, they are also not benefiting. So absolutely nobody is benefiting from what's happening. And the US environment, when I speak to a lot of people, and not just from the market, but generally citizens out there, it's in a state, it's in the throes of such confusion, such uncertainty, that nobody is willing to commit anything in terms of jobs, in terms of capital. Now, you were talking about tax cuts, which could have helped some of these companies increase their orders and all of that. Nothing of that sort is happening, at least for the next 2 quarters. Unless things change dramatically, I think IT will probably suffer a bit. And I do agree, Sagility as a name, we have discussed this earlier, it's one of the most resilient models that you have. Good pedigree, good client base. If pharma gets impacted, of course, that will also have some impact. It has pricing power. Let's face it, there's nothing that, a lot of the companies, healthcare companies can do without some of these intermediaries. So I would be a bit cautious allocating money to IT, absolutely. But no hurry to buy into any of these and probably wait for some more time. And results, tomorrow we have results seasons kicking off. So let's see what commentary comes through and give you some better idea of what do I anticipate from these companies.
Okay, all right. Well, Prakash, let's talk about the sector that's making a comeback. The FMCG sector, well, that's outperformed the Nifty this week. And Nuvama has maintained a positive outlook on FMCG stocks, like Britannia. Here's a breakdown of all the key factors. Well, first up, the SkyMat's call for a normal monsoon forecast. Well, that bodes well for agricultural production, which can help keep food prices stable and also support FMCG consumption. So that's point number one. Next up, initially the fear was that the heat wave will have a significant impact on the wheat crop. But the wheat crop is actually better than expected. And if the wheat crop is good, then it's beneficial as a key raw material and also it could help margins going forward. That's for the rest of FY26. The other factor at play, and that's both a tailwind for the economy as well as for the markets and for the FMCG pack as well, which is crude oil prices. That's at the lowest we've seen in the last 4 years or so. That helps in reducing packaging cost, which will directly help in improving the margins for all FMCG companies. And finally, starting from the second quarter of this fiscal, demand recovery is anticipated. And there's a few factors at play. Lower food inflation, which will make products more affordable for consumers. The interest rates cuts, well, that will help in lower EMIs, those that have EMIs on homes, on cars as well. That could free up some disposable income. The salary class as well will benefit from the tax rebates, which will increase their purchasing power. And finally, a good monsoon outlook, well, that's good for agricultural production and also it'll support consumer spending. The main risk that Nuvama highlight, though, is that the cost advantages will fully be passed on to the end consumer. That's what could limit any kind of margin expansion that we are likely to see for FMCG companies. So week to date, that index has made a comeback. To give you a number, I think the FMCG index in this week is up close to 2.5%. Well, the Nifty is down close to around 2.5% or thereabouts. So big outperformance is what you've seen in this week after underperforming for the last 7 to around 8 months. Prakash, what do you like from here?
So, Nigel, it's quite interesting, and this is a leverage that our community has. We can start looking at the glass half full the way we want, use all the factors to kind of support that thesis. And the simple explanation why FMCG is making a comeback is probably within the market, very few places to hide. Pharma is also, disqualified given the overhang that's there on pharma tariffs. They are completely internally focused, and consumption is something which will continue because you're all look at what's moving. It's all staples. It's not discretionary stuff that's moving. It's the staples that's moving. And while they speak about wheat being in a benign range in terms of pricing, you have sugar which has gone up. So there could be lots of these things. But given the fact that we've had FMCG not participate at all in the last 2 years in this rally, and of course even the correction that's come in has not been so severe, there is very clear evidence that this is the pocket where most of the large cap buying would happen, given valuation comfort, given the growth trajectory ahead and things like that. So if you have volume growth, margins will at some point in time start following. And this is one pocket where you could actually be completely safe. So, there's no impact of tariff. There's nothing much you need to be worried about in terms of global indices and all of those moves. So that's what's making sense. Anything specific that you want to buy? I don't know. Somehow I personally like ITC. But then when you buy ITC, it comes with a lot of other things as well. Thankfully, hotels is out, but I still feel it provides a very, very decent level of...
Yes. Go ahead, Prakash. ITC is something that you like.
Yeah.
And what about the other one? We're getting into, I'll give you 2 hints. One is we're getting into summer season and barley prices have come down. Which one is that?
No, absolutely. So that is a different discussion for altogether, and I'm sure there's enough salience that continues to be built in there. But
United Breweries.
Yeah. So wines and spirits, beverages. I mean, there's enough that you can talk about. As I said, it still doesn't qualify in staples, Nigel. So that's exactly where I delineated the two.
Right. So ITC is something that you like, and from the FMCG pack, and United Breweries has the tailwinds. Summer, and you have barley prices that have come to the lowest level we've seen in many, many months, which will be a tailwind for them as well.
Okay, I'm watching for Swiggy. Swiggy is higher by nearly 2.5%, and Instamart has launched Max Saver, which basically means that if you order more than 999 rupees, then you get higher discounts. So this is direct competition to Zepto's Super Saver plan. And Kotak Institutional Equities has come out with a note, and they say that Swiggy's plan for higher order values, again, above 999, where you will get more discounts, is more aggressive. You're getting more, cheaper. For the same thing, you'll get it at a cheaper rate. So therefore, it's good because it will help in expanding. But the net impact on Swiggy will be negative because of the higher discount. So the net losses at the bottom line will continue to stay. But that's the update coming through from Swiggy. Max Saver.
I wonder whether people really check. 1,000 rupees is getting me this, 1,200. Do you check?
No.
I don't check. But I don't have any of the Super Saver plans. I don't think... but yeah, it's
so on Zepto, it's not that you have to go to the Super Saver. If your order value is crossing 999, then you can just automatically switch.
No, for example, I've started using, I use, I think, Zepto sometimes. And every time I order something, it says...
It says you can switch to Super Saver.
Which I never do.
That's because you don't want to purchase more than 999, right? But if you have a long...
No, my point is if you have Zepto and you're using a particular scheme, you won't shift to something else because you wouldn't bother going through the scheme and finding out the details, etc. So it's kind of sticky in that sense. I mean, but of course, I mean, it does make a difference for sort of newer markets, etc. I guess we'll try and get the companies back on to talk about this competitive intensity. We've touched upon this with Swiggy, etc. Earlier. Maybe time to get them back. We'll take a quick commercial break here. We're going to come back in just a bit from now. Vaibhav Sanghvi of ASK Hedge is going to be with us on the other side. Stay tuned.
Welcome back. As trade war tensions between US and China escalate, there are possibilities that China may hit back by selling US bonds. Prashant has now moved over to the big wall for an explainer.
Well, thanks very much for that. Will China hit back at Trump's tariffs by what some have called, actually a guest in the morning called, the nuclear option, dumping US treasuries, but they're US bonds. It's the most powerful financial weapon in China's arsenal. There's growing chatter that China may retaliate by doing this, not just with words or counter tariffs, but with real pain in the bond market. Such a move could serve as a powerful financial market deterrent, much like weakening the yuan's daily fixing. I mean, lower yuan makes China's exports more competitive. Selling US bonds will raise the cost of funding for US government and send a clear message. I mean, you sell more bonds, yields go up, and that's essentially your risk-free rate. So cost of financing and rolling over US debt becomes much higher. Of course, the message is going to be that don't test our restraint. Now, how big is China's holding of US government bonds, right? I looked at the numbers, and the numbers I have is this. China holds about $760 billion in US treasuries. That's about 9% of all foreign-owned US government bonds. This is down from a peak of 28% in 2011. So this is not a percentage of the total US treasuries outstanding. This is a percentage of what foreigners own, and foreigners own about, as the graphic says, 30% of US treasury debt. So 9% is what China owns. Selling US bonds hurts China too, and that's the problem. And that's why many are saying, they won't do it. It's simply because they are the largest holder, and a fire sale would devalue their own reserves. It's quite similar to how in stock markets we say large shareholder selling, and that crashes the stock because they are the big supply, and there is no counterparty on the other side. One other line of thinking is this: why sell? If you look at the maturity of bonds which foreigners own, 60% of foreign holding of US government bonds are in the 0 to 5 year tenor. So they're not long dated. And I'm assuming these numbers hold true for China official reserves as well. So the thinking is, they could just simply let this run down without reinvesting back in bonds or buying new bonds issued by the US Treasury. In any case, if you look at Chinese reserves over the last couple of years, and not just now, one thing is clear. They're buying more gold and they're buying lesser of US bonds anyway. And this has been happening already. Now, while we're already only talking about China for now, the bigger sort of longer term question is this: will we see overall foreign demand for US bonds, US government bonds, permanently impacted, caused by all this, for the lack of a better word, nastiness on tariffs and trade? And I think it's an important question to ponder over, because US government finances a lot of its spending through this route, and people queue up around the world, or rather for the decades now have queued up around the world to buy this because it's considered safe and all the other reasons which go with it. The Chinese central bank, the PBOC, People's Bank of China, has a publicly stated goal in any case to diversify its reserves, move away from the US dollar and reallocate into other G10 currencies. This pivot makes more sense now in any case, even if we did not have a trade war, because the rate differential between US and the rest of the G10 countries is narrowing. So the attractiveness already, that gap is narrowed quite a bit. So it's a space we need to watch closely. As that statement just a while back said, that white paper, apparently they're ready for negotiation, and that's the route this will take, and it won't come to this. The point is this: they don't even need to sell it. If it comes to this, we're not talking about a wholesale sale. There's no buyer on the other side. The Fed will have to do QE and bump up all these bonds if China decides to sell and hand over dollars to China. We're not talking about that. But the point is, even a small, chunky sale could make the point in this trade war that we will match you in escalating this war step by step. And I think that's what we are looking at here. Let's actually welcome in Vaibhav Sanghvi, who's now with us to run us through what he's making of things. He's CEO of Ask Hedge Solutions. Vaibhav, beyond the big picture but it's all big picture now, and not very many people are looking at sort of bottom-up stories because everything is being brushed aside in the same color. What are you doing, Vaibhav, at your fund? You guys can do long short. What's the sense, and what are you up to?
Prashant, I think markets in a way are extremely kind of volatile in the sense that every day is a new day, right? At the end of the day, what are the developments? and what is the subsequent impact in terms of the portfolio, it's extremely tricky to kind of take a medium-term view on that. So, from being a long short fund and having the liberty to kind of go on the opposite direction as well, kind of helps us to kind of hedge the portfolio effectively during these kind of time periods. But when I saw what you had to mention about the China thing as well, I think one of our contention also is that on the trade tariff, it is not only about tariff. I think a lot would go also into in terms of the negotiating kind of deal, in terms of course, bridging the trade gaps, but 2, in terms of the geopolitics, and 3, in terms of kind of funding the US deficit by buying more US treasuries as well. So my sense is basically it will be all part of one big negotiating deal, which will come about with all the countries going forward. So interesting times, tricky times, but at least in the next couple of months, I think that turbulence will continue to be there on an overnight basis.
You were talking about your long shots, Vaibhav. Which side, how you're positioned currently, and how has it changed, say, in the last couple of months or so?
See, I think over the last couple of months, I think we had written a note in terms of what we are thinking in terms of the change. And of course, one of the big risk factors was Trump tariffs in that. But what we are seeing, from FY26 and 27 perspective is, one, from a domestic side, we are extremely positive on the whole consumer segment. Now, it's not only about the defensive nature of the consumer segment, but also because that we have seen after 8-9 years of, government's sole focus on the supply side to now a combination of welfare and in terms of the consumer rebates as well in terms of the tax. So what we do think is that increasing the disposable income in the hands of the consumer at the end of it will see to that the momentum in spending kind of increases, and especially into sectors where there are good experiences, or probably going to restaurants, malls, and over and above some amount of discretionary items as well. Lastly, to be followed by the staples. So all in all, the whole consumer space is something which we are bullish on. And at the same time, what we are turning a little kind of to neutral from being very positive is basically the banking sector, purely because as we look at rates kind of come down, we may see some amount of pressure on the margins. And as we see the turbulence on the economic side, where the exporters will have some tough time, maybe probably some amount of stress on those kind of books as well. So that's a segment which we are currently getting neutral from being bullish, from a portfolio perspective.
Any sectors which you're short on, cautious?
So all the global sectors, including metal mining, probably also on autos who have a global exposure. I think those are the sectors which we are avoiding. And lastly, I do think that if the global growth is going to weaken, then it will have a direct impact on the cap goods industrial side, as well. So industrials is something which we should probably avoid as well, purely because the valuations there are not cheap in any case.
And IT pharma? Vaibhav?
Yeah.
You spoke about export-oriented sectors like metals or global companies with auto companies with a global facing. But what about IT and pharma?
See, IT, I think it has been beaten down really badly, and probably we are looking forward to the next 10 days in terms of the results and the guidance. Not that it would be anything kind of exciting. What we may probably happen is basically because of these results and the guidance, we may find some amount of bottom happening post the declaration of numbers. So let's wait for that. In our view, when the free cash flow yield kind of starts to look pretty attractive on these companies, there is some amount of bottoming will be made probably in the next 10 to 15 days. So we will have that view. Pharma is, again, wait and watch. Let's see what happens from a tariffs perspective, and then we'll probably take a call on that.
I think I just saw Coforge up on the screen. Coforge high was about 10,000 rupees. It's fallen to about 6,000 rupees. And Rima, I think I remember speaking to Sudhir Singh.
Yeah.
He's
very bullish.
He's like front foot and everything first, right? I mean, I don't know if the commentary has changed. The last time, of course, this was all not there, this tariff talk, etc. So we've seen very, very sharp falls in that sense. And tomorrow, of course, we'll ask TCS, I mean, you know, what are they hearing? And if they're able to hear, if they've heard anything so far, and I think that should set the tone beyond the numbers for Jan to March. Vaibhav, any thoughts on OMCs, oil marketing companies? Again, you know, oil prices have come off very. The only thing is, marketing margins are very robust right now. Will oil stay here? Because in COVID, there was real demand destruction, right? Right now, the destruction is mostly financial markets. So the price of oil can also swing sharply based on what happens to financial markets.
Of course, Prashant, I think while that's a second order or third order probably impact in that sense, but what we have seen in terms of increase in excise duty by 2 rupees per litre, in our view, you know, the OMCs may not be allowed to make profit in excess of a certain amount, which probably will have to be contributed to the government coffers in that sense, which is to build up some amount of cushion on the fiscal spending side. So my view is that as oil keeps on correcting, while we see some amount of decrease in prices on the consumer side, but some part of, again, will kind of keep on chipping, you know, away to the government kitty as well. So in that sense, yes, current profitability looks good, but you know, as global growth weakens, refining margins will start to come under pressure as well.
Okay, all right, so not a positive look. I think there was an Ambit note today. They are talking about between 50 and 100% upsides here for oil marketing companies. So in the morning, look for it. But I mean, there's a fair bit of interest here, especially now with that marketing margin story, oil prices dipping, etc. But as Vaibhav said, there are the margin. Of course, we'll have to wait and watch if the government takes away more, leaving less for the companies themselves. Stocks are higher at this point. I think HP, etc., are up to 2.5%. Glenmark is the other one. I think it's down, but I think from the lows, I think it's come up a little bit. Let me just quickly pull this up. And there was some news which came through as well. Yeah, it is off the lows. The low was about 1340. Stocks at about 1375 now. From 230, it's bounced, I think, after that news flow. Vinny is here to tell us what has happened and to kind of explain what this means. Good, bad. Vinny, over to you.
So for Glenmark, mainly the news flow that has come in is that in March, they'd done some recall of 39 drugs, and this was the newest class, and the classification that came in for these drug recalls was class 2. Now, a recall of these drugs was initiated in March, like I was mentioning, and they classified it as class 2 just yesterday on April 8th, and that is why we are highlighting this, and it becomes important. Why? Because what does class 2 indicate? That in class 2 recalls, normally these products are causing some bit of an issue in terms of medical front, which are reversible for in terms of adverse health issues, so you can reverse it in terms of that. But it's important because this could cause an inspection in the Pritampura facility for Glenmark Pharma is what analysts are highlighting. Most of its drugs, yes, were expiring in March 2025, but an inspection is a possibility that could come in here, and that is a concern, and that is why we saw that dip coming in for Glenmark Pharma. As of now, in Q3 FY25, 20% of their revenue contribution came in from the US market. This drug was recalled in the US market, and that is why we're keeping an eye out on this one.
Okay, all right. So it's negative, right, Winnie?
It is negative for that.
At the margin, the perception is that
reasonably negative.
It could cause an inspection. Okay, got that. Thank you very much for that. That's Glenmark for you. We'll take a quick commercial break here. On the other side, we'll tell you what to buy or sell today for a reverse trade when we come back. Day after that is Friday. Stay with us.
Welcome back. Select stocks, though, have bounced a little bit from the lows of the day. I think NMDC should come up for you. That's cut its losses. Hindustan Copper as well, that's halved from the recent peak. But that stock as well is spiking up a little bit. And Angel One, just pull up the intraday chart out there. That stock, in fact, has done pretty well. It's done a bit of a U-turn, currently moved to the high point of the day. So individual stocks doing a thing of their own. Mitesh Thakkar is back with us. Mitesh, fresh calls you have for us?
So I think, as I said, trading would be best served if you take it on individual stocks. The indices are showing signs of, consolidation as the volatility indicators have started to shrink. So I have a BTST on NBCC with the stop at about 86 or 85.90 and look for target of 88. And the other stock I would want to buy is Nestle. It's just at the 200 average, which is about 23.50. And the stock is trading around 23.45, 46. So if it in the next few minutes starts getting past 23.55, buy, we'll take a BTS with a 20-point stop loss. I think this is heading towards 2,400 points.
All right. Thanks very much, Mitesh. Speak to you soon. Mangalam caught up with the Indigo CEO, Peter Elbers, to talk about the growth, the airline, international expansion plans. He began by asking how the industry is dealing with trade uncertainties and how that is sort of impacting flyer behavior. Listen in.
Underlying fundamentals of the Indian market, I think, are very strong. And with that, we're very confident that our growth path will continue to be there. One could even argue with some of the relationships between India and other countries, and recently a huge European delegation was here, is strengthening given the overall geopolitical context. So we're actually quite optimistic on that outlook, and we did not make any adjustments to our plans.
All right, so you haven't made any adjustment to your plans. The domestic market in India is fairly strong. You have a strong international aspiration as well. 40 destinations in FY25. How many more in FY26? And what proportion of your revenue do you expect should come from the international operations over the next 3 to 5 years?
Well, it's a good point. I think India was to some extent underserved, and a lot of the hubs were actually placed outside the geographical scope of India itself. So clearly the ambition of Indigo is to make sure that a lot of that international travel is actually traveling on an Indian operator, and that Indian operator being Indigo. So we moved in a time frame of just 2-3 years from 20-ish to 40 international destinations. We've doubled the number of international routes from 60 to 120. I do expect for the next year in the range of 10 new destinations to be added, more routes also to be added. And the revenue percentage today, or I should say the ASK percentage of production, we've reached the 30%, and we've recently said that that number is going up to 40% of our operational basis.
Let's talk a little about Indigo's business itself. The fourth quarter, how do you think the volumes have panned out for you? Have you met the guidances that you've had? And for the next year, what are your targets and aspirations?
We've actually presented a quite optimistic view on how India is moving. And if you look to the public DGCA data for the month of Jan and the month of Feb,
yes,
they actually look very, very positive and reconfirming that growth. So the underlying demand and the underlying dynamics are good. So we have been able to live up with our capacity guidance. I mean, if you take a ballpark number for aviation, and I would guess for hospitality, it's not dissimilar. GDP times 2 in a market which is underpenetrated. So if we take that 6 to 7% of GDP growth, which is taking place in India, you have a kind of figure where the growth is ended. For next year, we estimate, again, a early double-digit growth number going forward.
One of the concerns that everyone had was these airports increasing their charges. How do you have to respond to that?
Airports increasing their prices, it's a matter of a discussion taking place in India and outside India. I think where I would like to sort of engage in a discussion with the airports, if the average prices in India are 6,000 rupees for a ticket, you don't want to have airport charges of 3,000 rupees, right? And that's exactly where I think we need to find a good balance between what is the price point for customers and what is the airport charges. So that's a continuous debate. Having said it on a more positive note, the quality of airports in India is getting better by the day, and that's a very important aspect.
Well, important conversation over there. The Nifty is at that 22,400 mark. The low today was 22,350.
So that happened at about 11 o'clock. And since then, especially the last 2 hours, we've moved in an absolutely flat line. 22,400 down 130 points. Get into a break. We'll come back and chat with Ambrish Palika.
Quite a year it has been for the Nifty, right, this time around. But there are some stocks that have made records, not necessarily in a good connotation. And we'll look at some of those. We start off with the index heavyweight, that is Reliance Industries. And with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet the street remains bullish and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1,350 to as high as 1,950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now, in fact, since 2010 the stock has delivered negative annual returns only thrice, and 2 of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2,080 rupees to as high as 3,750, but the stock is veering more towards the former right now. On the flip side, Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year, the stock has doubled this year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains constructive, targets of anywhere between 2,700 to 3,700 on the stock. Now, HDFC Bank, positive returns every year since 2013, but 3 of those last 4 years are returns in single digits. Yet, no analyst on the street has a sell rating on HDFC Bank with price targets ranging up to as high as 25.50. Now, FMCG is a sector that is disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street, though, is optimistic, analysts giving targets of up to 3,400 rupees on the stock. Staying with consumption, Titan is set for its first negative calendar year after 2016, and since 2016 the gains have ranged between 10% to as high as 150% on the stock. The street, though, expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is
Welcome back. The benchmark indices are likely to go home with a cut of close to about 0.5%, reacting to perhaps what you could call the tariff trauma.
tariffs, Wall Street's reciprocal sweeping tariffs have come into effect right from Algeria to Zimbabwe. On China in particular, it's 104%. So most of the global markets are weak in trade. Indian markets, no exception, but the cuts are not deep. And in that, we forgot that RBI provided a boost. They cut 25 basis points of a rate cut and changed their stance to accommodative, but not too much of an impact given the global uncertainty. Amrish Baliga is now with us on the show. Amrish, before we get talking about today's market, first tell us your stock.
The stock of the day is Astral. It's among the leaders in the building material space with presence across pipes and adhesives. In the last few years, they've entered into other segments like paints, faucets, sanitary ware, bathware, water tanks, and valves. And they've, in fact, been the pioneers in India as far as CPVC and lead-free UPVC pipes and plumbing systems goes. They have about 25 manufacturing units spread across India, around 3,300 distributors, about 230,000 dealers. And they've been expanding on a continuous basis. In fact, the current capacity utilization is just about 60%. So there is a decent headroom. In the last 7 to 8 quarters, the top line growth has been in single digits, but the margins have been maintained, but still the stock has corrected quite sharply. And when you talk to the management, they're still confident of about 15% CAGR. As far as revenue goes, basically because the real estate and infra spaces are doing decently well. Government focus is there on various schemes like Pradhan Mantri Krishi Sinchai Yojana as well as Nal Se Jal under that Jal Jeevan mission. It's a net debt-free company. They have cash on books of about 290 crores. I'm expecting an EPS of about 34 for FY27 and have a target price of 1,700, which is still much lower than the highs which you have seen in the last year and a half.
Okay, all right. Well, just keep an eye on a couple of other stocks. JDL, one of those underperformers, suddenly is seeing a big volume spike, and JDL has now moved to the high point of the day. So let's just get the intraday chart of the stock up. Suddenly moved to the high point of the day. Well, Prakash, Amrish, apologies. I wanted to ask you actually about auto ancillary companies. Right. In the past, we have discussed Motherson, Gabriel as well we have spoken about, and I think Sona BLW as well. The problem is the auto pack has gone into a tizzy because of what President Trump is talking about. If there's a recession that hits, then it'll affect across the industry as well. At current reckoning, post the big pullback in stock prices, what's your top pick?
In fact, my top picks would still be Samadhana Motherson. Which has, if you see from the highs which we have seen in 2024, it's about 50% down. Sona BLW similarly. And I think, this negativity seems to be slightly overdone because, yes, there will be issues because of the tariffs. But then we should keep in mind that these big boys in auto ancillaries have their units in US. So, the hit will not be as big as most of us think it would be because, at least some part of their revenue comes from US and that really will not get affected by these tariffs. Yes, to a certain extent, whatever they're exporting from here, whatever raw materials they're exporting from here to their plant in US, that would be affected to a certain extent. But I don't, the way the stocks have fallen, I think the worst seems already built in.
So we'll have to see when what will cause eventually for this next leg to play out, right? Worst is built in, and then news hits, and then the market starts to look a little better. Some of these stocks start to look a little better. But that's the problem. We don't know what the timelines here are in that sense. Any other individual names, Amrish, which may have been in your coverage? You talk about, we've discussed many stocks in the past as well. And I'm sure many have taken a bit of a hit, maybe some in an unwarranted way. Anything else you want to highlight?
Some of the others in the auto ancillary space where I'm positive is basically Menon Bearings. Again, a small cap. Jamna Auto, they are the leaders in the leaf springs. I think these are two ones where again we have seen a decent correction. And at the current levels, I feel that possibly the downside seems limited from here. I don't know as to when it can start moving up, but if one is a long-term investor, nothing much to lose at the current levels.
Okay, all right, Amrish. In the past we've discussed Hindustan Zinc. I'm just looking at a few of these names. They've got hammered, metals because it's more global facing as a theme. SAIL has recovered from the day's low. Hindustan Copper has recovered from the day's low. We have JSL Stainless. All of them seen a good recovery. What's the call on Hindustan Zinc?
Hindustan Zinc, I'm still positive on the stock because if you look at the valuation, it's still quite, extremely decent at these levels, especially after the fall which we've seen recently. About close to about 40% of the bottom line, in fact, comes from the silver. Where again we have seen some correction as far as the silver as a commodity is concerned, and that's also rubbed off the prices of Hindustan Zinc. But at the same time, we should remember that the sales are completely dependent on real estate, the construction, as well as infra, because end of the day, zinc is used in combination with steel. So I really don't see the demand really going down too much more from here. So at the current levels at 400, possibly a risk is 5 to 8% maximum. Whereas the upside, if things work out fine, the cycle turns, possibly in the next year and a half, I'll not be surprised if you see levels of about 550, 600 plus.
Okay, all right. Amrish, stay with us. We'll continue this conversation a little later on markets forward. Let me just quickly wrap up things. We're about 2 minutes away from closing. And we'll end with a 0.5% cut uniformly on the main indices, except the small cap index, which loses a little bit more. But otherwise, it's pretty contained in that sense. 2:1 declines to advances. The big Nifty losers. And sectorally, I think it's easy to count the winners. FMCG was up, everything else broadly lower. In terms of large stocks, Wipro and Tech Mahindra from the IT space took a bit of a knock. TCS, of course, reports numbers tomorrow. SBI and Shriram Finance are the other two names from the financial space which looked up. And there was a L&T and a Trent as well, which were higher, which were lower, beg your pardon. These are the losers. And as I said, FMCG stood out. Nestle, Lever, Tata Consumer were the three FMCG names. And of course, there was Titan, which was higher as well. Muthoot, which was down 10% immediately after that RBI. Around the time of the RBI governor was speaking, actually recovered, but then again, it just is about 3% off from the day's lowest level. So to at 21.34 or so on Muthoot Finance. And I think as Ritu said, post-market hours is when we will get that draft circular come through. The other big losers, Phoenix Limited, Piramal Pharma, Biocon and Wockhardt. And there was something like a MGL which was sharply lower as well. A few gainers, there was Mastech, which was up a bit with big volumes, Jyoti Laboratories, and Max Healthcare stood out as well. So that's basically the market action this Wednesday as we head into the holiday tomorrow. But before the holiday, there's markets forward. We'll, of course, continue programming here. Stay with us. You'll hear from Ambarish. We'll get you a technical voice as well. Stay tuned.
Since 2002, and the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now, banks make an appearance here with IndusInd Bank, positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, and it's the 5th time in the last 7 years that the stock has had negative returns. Yet, 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, our news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so. And analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they've exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out. And now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis.
The market here mirrored global sentiment as it ended with small cuts. FMCG index is the lone winner, while most other sectoral indices were in the red. The volatility index gains over 5%. IT banking stocks were under pressure in a generally weakish market.
The Reserve Bank of India cuts the repo rate by 25 basis points as expected, changes the policy stance from neutral to accommodative. The governor raises the red flag on tariffs, says he worries more about the impact on growth rather than inflation, refuses to predict where rates are headed amidst tariff wars.
Chinese premier hits out at US President Donald Trump and his trade policy, saying China is equipped to fully offset any external shocks, believes China's growth remains intact. This while Trump took pot shots at world leaders who've been calling him to strike a deal. Meanwhile, the Chinese yuan hit a new low as the People's Bank of China eased its grip as tariffs take effect. You're with us here on Markets Forward, your go-to program where we aim to get you everything you need to know as you come back, not tomorrow, but the day after, tomorrow being a market holiday. I'm Prashant. With me, Surabhi. Surabhi, hi.
Hi, Prashant. So a day that started off with some amount of volatility. Then once we got through the policy, it was then after that it was fairly flat. But of course, the color was red.
Actually, the policy turned out to be a non-event, right?
Yeah.
It was largely in line with expectations, except, of course, that gold finance bit, which came out as a surprise. But otherwise, I mean, they've cut 25, they've changed their stance. So the market really moved on. But we've seen, global markets have seen a decent bounce from the lows. And I think, if it's incremental change is what markets are all about, and you just want to watch which way the thrust is, up or down, then today at least it was from the lows to the way up. And I think that perhaps is the best way to describe it. We ended with 0.5% cuts, except the small cap index, which ended with a little bit more. There's no real sort of clarity on tariffs. Even as tariffs have gone into effect, markets are still waiting and watching for clues in terms of what this will really, what the end game really is, or if there is an end game. And I think that is where we find ourselves at. Tomorrow, of course, is a market holiday, which of course provides all of us with some rest, but it also complicates things because you'll have 2 sessions worth of headlines to react to when you come back on Friday morning. Surabhi.
It's a complication we can deal with. I don't think anyone will complain. But yes, I mean, there is that outlier risk of, you never know what. For the day today, the Nifty, the final tally was the Nifty was down about 0.6%. And as that chart says, that once we got through the policy announcements, 10:30 onwards, the market was just absolutely flat, didn't do too much. The financial side of the market, interestingly, actually sold off. A lot of the large banks, NBFCs, they were all on the downside, perhaps because the policy didn't have anything out of the box. It was absolutely on expected lines, and therefore the rate cut as well as the change in stance perhaps already priced in. The advanced decline ratio, let's just pull up the crisscross lines because that's where there was a slight negativity. There were more stocks declining than advancing, almost a 2:1 kind of a ratio, with two stocks declining for everyone that was advancing. Now, in terms of the sectoral spread out, big slam dunk on IT once again today. Metals very weak. So once again, global facing sectors were bearing the brunt of it. And there was a rush to safety. Finally, consumer stocks, and that too consumer staples, they found a lot of takers. So stocks like Nestle, etc., they were doing pretty okay. That's the Nifty consumption, which was up almost 0.5%. So that in a nutshell kind of explains what transpired. Of course, we are going to get you more details over the next 20 minutes. Let's tell you what the lineup is like. We'll, of course, focus on some individual stocks as well, along with sectors that were that were in the limelight. The movers and shakers of the day will come up with Vivek. After that, we'll talk about the RBI rate cut. 25 basis points is done. We'll have, of course, our in-house experts to give us a detailed view on what this means for policy going forward. The RBI governor is also expected to issue guidelines on gold loans, and that weighed very heavily on stocks. We'll talk about that. IT stocks were in focus following a slightly negative report from Jefferies. They've downgraded a whole bunch of IT names. So we'll get you more details on that as well. But first up, let's go across to Vivek to understand the stock-specific action of the day. Vivek.
Well, thank you so much for that. Especially post the policy, it was a very dull trading session given the fact that there weren't too many wild moves that we've been used to seeing in the last few trading sessions. But quite a few gainers also in today's trading session. First on the list has to be the entire FMCG pack. Very good commentary coming in terms of easing inflation, so raw material prices easing as far as the FMCG pack is concerned. Also strong commentary coming in as far as monsoon is concerned. Back of that, the entire FMCG space, HUL Britannia, amongst the top gainers as far as the Nifty is concerned. The next stock on the radar is Hudco. This particular stock, the company actually received a news development indicating that they will now be allowed to issue capital gains bonds under Section 54EC. That particular stock, this is a significant development, a lower cost of funds, and on the back of that, Otla stock, very strong volumes today. And on the list of gainers, HPCL. Yesterday was a strong outperformer. Today continued the move higher. Lower crude oil prices actually aiding sentiment as far as OMCs are concerned. But on the other hand, quite a few laggards as well. The entire IT pack. You saw the downgrade coming in from Jefferies. Also remember TCS results tomorrow. Ahead of that, the entire pack sold off quite significantly. Wipro over 4% lower. The pharma pack renewed worries about impending tariffs, and on the back of that, you did see significant selling pressure. And of course, Muthoot Finance, still we don't have clarity in terms of what exactly are going to be the guidelines as far as gold loan is concerned. That particular stock ended lower by 7%. The pharma fact, like we just mentioned, the entire pharma index was under significant pressure today. And lastly, Phoenix Mills came out with their operational update, and it was very clear that the LFL growth or the like-for-like growth has moderated quite significantly. That particular stock amongst the top laggards in the F&O space.
All right, Vivek, thank you very much for that. So it's a comprehensive wrap out of what was up and down and what moved. Shrikant Chauhan is with us on the technicals, price action. Ambarish Baliga is with us as well on the fundamentals, and we'll talk stocks. But just a quick near-term view, Shrikant, both Nifty and Bank Nifty.
Good afternoon, Prashant and Surbi. For Nifty, it is extremely tricky to understand that what exactly happening in the market, because since last 2 days, if we see the technical pattern of the market, then it is in the range, and it's a clearly indecisive pattern. But the way we saw a sell-off on Monday, and later on the way there was recovery and gap up opening, I am of the view that till the markets are not breaking the levels of 22,200 on a closing basis, we could see range-bound sort of activity between the broader range of 22,200 and 22,800. But in case, if we see the market is dropping below the levels of 22,200, then in that case, the chances of hitting 21,700, 750 would turn bright. And if we consider the today's low with the low that we saw in the month of June, 2024 after the election, the low was around 21,200. So we are just 1,000 points away from that low. Nifty IT index has already reached to those levels. And as we are like discussing about Nifty FMCG, consumer staples, if they are doing well, that means the market is taking more and more defensive approach in the market. So we should be on the risk off side. And broadly, I'm of the view that we need to focus on the important level of 22,200.
Okay, 22,200 needs to be a critical watch point. Got that, Srikanth. Let's then get to our top story of the day. The Reserve Bank of India's Monetary Policy Committee has taken a dovish stance to counter the uncertainties linked to US President Donald Trump's sweeping tariffs. As expected, the MPC has decided to cut the key repo rate by 25 basis points to 6% for the second time in a row. The MPC also made a unanimous decision to change the stance from neutral to accommodative, signaling room for perhaps either a pause or more rate cuts in the coming months as well. The MPC also revised the growth forecast slightly lower for FY26 to 6.5% from their earlier estimate of 6.7%. The forecast for the first quarter has also been trimmed by 20 basis points. Let's listen in to the RBI governor.
The dent on global growth due to trade frictions will also impede domestic growth. Higher tariffs shall have a negative impact on net exports. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement.
All right, well, that is the governor. Let's now hear it from Lata, who's joining in with the editor's take on what she made of the policy. Lata, dovish enough or just dovish?
My take would be it was more dovish than expected, and it has promises for more dovishness to come. So that's why I think it was an elated market, an elated ecosystem. Why do I say more dovish than expected? 25 basis was always expected, but we didn't get a majority vote when we polled people for the change in stance. So that's clearly more than what the market expected. Again, the growth cut was not quite the unanimous view in the market. The fact that it is cut is an indication that they're seeing challenges to growth. That's always a sign that, you may have to help growth with few more cuts. The CPI cut was clearly a surprise. Most people thought that they would, hold on to their horses. It's also the statement that accompanied. The governor's or the MPC statement is, as per projections, there is now a greater confidence of a durable alignment of headline inflation with the target. Up until December, a dozen policies the MPC has told us that our goal is to use policy to align inflation durably to the target of 4. This durable alignment was a goal. And lo and behold, now the governor is saying it is durably aligned to 4%. So that, again, was something the market was very elated about. It confirms the dovishness. And finally, in answer to a CNBC TV18 question on the neutral rate, let me tell you that everybody was working towards 5.5 as the terminal repo rate in this cycle. We started at 6.5, we are now at 6, and it is expected it will go up to 5.5. How do you arrive at that figure? You achieve 4% inflation. 1.5% is seen as the real rate, which the economy needs. So 4 plus 1.5, 5.5 was what everyone was working with. The governor gave two signs. One, that when he is giving the forecast of inflation for all the months of 2025, inflation is going to be below 4%, between 3.6 and 3.8. And secondly, when we asked him about the real rate, he said RBI studies show it is between 1.1 and 1.9. There was something about his answer which made people feel that it would be okay if the real rate were even towards that 1.1% mark. Put the two together, the market is now almost a majority expecting that the risk is of the repo rate going below 5.5, probably to 5.25. There are many reports that you will hear from brokerages on that score. So that, again, for me, is a sign of more than expected dovishness to come. And finally, his answer on liquidity. When I try to lull him into give an assurance on liquidity, he's almost promised that they will keep liquidity surplus at around 1% of the total deposits, what you call NDTL, net time and demand deposits. That, again, was for the market an assurance. After all, transmission of rate cuts require that there should be adequate liquidity, and this kind of a almost clear promise that we will keep 1% of total demand deposits comes to about 2 trillion rupees. If that kind of durable surplus is kept in the system, the market would feel reassured. So that's why I would think that it was more dovish than expected. It promises more dovish than expected.
All right, Lata, thank you very much for that. And perhaps more coming, right, as you said, right at the beginning. Well, let's talk about the other story, right, from the RBI. But of course, this was the unexpected bit. Gold loans, perhaps under a bit of scanner. Muthoot sold off 10%, then recovered a little bit, then sold off again, ending about 7% down. That's the largest pure gold loan company in the country. Ritu is here with exactly what the regulator said, or it's trying to do here. Ritu, over to you.
Well, while we await the draft rules from the Reserve Bank of India on gold loans and on co-lending arrangements, here's what we know so far. Now, on gold loans, RBI said it is going to issue comprehensive guidelines on prudential norms and conduct-related regulations for all regulated entities. The idea, it said very much, is to harmonize these lending rules and to rationalize them and not really tighten gold lending rules. Now, what are the issues that RBI has observed so far? If you look at its previous comments, it spoke about shortcomings in the use of third parties for sourcing of loans, valuation of gold being done without the presence of the customer, weakness in monitoring the loan-to-value ratio, incorrect application of risk weights, and so on. Also keep in mind, gold loan is the fastest growing segment among all kind of loans for banks, growing at nearly 87% year on year. When it comes to co-lending arrangements, the scope has been broadened to include all regulated entities and all segments and not just priority sector loans, which was so far the focus. There was a regulatory gray area when it came to NBFC to NBFC or bank to bank co-lending. So all of that will now be corrected in the new guidelines that come into play.
Okay, got that, Ritu. Thanks very much. That did lead to, of course, pretty sharp cuts, especially when this announcement was immediately made on a lot of the gold financing NBFCs. We've got Amrish also with us. Amrish, by the end of it, there was some recovery in names like Manappuram. Muthoot was still down. What do you make of these, possible, changes in regulation, and what would your advice be on Manappuram and Muthoot?
No, see, I mean, whenever there is an additional regulation which comes in, it can disrupt the business for some time until you really get used to the new normal. So looking at the way the gold loan companies have expanded in the last 4 years, I think the disruption can be a bit widespread. So for the time being, I'll just wait and watch, let the regulations come, and then possibly we can take a call.
And I think we don't have to wait very long, right? I think we'll know by the time we hit Friday morning, we come back, we'll know. Otherwise, NBFCs, Amrish, any thoughts from anything you like in that space, really?
NBFC is nothing as such, but then I would still be positive on the banks, both PSU as well as the large private sector banks. So that's where we have started reinvesting again. But NBFCs, for the time being, we are staying away.
Okay, let's talk about IT now. Rima is here with us. Our TCS reports tomorrow. We know the backdrop is pretty uncertain, and that'll be the top question which we'll put to them. But Rima, take us through what you're picking up.
IT continues to bear the brunt of all the macro uncertainty, rising demand concerns, a hit on the top line, margin compression, sectors like retail, manufacturing, logistics. All these could come under pressure in FY26, and brokerages are now coming to terms with the reality. Today, Jefferies has lowered the target price on Indian IT companies by 5 to 35%. So in the frontline pack, the biggest cut in target price is Wipro, where it's slashed by 32% to 210, and the other one is TCS, where the target price is down by 27%. In the mid-cap space, again, the cuts are, across the board, but LTIMindtree has seen the target price come down by 37%, for Infosys by 29%, and about a 25% for Coforge and Sagility. Jefferies prefer stocks like an Infosys, Coforge, and Sagility, where you have higher growth visibility and limited derating risk. They've downgraded a TCS, LTIMindtree, and Infosys on account of weaker growth, outlook or higher exposure to US discretionary exposure. They've also downgraded Wipro, and Wipro, in fact, was the top Nifty loser. As I said, the target price was slashed by 32% to 210, and even after the correction today, the target price implies about a 10-11% downside for the company. Now, Jefferies' revenue and margin estimates will come up for you on your screen. FY26, according to them, Wipro will see negative growth, minus 0.5%. FY27, a modest 1.7% growth. Margin estimates too have been brought down, and they anticipate a very meager 2.5% EPS growth over the next 3 years.
All right. Rima, thanks very much for that. Amrish, any picks here in the IT space? You know, what's the risk here? Is the risk more downside, or the margin, the risk is on the upside after tomorrow when we hear from TCS?
No, I think the risk is on the upside, because the way these stocks have corrected, like we should also remember that they have underperformed during that whole run which we saw in the last couple of years. And in the last couple of months, we have seen a decent amount of underperformance. I mean, something like a TCS has lost more than 30-35% from the highs, like recent highs which we have seen. The issue is not direct. It has got nothing to do with tariffs directly on the IT space. So there's no tariff on that. The fear is of a slowdown in the US. So that's a question mark. Slowdown, yes or no? And in case of a slowdown, I mean, will discretionary spends, go away? No, it can't, because they need to have the systems up and running. The question is on the non-discretionary spends. Will it become zero? Again, the answer is no. It can reduce to a certain extent. So as against that background, I mean, if you have the stocks correcting so much and the negativity is so high, I think it's a good time to start cherry picking, especially the leaders in this space. Maybe you may have to hold on for the next 12 to 15 months, may not get an immediate upside. But then from these levels, the downside seems quite limited. And I think by tomorrow evening, we should have the management commentary from TCS. And that will also possibly throw more light on what are the risks they're expecting.
Shrikant, any strong trades here, stock-wise?
No, stock-wise, like I said, I would prefer to go with the leaders at this point of time. That's not only for this sector; it's across sectors.
Right.
Because when things are going wrong, especially when the market men feel that things are going wrong, you should go in for the leaders in that space. And here, I would surely go in with something like a TCS, Infosys, as well as HCL Tech.
All right, 10 seconds, Shrikant. Any trades?
Yeah, I think. Prashant, these FMCG stocks, they are doing well. And in that space, Tata Consumer looks good to create some long positions.
Tata Consumer. Okay. All right. Gentlemen, thank you very much. Out of time. Appreciate you joining us with all of that perspective and that commentary. We'll leave you with some commentary from noted economist Jeffrey Sachs. My colleague Shireen spoke with him. He believes that Trump is single-handedly wrecking the global economy. And he's got some pretty strong advice for India. And as India looks to negotiate with the US under the Trump presidency. Listen in.
India really needs normal relations with China. And India should appreciate this is a great civilization, and this is a country that's going to play a huge role in the world in the 21st century. I mean, a huge role in the world on all sorts of things, on culture, on economy, on technology, on global peace. Yes, have good relations with the U.S., but don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement.
Cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape, and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for 9.56.
Welcome back. Let's actually get you some corporate opinion. This is a CNBC TV18 exclusive. Peter Elbers, CEO of Indigo, says that he expects the airline to achieve double-digit growth by next year. Listen in.
If you look to the public DGCA data for the month of Jan and the month of Feb, yes, they actually look very, very positive and reconfirming that growth. So the underlying demand and the underlying dynamics are good. So we have been able to live up with our capacity guidance. I mean, if you take a ballpark number for aviation, and I would guess for hospitality, it's not dissimilar. GDP times 2 in a market which is underpenetrated. So if we take that 6 to 7% of GDP growth, which is taking place in India, you have a kind of figure where the growth is ended. For next year, we estimate, again, a early double-digit growth number going forward.
All right, that's Interglobe Aviation. Before we wrap, let's talk about some of the key events to watch out on Friday. Vamakshi is here with the latest. Vamakshi.
Well, Surbhi, tomorrow is a market holiday for us, but that will not stop some of the economic cues from trickling in. Lots lined up actually in tomorrow as well as day after. April 10th, keep an eye out on the US CPI as well as the initial jobless claims. China's PPI data will also be out tomorrow, so keep an eye out on that as well. Come April 11th, India will be disclosing the industrial production data. From the US, we expect to see the PPI data, while the UK will also be reporting its GDP numbers. The earnings season is now kickstarting. April 10th, that is tomorrow, we'll be keeping an eye out on numbers from TCS as well as Angel One, as well as Anand Rathi, I beg your pardon. And apart from that, we'll keep an eye out on China's 34% additional tariffs, which will take effect on the US starting tomorrow onwards. On Friday, we'll also be keeping an eye out on the data that comes from AMFI on the mutual fund industry monthly data. So those were some of the important events that you need to keep an eye out for.
All right, Vamakshi, thank you very much for that. And with that, it's curtains on this edition of Markets Forward. More news and updates coming up right here on CNBC TV18.
In electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports through all of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcomp, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to the state's export engine. And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in partnership with global electronics manufacturer Flex.
Cisco's partnership and the announcement made a huge difference, not just for Flex in India, but also in industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing is more down the value chain coming in, more components down the value chain. The entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's output. We would definitely want to go up.
The groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn has committed 13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanath.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US President Donald Trump's reciprocal tariffs on nearly 100 countries, including a 26% levy on India, kicks in. China hit with a total levy of 104%. Beijing vows resolute and forceful measures to protect its interests. Trump says countries are calling him dying to make a deal, also threatens farmer tariffs very shortly. The Trump tariff sell-off resumes across the world. Stocks tumble across Asia and Europe, but China bucks the trend thanks to strong domestic buying.
I'm Sanjay, but I'm not Sanjay of Mahabharat to be able to, foresee that far.
Reserve Bank cuts repo rate by 25 basis points as expected, changes policy stance from neutral to accommodative. Governor raises the red flag on tariff, says he worries more about the impact on growth rather than inflation, refuses to predict where rates are headed amidst the tariff wars. RBI cuts GDP forecast for this fiscal by 20 basis points to 6.5%, highlighting global risks and the tariff tensions. Also cuts inflation forecast, citing greater confidence in aligning with a 4% target over a 12-month horizon. RBI announces a comprehensive review of gold loan rules, sparking a sell-off among top lenders. Central Bank also promises to expand the scope of co-lending arrangements to all regulated entities. Weak global cues dent Dalal Street. Sensex loses over 380 points. Nifty drops below 22,400. Rupee weakens for the 4th straight session against the dollar. External Affairs Minister Jaishankar says it's impossible to quantify the impact of US tariffs, remains hopeful of a bilateral trade deal, saying India is the only nation which has reached an understanding in principle with the Trump administration.
Don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement.
Noted American economist Jeffrey Sachs warns about getting closer with the United States at the expense of its ties with China, says India should not be anti-China to please the United States. That's an exclusive. Indian government approves a 63,000 crore rupee deal to buy 26 Rafale marine jets from France. The government-to-government deal is expected to be signed shortly. All right, the big story this evening, US President Donald Trump's reciprocal tariffs on about 90 countries took effect today. The sweeping tariffs, which hit US allies and adversaries alike, are in addition to a 10% baseline levy, which came into effect last Saturday. The tariffs include a 26% duty on all Indian goods exported to the US. China has been hit the hardest by the tariffs with a 104% levy. The hike consists of a 20% tariff levied in March, followed by another 34% announced on 2nd of April and an additional 50% confirmed this week. The White House said that the new tariff structure follows through on Trump's ultimatum to Beijing to roll back its retaliatory duties. China has promised to take resolute and effective measures to safeguard its interests. The country's foreign ministry maintained that they're ready to fight till the end if the US insists on waging a tariff war. The ministry also expressed China's willingness to negotiate, but insisted that it will not follow the USA's current approach. No country has successfully secured a formal exemption from the newly imposed US tariff so far. However, Trump said that his government was working on tailored deals with trading partners. The White House has said that it will prioritize allies like Japan and South Korea. Speaking at a dinner with Republican lawmakers, Trump insisted that countries were quote-unquote dying to make a deal.
This is the largest transaction in the history of our country. And don't let some of these politicians go around saying, because I'm telling you, these countries are calling us up, kissing my ass. They are dying to make a deal. Please, please, sir, make a deal. I'll do anything. I'll do anything, sir. And then I'll see some rebel Republican, some guy that wants to grandstand, say, I think that Congress should take over negotiations. Let me tell you, you don't negotiate like I negotiate.
Well, the ratcheting up of US-China trade tensions, followed by Trump holding his ground on the historic tariff levies, weighed on global equities, from Wall Street to Europe to Asia. Stock markets remain terrified. The sell-off on Wall Street continued after a short-lived relief rally. The US equity market lost 11% of their value in the last 4 trading sessions. The stocks of top 7 tech companies, colloquially known as the Magnificent Seven, collectively lost over $2 trillion in market cap during this period. Apple and Nvidia alone accounted for over 50% of this erosion. This sell-off resumed across the Atlantic after a one-day break. The frontline indices all trading with losses in the range of 3%. China bucked the sell-off trend in Asia thanks to strong buying from domestic buyers. In fact, mainland Chinese investors bought Hong Kong stocks worth a record $4.6 billion as well. The Japanese Nikkei, the South Korean Kospi ended in the red back home. A volatile day on Dalal Street saw the benchmark indices ending with cuts of 0.5%. However, the Nifty and Sensex ended off the day's lows. The IT sector was the biggest laggard. The RBI Monetary Policy Committee has taken a dovish stance to counter the uncertainties linked to US President Donald Trump's sweeping tariffs. As expected, the MPC decided to cut the key repo rate by 25 basis points to 6% for the second time in a row. The MPC also made a unanimous decision to change the stance from neutral to accommodative, signaling room for either a pause or more rate cuts in the coming days. The MPC revised the growth forecast for FY26 to 6.5% from 6.7% earlier. The forecast for the first quarter has also been trimmed by 20 basis points. RBI Governor Sanjay Malhotra highlighted that the trade tariffs measures have clouded the global economic outlook, posing new headwinds for growth and inflation. However, he expressed more concerns about the impact on growth than inflation. The MPC expects inflation to moderate to 4% in FY26 as against 4.2% earlier. Now, inflation during the first 3 quarters is expected to be within 4%. Governor Malhotra said global uncertainties could lead to pressure on the Indian currency and imported inflation.
The dent on global growth due to trade frictions will also impede domestic growth. Higher tariffs shall have a negative impact on net exports. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern.
Well, Lata Venkatesh joins us now with the editor's take on the RBI MPC's dovish cut. Lata.
My take would be it was more dovish than expected, and it has promises for more dovishness to come. So that's why I think it was an elated market, an elated ecosystem. Why do I say more dovish than expected? 25 basis was always expected, but we didn't get a majority vote when we polled people for the change in stance. So that's clearly more than what the market expected. Again, the growth cut was not quite the unanimous view in the market. The fact that it is cut is an indication that they're seeing challenges to growth. That's always a sign that, you may have to help growth with few more cuts. The CPI cut was clearly a surprise. Most people thought that they would, hold on to their horses. It's also the statement that accompanied. The governor's or the MPC statement is, as per projections, there is now a greater confidence of a durable alignment of headline inflation with the target. Up until December, a dozen policies the MPC has told us that our goal is to use policy to align inflation durably to the target of 4. This durable alignment was a goal. And lo and behold, now the governor is saying it is durably aligned to 4%. So that, again, was something the market was very elated about. It confirms the dovishness. And finally, in answer to a CNBC TV18 question on the neutral rate, let me tell you that everybody was working towards 5.5 as the terminal repo rate in this cycle. We started at 6.5. We are now at 6, and it is expected it will go up to 5.5. How do you arrive at that figure? You achieve 4% inflation. 1.5% is seen as the real rate, which the economy needs. So 4 plus 1.5, 5.5 was what everyone was working with. The governor gave two signs. One, that when he is giving the forecast of inflation for all the months of 2025, inflation is going to be below 4%, between 3.6 and 3.8. And secondly, when we asked him about the real rate, he said RBI studies show it is between 1.1 and 1.9. There was something about his answer which made people feel that it would be okay if the real rate were even towards that 1.1% mark. Put the two together, the market is now almost a majority expecting that the risk is of the repo rate going below 5.5, probably to 5.25. There are many reports that you will hear from brokerages on that score. So that, again, for me, is a sign of more than expected dovishness to come.
Right, thank you, Lata, for that. On to the currency markets. The rupee extended its losing streak for the fourth straight session, falling against the US dollar. A weaker Chinese yuan and sustained foreign investor outflows dragged the currency down. The fall comes despite a dip in crude oil prices and a softer dollar. On to all the action from the commodity space. Crude oil prices fell to its lowest level in over 4 years after USA's 104% tariffs on China kicked in today. The escalating trade war between the two largest economies sparked demand concerns and a rising supply outlook. Gold prices gained as Trump tariffs boosted safe haven buying. The yellow metal, which is above the $3,000 per ounce mark, was further supported by the weakening dollar. Meanwhile, the crypto market, which came under pressure after Trump's tariff measures, is recovering. Bitcoin, which briefly slipped below $75,000 yesterday, is now trading above the $77,000 mark. Shares of pharma stocks fell in early trade. This after US President Donald Trump signaled at a major tariff on pharma imports. Speaking at an event, Trump added that this move is aimed at encouraging drug companies to shift their operations to the United States. Remember, the Trump administration had exempted pharma and semiconductors from the scope of tariffs, only to reverse his decision soon after.
The same package in our country compared to like London and other places is sometimes 10 times more. 10 times more. But we're going to do something that we have to do. We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here. And they're going to be opening up their plants all over the place in our country.
And staying with tariffs, External Affairs Minister S. Jaishankar said that India is trying to negotiate a bilateral trade agreement with the United States by the fall of this year. Speaking at the Rising Bharat Summit, the minister said that the Indian government is the only nation that has reached an understanding with the US to have an agreement on tariffs. He said that it's not possible to speak about the impact of tariffs as yet.
I don't think it's possible to speak about what would be the impact because we don't know. What is our strategy? I think that's pretty clear. We decided that we will engage the Trump administration early on this set of issues. We were very open with them, very constructive with them, as they were with us. What we agreed to do was to try to negotiate a bilateral trade agreement by fall of this year. To the best of my knowledge, and I could be corrected here, I think we are the only country after President Trump has assumed presidency the second time, which has actually reached such an understanding in principle. In our case, our strategy has a goal, and the goal is to see whether it's possible to actually deal with this situation by concluding a bilateral trade agreement. And I should add that in an interesting way, this has long been our objective. I've always wondered why it takes such a long time. Frankly, I've never figured it out. You tell us. No, I've never figured it out because, I see, we have trade negotiations which have been going on for decades. And the negotiators meet, I think, every 6 months or 3 months or 4 months. And I wonder why. I mean, if I were doing a negotiation, I'd be at it till I got the job done. And I think today, when I look back at the last, since the Prime Minister's visit, I'd say mid-Feb, so we're about 6 weeks since then, we've actually had multiple rounds in this period. I think we've had more periods, discussions with the Americans in the last 6 weeks than I suspect we've had with the Europeans in the last 2 years.
Noted American economist Jeffrey Sachs has warned India about getting closer with the United States at the expense of its ties with China. Speaking with Shireen Bhan, he said that India should not be anti-China to please the United States. He also added that the US President Donald Trump is wrecking the global economy.
Market capitalization in 2 days, you're probably on the wrong track. The United States is on the path of wrecking the world economy once again. This is not U.S. policy. This is not congressional policy. This is not U.S. public policy. This is Donald Trump's policy. He is single-handedly wrecking the world economy. And I think the damage is going to be done before it gets undone. India really needs normal relations with China. And India should appreciate this is a great civilization, and this is a country that's going to play a huge role in the world in the 21st century. I mean, a huge role in the world on all sorts of things, on culture, on economy, on technology, on global peace. Yes, have good relations with the U.S., but don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement. It's the end of American leadership, I would say. It's the end of other countries looking to the United States as a stabilizer, as a rule-based order, although that was quite frayed already, but now no one could utter those words with regard to the United States. Similarly, China was not in any way isolationist. It was the major trade partner of probably 150 countries in the world. But China has aimed for the last decades to be a responsible participant in the international system. China now has to take a more leadership role. I think China will have to enable the renminbi to play a more international currency role. It's been very gradual, step by step, but I think it's going to have to accelerate.
All right, it's time for a short break, but coming up next, Ather Energy has revised its IPO expectations again. That and much more when we return.
rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over leveraging of customers to credit cost to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, X of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023 and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equita Small Finance Bank. Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, now underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at
Welcome back. The government will acquire 26 Rafale marine fighter aircraft from France. Reports have suggested that the deal will be valued at over 63,000 crore rupees and is expected to be signed in the coming weeks. The deal will include 22 single-seater aircraft and 4 twin-seater variants. The jets have been specifically designed for the Indian Navy's operational requirements. Russian President Vladimir Putin has invited Prime Minister Narendra Modi to attend Russia's Victory Day celebrations on the 9th of May. Reports have said that the visit is currently under discussion between the two nations. Moscow has expressed hope that Prime Minister Modi will attend the event. Russia is celebrating 80 years since the Soviet Union's victory over Germany in the Second World War. More international news. Israeli forces continue to bomb Gaza, killing at least 26 Palestinians yesterday. Doctors Without Borders has said that Israeli attack hit close to its clinic in a so-called safe zone in Gaza. Reports say Israeli forces also bombed a charity kitchen in Khan Yunis on Monday. Atta Energy has revised its IPO expectations again. Sources have told CNBC TV18 that the electric two-wheeler maker is now targeting a post-money valuation of around 12,800 crore rupees. Rachna Dhanrajani joins us now with the details. Rachna, please take us through to the roadmap.
That's right. Electric two-wheeler maker Ather Energy is once again revising its IPO expectations. Sources have told CNBC TV18 that the company is now targeting a post-money valuation of around 12,800 crore, lower than the earlier number of 14,000 crore rupees. Consequently, the IPO size is also likely to be scaled down to 2,900 to 3,200 crore rupees. That's about $350 to $375 million compared to the earlier target of about $400 million. This is the second instance of Ather cutting its valuation ahead of its public debut. The company had initially eyed a much higher range between 17,000 to 20,000 crore rupees, but has had to recalibrate given market conditions, expectations and lack of investor enthusiasm. The issue will include both a fresh issue and an offer for sale, with early investors likely to dilute their part of the stake. Hero MotoCorp, which holds about 40% in Ather, is not expected to sell any shares in this IPO round. We reached out to the company for a comment but haven't received a response yet.
Right, thank you, Rachna, for that update. Let's move on to a CNBC TV18 exclusive. Indigo's CEO Peter Elbers has said that airport charges cannot be as high as half the price of a flight ticket. Speaking with CNBC TV18's Mangala Malu, Elbers said that the airlines are in constant discussions with the airports to strike a fine balance.
Airports increasing their prices, it's a matter of a discussion taking place in India and outside India. I think where I would like to sort of engage in a discussion with the airports, if the average prices in India are 6,000 rupees for a ticket, you don't want to have airport charges of 3,000 rupees, right? And that's exactly where I think we need to find a good balance between what is the price point for customers and what is the airport charges.
The Indigo CEO was speaking at the sidelines of an event where the airline announced a partnership with global hospitality company Accor. Interglobe's managing director Rahul Bhatia also spoke with CNBC TV18 on the sidelines of the event about the partnership. He said that the two entities will develop a strategic collaboration through their loyalty programs.
In many ways, I think Interglobe demonstrates that it's long on India, and we are certainly very long on Accor. And to your earlier point, this arrangement has got nothing to do with what may happen in the short term. In the long term, the growth in India is only going to go one way.
And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV18.
$20.25 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, which along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of the borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized. Hence, incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money with me, Surabhi Upadhyay. Now, a lot of you would have been watching the market headlines glued to your screens, looking at the tremendous volatility that has hit markets around the world, not just in India. And you could be talking equity, you could be talking fixed income, and even currencies. It's all going topsy-turvy thanks to Trump's tariff plan. The question that a lot of people are asking is what should they be doing when it comes to their investments, our mutual fund holdings? Is this a great time, a great dip to deploy more money? Should you wait? And if you want to add more money, then what kind of funds are perhaps best suited for the new normal, this new environment that we are in? Well, to help us understand some of these issues and navigate them, we have with us Harish Krishnan, co-CIO and head of equity at Aditya Birla Sun Life AMC. Harish, thank you so much. I know it's extremely busy. You folks in the office must have had lots of, turbulent mornings and evenings. So really appreciate you taking out the time to join us here today.
Thank you. Delighted to be on your show, sir.
Well, the reason we wanted to do this and do this now, Harish, is, as I said, we've got a lot of viewer queries, and I'll get to them in just a bit. People have learned after COVID that dips are usually the best time to buy. but it's still confusing.
Sure.
And it's still a little scary. So your opening thoughts?
No, so, contrarian thinking doesn't come naturally to human beings. When things are going well, good news gets amplified, and we start to look at echo chambers which amplify that news. And similarly, when bad news comes through, the same reverse process happens. Good prices and certainty don't come together, okay? And therefore, it is important to cultivate a habit of being contrarian. Now, being contrarian for the sake of contrarianness never really works, right? Just because everybody else is doing something, you're doing something else.
Different.
I don't think we want to be that. But we need to have a framework of asset allocation, okay, which helps us navigate these kind of uncertainties. Because in markets, uncertainties are a feature, not a bug. It's not an aberration that you have all of these things coming through, right?
Yeah.
Every now and then you will have new events, some business cycles going bad, etc. It's all part of the overall game. Now it is up to us how we react to these developments rather than just going by what, say, the newspaper headlines tell us. To kind of second guess and to think maybe half a step ahead of what the newspaper headlines are today talking about, rather to think about what the newspaper headlines can be talking about 6 months down the line. I think if we are able to cultivate that, we get into a much better mind space wherein we can take far more intelligent decisions about how we manage our own wealth.
So I take your point, and I'm not going to argue against that at all. I think, and history has taught us, n number of times, that when the market is really capitulating, if you're able to deploy some money, invest at that time, that is when you make outsized returns over longer periods of time. So no arguing that. But my question here is that COVID was relatively easy from a market standpoint. It was a nice V-shaped recovery. The market didn't look back. It just kept, tearing higher and higher, at least for the next 1-2 years, right? Now, given this new situation of tariffs, would it be a little silly to expect that kind of a quick recovery for people who are willing to punch in the buy orders now?
So let us examine the market correction, because it's been in a corrective phase for now about 6 months or so. From September of last year is when it started correcting, right? So we were going through a phase of valuation-driven excesses getting corrected out over those 6 months, and there are multiple reasons. Earnings kind of slowed down. There has been some kind of global turmoil, etc., right? So what became a garden variety kind of a correction, which is more driven by business cycle and, say, earnings slowing down.
A garden correction, garden variety correction.
Garden variety, because it is but obvious that you see a 10-15% drawdown once a year. It is nothing unusual. Of course, post-COVID, maybe those occurrences have been so far and few that people's memories have kind of got wiped out from that. But this is pretty much normal, right? So from a very natural garden variety kind of correction, we have actually now gone into a man-made reset, which is what Mr. Trump with his tariffs have done. Now, has there been such man-made reset buttons in the past? Absolutely. In fact, in our own country, I mean, if you look at, say, November of 2016, wherein we had demonetization, we had a reset button being pressed, right? And we know how that kind of eventually turned out, okay? Yes, during that phase of reset, yes, is there absolute certainty? Absolutely not. But what we have seen time and time again is that while these events may be new, it could be a liberation day, it could be tariffs, it could be wars, it could be geopolitical, a number of reasons that can cause it. The response of the market participation or of the market participants has always been consistent over the last 500 years, which is the behavior of market participants oscillates between greed and fear, right? Now, if you are able to harness signals which kind of say, are we getting more greedy as a segment, or are we getting more fearful as a segment? Then we have a way of second guessing the market and trying to see that can we be half a step ahead. And at this point of time, it does appear that we are a bit too much fearful about markets. There are multiple indicators, and we can speak about what are the different kind of indicators that we look at that gives us that kind of a sense.
So that, in a sense, is the crux of the conversation that we're going to have over the next, 15-20 minutes. That how do you overcome emotional biases, extreme fear, extreme greed? Right now we're dealing with extreme fear. How do you overcome that to ensure that you're investing right for the future? Are there some products in the mutual fund industry that help us do that? If I might be too fearful, but if I'm disciplined in that product, in that particular fund, then can the fund do it for me? We'll get to that in just a bit, but I also want to take some viewer questions, which we are getting along the way to kind of answer them. We'll start off with this one. This is a query from Harsha Subramaniam. He's asking whether it's a good time for fresh deployment into mutual funds, given the sharp correction in the market and in fund NAVs. And he's saying, would a multi-asset fund be a better approach for a fresh lump sum investment right now than a large cap fund? Harish?
So yes, I do think that, compared to what it was 6 months ago, where there was a lot of overvaluation, things have kind of settled down quite well. Our macro fundamentals are extremely strong. I'm saying India as a country as a whole. And companies are in very good shape. The balance sheets are in very good shape. So it is just that the investor expectations and exuberance had kind of gone a bit too much, which has kind of corrected itself. So typically we've seen, say, a median stock correcting by about 35% in the last 6 months, which is generally the threshold of all previous corrections, unless there has been, say, a global financial crisis or a COVID, where the drops have been slightly more. So you're getting into a reasonable zone where there is some amount of margin of safety, unlike what it was. Right? Sure. Now, coming to where do we deploy it?
Exactly.
Okay, do we get into a traditional diversified fund, or do we get into an asset allocation?
Large cap, flexi cap, asset allocation.
Yeah.
I think this is a very common question that a lot of people have at this point.
So let me start out with saying that, asset allocation solutions provide investors to give a larger sum of their monies in a more tax efficient manner by investing across asset classes, right? And this is borne by data, right? So if you look at an average folio value of any other category of mutual funds, including large cap, tax saver, mid cap, small cap, etc., the average folio value is roughly about 1.5 to 1.6 lakh rupees.
Okay.
But if you come to an asset allocation product, be it that of, say, a balanced advantage fund, which has got a slightly longer vintage, or say a balanced fund, okay, that number comes to close to about 5 lakh rupees. Okay. So we already are seeing an average Indian investor deciding to put big amounts of money in these categories.
In the asset allocation.
In the asset allocation products. Now, why is it that they do it? Asset allocation, firstly, it invests across multiple asset classes, right? Which makes it much more tax efficient than you personally investing. That is one. Secondly, the weightages given to various asset classes are also determined by the fund manager, typically in conjunction with a model. Okay, which tries to reduce some of these emotional biases that otherwise plague individual investment, right? So that's the second thing. And thirdly, the benefit of allocating across asset classes is that it's the same nursery, kindergarten kind of a thing. Don't put all your eggs in one basket.
Absolutely.
Primarily because that each asset class responds differently to uncertainties in different points of time, right? And therefore, by putting it together, your overall volatility, or let's say the BP of investment, okay, that reduces quite dramatically compared to putting in a pure equity fund.
So, coming back specifically to Harsha's query, and the multi-asset category is being pushed very much by the mutual fund industry as well as a good tool to diversify across asset classes. In terms of return expectations, since he's asking specifically about large cap funds versus asset allocation, multi-asset funds, over let's say a 3 to 5 year period, what should my return expectation be from a MAF, the multi-asset fund, versus a traditional large cap?
Sure. See, any asset allocation product has a trade-off. There is no free lunch, as they say, right? Okay. Now, a pure 100% equity, be it in large cap, mid cap, or small cap, over a 5-year, 7-year, 10-year period will always give higher returns than, say, an asset allocation product. But the idea of an asset allocation product is to get you better sleep, lower BP, lower volatility, right? So, over the next 3-5 years, I would think that the returns are broadly similar. So, for example, let's look at the past track record. Okay. So, if you look at, say, some of our balanced funds, or say the balanced advantage fund, because they have slightly more vintage. MAF as a category is new, so I'm using some other parallels, right? If you look at, say, our own balanced advantage fund, we've captured about 85% of the market return, okay, with the volatility of 66% of that. Right?
Okay.
So if equity markets give, say, X amount of volatility, a product like BAF gives you 0.66 of 0.66 amount of the volatility, right?
Yeah.
But obviously returns over here are, say, Y. here the returns are 0.8 or 0.85 times Y. Okay. So that is the trade-off that one is talking about. Now, the greater peace of mind that it provides you helps you allocate more amount of money.
Sure.
So if you're a first-time investor and you're confused, and you're thinking that, so much jargons are being spoken about, this becomes a very simple product or a destination wherein an investor can put in a larger sum of money, where the allocation happens automatically in a very tax efficient manner.
Right.
Okay. There is a significant tax incidence when you do it yourself. In a fund product, that tax incidence comes down meaningfully.
Absolutely, because the fund is doing the churn, you're not doing it yourself. So, that's on MAFs and BAFs. I just want to make a distinction over here. We spoke about multi-asset funds because that was one of the questions that we got. But otherwise, going back to the concept of rules-based investing, there are two categories that stand out here. When the fund itself, the product itself, is going to do that rebalancing for you, basically the shift between, let's say, equity to fixed income or fixed income to equities, or maybe even some other asset classes. Now, here we are talking about the quant category, quant funds which do this, and the balanced advantage or the dynamic asset allocation category that Harish, you spoke of. Now, help us understand between these two, and quant is also a very, very new category. If we talk about balanced advantage, which is older, how do balanced advantage funds typically work in a market like this? How do they decide that now it's time to load up on equities? And how do I know? And is it the same formula, the same pattern that all BAFs follow? As an investor, I mean, those are the details that I'd want to have.
Sure. So, see, fundamentally, be it fundamental analysis, technical analysis, quantitative analysis, behavioral analysis, there are many ways to invest money, right? There are only two signals that one is looking at, okay, to keep things simple. First is trend following or momentum. Even in fundamental, when we are looking at an annual report, all we are saying is, okay, this has been the pattern of, say, sales growth. Is it likely to continue basis certain expectations, right? So that is trend following, okay? The second signal that we talk about is reversion, which is that has it gone too much, too far, that it tends to reverse. Now, what we've kind of discovered over our journeys of investing is that trend following is very good when we go down the curve, which is while we are looking at stocks to identify, okay? Whereas reversion to mean, okay, works very well when we are talking about, say, asset classes, market caps, etc., which are higher up the plane. Right? So when it comes to asset allocation products, we typically use mean reverting kind of variables to focus as to when do we go contrarian, right? But when it comes to, say, quant funds, where the mandate is, of course, our mandate is to be fully invested at all points of time. So we're not taking a cash call. And over there, we are primarily looking at some variation of trend following to get the maximum bang for the buck over there. So this is a very aggressive product. Okay? But both of them work with a similar premise that there are emotions in both ends, be it in trend following or be it in reversion to the mean, right? The idea of rule-based investing in both these categories wants to eliminate that element of behavioral bias by making it into a programmatically algo-driven or flowchart-driven, etc., which helps people or the fund manager decide what is the right way. Because uncertainty impacts everyone. Be it an amateur investor or a professional investor. And these rules, therefore, help us doing. Now, coming to balanced advantage fund or those kind of categories which look at reversion to mean. Okay. Now, like I said, the behavior of people are always mean reverting between greed and fear, right? Now, there are multiple ways in which this greed and fear signal can be manifested and harvested, okay? One simple way is the valuation, be it, price to earning, price to book. You generally see, for example, in India, when price to book crosses 4 times, it's generally seen as an overheated, exuberant market, and when it comes below, say, 2 times, generally seen as a market in it. So that's a very simple valuation-driven thing. You also have, say, Cape Shiller, etc., more complicated formulas as far as valuation is concerned. But we also know that just relying on valuation is not going to do the trick, because markets can remain irrational for much longer.
Absolutely.
Right? So therefore, we use other indicators also. So what are the other indicators? Some of the indicators can be, see, extent of valuation mainstreaming. So let's say if there are, say, 500 companies or 100 companies in your universe, what percentage of companies are beyond...
How many are overvalued?
Overvalued.
Yeah. So it gives you a sense the market's maybe in an exuberant
zone. So that could be one.
Yeah.
The second way or another way in which we can look at is the number of multi-baggers that have happened in a short span of time.
Okay.
So the number of 10 baggers in, say, 3 years or 5 years, that also follows generally a mean reverting kind of thing. Similarly, if you look at, say, the number of stocks which are making all-time high, that also follows a very mean reverting kind of a thing, right? Similarly, if you look at, say, the number of stocks in portfolios of various fund managers, you generally see that in a bull market, you will generally see a many names getting added.
Right.
Okay, more news stories, more IPOs, all of that keep getting added. And in a bear market, you see the complete reverse. So when you see these points of inflection, that is when you start going the reverse direction and saying that, okay, now maybe we are getting a temperature check from the market that there is too much of fear. And therefore, it makes sense for us to go contrarian. So the idea of these products is not to time the markets. We are just trying to gauge the temperature of the markets and trying to be contrarian to that temperature.
Okay, all right, got it. So these are some of the indicators or some of the the rules that funds follow. I'm talking about the balanced advantage category or the dynamic asset allocation category, even quant funds. These would be some of the parameters that they follow to decide whether it's time to have more equity or more fixed income or vice versa. Just want to take a break by talking about the returns. Maybe we can pull this up on the screen as well. So a balanced advantage fund, what kind of return can it give you over longer periods of time? We've taken the Aditya Birla Sun Life Balanced Advantage Fund for an example, I mean, in the sense of an example. So the 3-year return, and these are rolling returns, the 3-year return is about 11.3%, which is actually better than the category average. The 5-year return is about 10.7%. So this is typically, what these funds are doing. Just not bad returns. I mean, 10 to 12% returns over long periods of time, perhaps very reasonable returns to have. Quick break. On the other side, more of your queries answered. Just a moment and we'll be back.
Let's talk money.
China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steelmakers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty, along with the onset of a seasonally good quarter, could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC TV18, Mumbai.
Surabhi Upadhyay, and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC TV18.
Celebrating 25 years of CNBC TV18.
From sharp insights in the political arena to all the excitement from the world of sports.
Let's talk money.
Welcome back. You've been sending in your mutual fund questions to us, so let's straight away get to them and try and answer as many as we can. The first query is coming in from Sam, and all of them have come in to me on Instagram. By the way, you can always reach out to us on Insta or email and social media. He's saying that I want to start an SIP in about 3-4 funds. What would the ideal split be in terms of the type of funds where I should divide my money in? Harish, I know this is very incomplete information for you to answer on, but generally, I mean, if someone has, let's say, X amount of money for immediate lump sum investing, how should they divide it?
So I would say that, put majority in an asset allocation because you're putting in a lump sum amount, right? And that will automatically take into it. The second thing is you need to expose yourself into segments which are not covered by this asset allocation product. So maybe either you can get into thematic funds or you can get into, say, small cap, mid cap, because generally the asset allocation products are more large cap biased, right? So a combination of these three, I would say bulk of your money in an asset allocation kind of a product, stroke flexi cap. These are the two things that I would say would be the fulcrum of it. And then you can have satellite positions in, say, either in a thematic fund. At this point of time, we think banking can be a very good thematic fund. So that could be something that one can look at. And then to get into small cap, etc., which need to be a long term, at least with a 5-7 year kind of horizon.
And he's specifically saying if I want to start SIPs, then it should be the same approach?
No. So if you're doing SIPs, then, the more volatile asset class, the better it is because you're getting better units at this point of time, right? So therefore, then you need to move into, say, small caps or thematics a lot more. So I would still say that the mix needs to change. The core and the satellite still remain the same. But if you're looking more as SIP, the satellite can be a lot more.
Maybe more mid cap, small caps.
And the weightage to the satellite can be more than the core.
Than the core. Got that. Okay. Let's move to the next query. And this is the question coming in from Neil Vakharia. He's saying, I'm looking to invest in a domestic manufacturing fund for the next 5 years. Should I do it, and how should I allocate my money? What an interesting question. We've got someone who's been managing a manufacturing fund. So who better than Harish to answer this? 5 years time horizon, looking to play a specific theme, manufacturing. Is it a good time?
I think it is a good time for a long-term investment. There is a massive amount of reset of supply chains, and we all know about what Trump is trying to do. I think India is a very large market, and India is importing a lot of stuff. A lot of those supply chains will be built in India. So I would say that manufacturing is in a very good shape from a medium to long-term perspective. I would definitely think, given the fact that it has done so well in the last 3-5 years, the better route would be to come through an SIP, because there is likely to be some kind of consolidation, and for the investor to get the benefits of that consolidation.
Okay, thumbs up to investing in a manufacturing fund, but stagger it out. That's the advice. Quickly, time for one last question. This is from Subhashish Day. I think his question is probably, it echoes everywhere, because he's saying, is there any sign of recovery in mid-cap funds? Harish, everyone is, and I do this for the regular market, shows as well. Everyone is still coming and saying, no, large caps are better. There's still, valuation discomfort in mid and small caps. People with these funds are wondering what next.
So I think that, it's only a question about expectations and horizon that is needed. I think there are some great Indian mid-cap companies and small-cap companies that are going to create outstanding wealth. It's just that a lot of that wealth got created in such a short time span that there is going to be some amount of prolonged consolidation phase before you get that.
So low return period, be ready for it.
For at least the next 12-18 months, I would say. But then eventually, yes, we do think that they will create significant wealth. India is a wealth-creating market. There is no doubt about it. It's only about managing your expectations and committing to a slightly longer-term horizon than looking at it every 6 months or every 12 months.
Okay, I think that's very sane advice, and that's a good optimistic note to end on. Don't look at it as a short sprint. Look at it as a long marathon. And perhaps you'll be, quite happy with your mutual fund investments. Harish, thank you very much. This was very helpful. Thank you for dropping by and giving us all this wisdom today on the show. Thank you. Well, with that, we are out of time on this edition of Let's Talk Money. Remember, you can keep reaching out to us. Tell us what do you want to hear more on, what questions you want answered, and we'll be here for you again, same time, same place next week.
Let's Talk Money.
We are here at the CNBC TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of
Hello and welcome to our special broadcast. I'm Arundhati Ramnan and here are the headlines at this hour. The global trade war escalates. China hits back with an 84% tariff on US after Trump administration imposes a levy of 104%. The US reciprocal tariffs on nearly 100 nations, including a 26% levy on India, kicks in today. Trump says countries are calling him dying to make a deal, also threatens pharma tariffs very shortly. The tariff sell-off resumes worldwide. Stocks tumble across Asia and Europe, but China bucks the trend thanks to strong domestic buying.
I'm Sanjay, but I'm not Sanjay of Mahabharat to be able to, foresee that far.
Reserve Bank cuts repo rate by 25 basis points as expected, changes policy stance from neutral to accommodative. Governor raises the red flag on tariffs, says he worries more about the impact on growth rather than inflation, refuses to predict where rates are headed amidst the tariff wars. RBI cuts GDP forecast for this fiscal by 20 basis points to 6.5%, highlighting global risks and the tariff tensions. Also cuts inflation forecast, citing greater confidence in aligning with the 4% target over a 12-month horizon. Weak global cues dent the Wall Street. Sensex loses over 380 points. Nifty drops below 22,400. Rupee weakens for the 4th straight session against the dollar. External Affairs Minister Jaishankar says it is impossible to quantify the impact of US tariffs, remains hopeful of a bilateral trade deal, saying India is the only nation which has reached an understanding in principle with the Trump administration.
Don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement.
Noted American economist Jeffrey Sachs warns India about getting closer with the United States at the expense of its ties with China, says India should not be anti-China to please the US. That's an exclusive. Indian government approves a 63,000 crore rupee deal to buy 26 Rafale marine jets from France. The government-to-government deal is expected to be signed shortly. The big story this evening, US President Donald Trump's reciprocal tariffs on about 90 countries took effect today. The sweeping tariffs, which hit US allies and adversaries alike, are in addition to a 10% baseline levy, which came into effect last Saturday. The tariffs include a 26% duty on all Indian goods exported to the US. China has been hit the hardest by the tariffs with a net levy of 104%. Expectedly, Beijing has hit back with additional 50% tariffs, taking the total levy to 84% on US imports. The new tariffs will come into effect tomorrow. The country's foreign ministry had earlier said it is ready to fight to the end if the US insists on waging a tariff war. China has also added 12 new American companies to its export ban list. No country has successfully secured a formal exemption from the newly imposed US tariffs so far. However, Trump said his government was working on tailored deals with trading partners. The White House has said that it will prioritize allies like Japan and South Korea. Speaking at a dinner with Republican lawmakers, Trump insisted that countries were dying to make a deal.
This is the largest transaction in the history of our country. And don't let some of these politicians go around saying, because I'm telling you, these countries are calling us up, kissing my ass. They are dying to make a deal. Please, please, sir, make a deal. I'll do anything. I'll do anything, sir. And then I'll see some rebel Republican, some guy that wants to grandstand, say, I think that Congress should take over negotiations. Let me tell you, you don't negotiate like I negotiate.
The ratcheting up of US-China trade tensions, followed by Trump holding his ground on the historic tariff levies, weighed on global markets. From Wall Street to Europe to Asia, stock markets remained under pressure. US equity futures currently trading with cuts of close to 2% after China's latest tariff measures. The US equity market has already lost 11% of their value in the last 4 trading sessions and is expected to see a weak opening. The sell-off resumed across the Atlantic after a one-day break. The frontline indices all trading with losses in the range of 3%. China, however, bucked the sell-off trend in Asia, thanks to a strong buying from domestic buyers. In fact, mainland Chinese investors bought Hong Kong stocks worth a record $4.6 billion as well. Back home, a volatile day on Dalal Street saw the benchmark indices ending with cuts of 0.5%. However, the Nifty and Sensex ended off the day's lows. The IT sector was the biggest laggard. The RBI Monetary Policy Committee has taken a dovish stance to counter the uncertainties linked to US President Donald Trump's sweeping tariffs. As expected, the MPC decided to cut the key repo rate by 25 basis points to 6% for the second time in a row. The MPC also made a unanimous decision to change the stance from neutral to accommodative, signaling room for either a pause or more rate cuts in the coming months. The MPC revised the growth forecast for FY26 to 6.5% from 6.7% earlier. The forecast for the first quarter has also been trimmed by 20 basis points. RBI Governor Sanjay Malhotra highlighted that the trade tariffs measures have clouded the global economic outlook, posing new headwinds for growth and inflation. However, he expressed more concern about the impact on growth than inflation. The MPC expects inflation to moderate to 4% in FY26 as against 4.2% earlier. Inflation during the first 3 quarters is expected to be within 4%. Governor Malhotra said global uncertainties could lead to pressure on the Indian currency and imported inflation.
The dent on global growth due to trade frictions will also impede domestic growth. Higher tariffs shall have a negative impact on net exports. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern.
Onto the currency markets then. The rupee extended its losing streak for the fourth straight session, falling against the US dollar. A weaker Chinese yuan and sustained foreign investor outflows dragged the currency down. The fall comes despite a dip in crude oil prices and a softer dollar. Onto all the action from the commodity space. Crude oil prices fell to its lowest level in over 4 years after USA's 104% tariffs on China kicked in today. The escalating trade war between the two largest economies sparked demand concerns and a rising supply outlook. Gold prices gained as Trump tariffs boosted safe haven buying. The yellow metal, which is above the $3,000 per ounce mark, was further supported by the weakening dollar. Meanwhile, the crypto market, which came under pressure after Trump's tariff measures, is now recovering. Bitcoin, which briefly slipped below $75,000 yesterday, is now trading above the $77,000 mark. Shares of pharma stocks fell in early trade, this after US President Donald Trump signaled at a major tariff on pharma imports. Speaking at an event, Trump added that this move is aimed at encouraging drug companies to shift their operations to the United States. Remember, the Trump administration had exempted pharma and semiconductors from the scope of his tariffs, only to reverse a decision soon after.
The same package in our country compared to like London and other places is sometimes 10 times more. 10 times more. But we're going to do something that we have to do. We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here, and they're going to be opening up their plants all over the place in our country.
On that note, we head into a short break, but more news and updates coming up on the other side. Stay tuned.
Universe to becoming a success story in itself as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and
if you've recognized him, but he was all over television screens last year as their first semi-cryogenic rocket went up Agnikul. So a big round of applause to Srinath and his team at Agnikul Cosmos for that achievement. How did it all happen, Srinath?
Thank you for having me here, Shireen. So yeah, it's been a circuitous long journey, as I think with everything in space. But for me specifically, I did a couple of things outside of space tech, like in finance and electrical engineering and all that, before it all came back to building rockets, which is what I always wanted to do. So we build small rockets that take satellites to space on demand. The one thing that is the biggest surprise for me even today is when we started, we never knew there would be this much clarity in policy. There would be a body to authorize space missions from India and all that. We started thinking, okay, we like to build rockets. If we build something interesting, someone would fly with us. That's how it started. But yeah, I mean, a lot of things have changed. There is now a body to allow these things to happen. I'm hearing about hundreds of startups in the country now. So it almost feels like, you know, another version upgrade for space tech in India altogether.
Well, it clearly is an inflection point, as you point out, for space tech in India. But, you know, the cliche is it's not rocket science. So I want to understand that from you, because you make it sound so casual. We just decided that we're going to create this space transportation system. It's almost as if, you know, you woke up one day and decided this is what I want to do after breakfast. I mean, it can't have been that easy.
No, it was not that easy. And it's that one statement that we can never use in our company, right?
It's not rocket science.
It's not rocket science. We can't say that. No, it was hard and it was easy in different ways, right? The hard part was in terms of getting the quality aspects right, in terms of getting the integration of things right, in getting people from different expertise, you know, specializations to talk to each other, because otherwise everyone ends up building his or her own rocket, and it doesn't add up. But the good part is we have a very strong retired ISRO community in the country, and these people have flown rockets for decades. So you can start off from that, but then the new technology will have to be built in-house. So that's how we have, you know.
So very quickly, and I'm going to ask you to do this for us in a minute so that everybody here understands the kind of innovation that's gone into putting that first rocket that you launched in space. What makes it different? What is the innovative aspect as far as technology is concerned? And even in terms of cost, because I understand it's been significantly much more cost efficient and much more cost effective. So your time starts now.
The investor question. Okay.
The investor question. You're perpetually fundraising, so you never know. There might be somebody watching here.
I think I can answer that any time of the day now. So the satellites, you know, the way in which satellites work have completely changed. So it means you need a new breed of rockets. But if you end up building smaller rockets, it's usually expensive because anything in manufacturing works better at scale. Now you're trying to fight economies of scale. You can't fight economies of scale. That's like it's almost like a truth, right? So you have to figure out technologies that work at this scale at the same cost. So this is where things like 3D printing, you know, modularity and automation, all of these things come in. So what we did in our launch was to prove a bunch of these technologies that we had developed in-house. Say, for example, our rocket engines. It's one of the most spoken about ones in the media, at least, which is it's a single piece of hardware. The entirety of the rocket engine is made by the printer without any interference from a human. Right, so it's almost like you stand back and watch the engine getting made, and then what comes out as a full engine. So that's because only at that, with that kind of manufacturing was the pricing working out. Similarly, our autopilot, and this is one of the other things, right? Because everyone talks about the 3D printed engines, the software team is like, wait, we're also building cool stuff. But it is not as fancy probably to say we've built our own autopilot now, I don't know. But there is a lot of work going on for the, you know, the software aspects of it, the autopilot aspect. The flight was special also because it was a controlled flight. Like it had a vertical liftoff, it had a particular point it had to get to, and it lifted off from our own private launch pad. Just to make that.
And it was a first. It was a first in India. So that again deserves a big round of applause, ladies and gentlemen. It's not easy to do. It is certainly not easy to do.
Yeah, and then you know that comparison is always very stark in my mind. When we wanted to start Agnikul, a lot of people were asking me this question: why are you not doing this in the US? Because I came from there to start this, and from there, and you know, people asking whether it is even legal to privately launch a rocket in the country, to allowing us to have our own private launch pad within ISRO's premises and launch from there. I mean, that's what it's really like a complete version upgrade. It's almost like, you know, the whole sector has seen a completely different shade of what can be done in India.
Absolutely, and you've shown what can be done here in India. Oves, I'm going to come to you next in line in terms of seniority, because you decided to start up when you were all of 21. Take me through the story of Pixel, a boy from Chikmagalur to Bits Pilani. How do you get to this point of being able to create, in your words, satellites that monitor the health of the planet?
Yeah, no, thanks again for having me here. I think it all boils down to an obsession or love for space. Like most kids, I think we can recall going out, looking at the starry skies and being fascinated with it. But from the earliest days, since my dad got me this space encyclopedia for kids, I was obsessed with space. Like I wanted to be an astronaut. Very seriously made up a list of what I need to do to become an astronaut. But obviously that didn't come to pass for a variety of different reasons. But when I joined college at BITS, and I was 18 or 19 at that point in time, there was a student satellite team at the university that was working with the scientists at ISRO. And I was like, whoa, there's actually a team that you can go to where you can actually build hardware that would go to space, taught by people that know how to send stuff to space at ISRO. And my first and second year at college was, outside of class, with more time spent with this team than inside classes, learning how to build a satellite. And then the second more formative experience that came up was when, this was in 2017, Elon Musk was tweeting about traffic in Los Angeles and about the Hyperloop, and SpaceX created a competition out of it. We decided we would participate just because we thought it might be a good chance to meet Elon at that point in time. And to our pleasant surprise, we got through the first stage, and then we took it a lot more seriously, ended up building India's first ever Hyperloop pod in Bangalore, took it to Los Angeles. And so while you were there at the SpaceX headquarters, it was basically the only place outside of space agencies where space was being done at scale, rocket engines being built, rockets being landed back on Earth. That was my eureka moment. I remember, 27th of August in 2017, that I decided, if a private company can do this in the US, I don't see why we can't do this in India. Of course, I was a lot naive back then. So came back from there, looked at what was happening in space. And as a college student that didn't come from a background of money, wanting to build rockets or space stations seemed like very, very far away. But satellite imagery, thankfully, didn't seem that far off. So we worked with different sources of satellite data that were being sent down by ISRO satellites, by other satellites. And we realized that a lot of these satellites can't see some problems that you need to be seeing. For example, if I have a broken bone and go to the doctor, a normal phone camera won't tell the doctor what's wrong. You would need to go beyond the electromagnetic spectrum to see it with an X-ray. Similarly, the satellites and cameras that were up in space today couldn't see crop diseases or methane leaks or pollutants, and that's where you could build a new different kind of satellite called a hyperspectral satellite. And since no one else in the world surprisingly was doing that, I think we were at that right place at the right time where we said, if we build this for the world, we can build that health monitor. And so the plan was we will build and launch our own constellation of satellites.
And do it here in India. And 2024 has been a big year for you. Tell this audience why 2024 was a big year for you at Pixel.
Yeah, so I think, just a few months ago, we launched India's first ever private satellite constellation. Before this, it was only ISRO that used to, thank you, ISRO that used to launch satellites and constellation of satellites. So in 2022, actually, we launched Shakuntala, which was our first demo satellite. That was India's first ever private satellite. But it was a demonstration. It was a prototype. But from getting from that point to just a few months ago, launching 3 satellites at one go, built in India, designed in India, and at the highest resolution, these kinds of satellites that were launched globally. I think, as Sheena was mentioning, India's space has come a long way. So it was a big last few months for us in terms of actually getting those satellites up.
Well, congratulations to you and your team. And I think this is really the answer to can India do it? Can India and Indian startups be innovative? And you've got 3 startups here that prove that yes, it can be done, and they're doing exactly that. I'm moving down in the order of seniority because Ovesh started when he was 21 and Anirudh here started when he was all of 19. Take us through the story of Diganta, and he explained it to me very simply when I asked him. I said, what is it that you're attempting to do? And he said, simplistically, we're trying to create a GPS for space. So in your words, tell the story of Diganta.
Diganta started out of my university when we were working on a similar student satellite team within our university. At that point in time, there was a question that we had: what problem should we solve for? Should we build an Earth observation satellite? Should we put a spectrometer or something else? At that point in time, we had a space agency that we were working with in South America. These folks wanted us to work with them on building the satellite chassis for one of their programs, because we started to work with them in our early days of doing the student satellite team. That's how we sort of started working on space. And the company itself was more of an accident. We didn't plan to do space situational awareness when we started. We started as a space consultancy company. Initially, we were working just on building these structures for just this one South American company, working on avionics, structures, and selling it to them. So the first invoice that we had to raise was in 2018, 2019 time. That's why we started this company, because we had to give an invoice and we had no plans beyond that. So that's how Digantra started.
With or without GST?
I mean, I don't remember, I think. Like, I was deciding whether we should do a partnership company, private limited company, and we ended up registering a private limited company because it sounded more credible. I didn't have any knowledge beyond that. So that's how Digantra started. So even the name, we chose Digantra because we had only one day to, start this process, and in 1 week we had to give an invoice, and I didn't know what to, name this company. We were just like, let's keep something Indian, and we just Googled synonym for space in Sanskrit. First was Antariksh, which was taken, so the MCC folks said you can't take this one. So the next one we chose was Digantra, and that's how the company started. Post which these components that we supplied to went as part of a NASA education launch program, where the satellite was launched, and that satellite stopped working after 6 months because of a debris hit. And that's when we realized that the problem of space debris is huge. And this was back in 2019, 2020, when we had only 2,000 satellites in orbit. Today we have over 13,000 satellites in orbit.
Over 13,000 satellites in orbit
Most
today?
of it is commercial today because of Starlink.
Yes.
So because of that, we realized that at some point in time, you need an infrastructure that you have in aviation sector for space. Let's start working on tracking all of these objects. So we started working towards understanding what are the mechanisms that exist today to track objects in space. Most of them were ground-based, which had atmospheric limitations. So we ended up working on a technology that uses a LiDAR system to track objects in space.
Okay.
And that became our base infrastructure to collect data of every object that's in orbit and build a map. So today, to investors, I often say we build Google Maps equivalent platform, but for space, by tracking every single thing that's happening in Earth's orbit. So that's what we do at Digantra.
That's what you do at Digantra, and what a fabulous story it is, and what a journey the three of you have made. But Srinath, I want to come to you now and talk about what the future looks like as far as space tech is concerned, because we've seen several things change. Policy has changed. It's become much more enabling. It's become much more facilitative. Investors are now starting to see the case for investing in this sector, albeit proportionate to what quick commerce and other consumer tech companies are getting. It's still fairly small, but you've raised in excess of $50 million. It is a capital intensive business. What have you seen as being the big changes, and what continue to be the pain points, the friction areas?
So I think the biggest change from a the sector standpoint is people are starting to think of space more as a like a platform as opposed to a destination. Before, you used to go to space to take photos or to help with communication, and that's about it, right? And it's always around this. But now we're hearing about people who are trying to use space for what it offers. And what I mean by that is, if you're in low Earth orbit, for example, you are in microgravity, you are in vacuum, and if you are oriented right, you can be exposed to very low temperatures, which means a lot of the applications of manufacturing processes, for example, which need these environments for prolonged periods of time, can actually be done in space. So suddenly space has become like a platform, as opposed to like, okay, I've been there and that's about it. That is the whole point. Now it's like after you go there is where the real work actually starts, right? So I think that is a big change, and the reason I'm talking about that is that's what drives money into the system, right? Because the more people start thinking about space as a tool, as opposed to space as a, oh yeah, that's for the rich boys and girls. I think that has to change for the sector.
The very rich boys and girls.
The very rich boys. Yeah, and I think at least on this panel, we all didn't start off with the 200 billion that Elon had. So I think that way in India, which is where the second point I'm coming to, which is the investor point. So a lot of things have changed. In 2017, which is when we formally registered Agnikul, it was a very different thing, because I think hardly any space investments as such. 2 or 3 companies were there, but not too many. Definitely no investors. So today, if you look at it, it's almost, I don't know if I can say this perfectly, but it's almost easy to raise the first 5 million. I don't know if you guys agree. The first 5 million in space tech is not that hard in India.
Not that hard.
In India.
Okay.
Forget globally, in India, which is like a huge deal. Like 5 million in 2017, I would have been like partying all night, right? So I think that is a big change, and that has come from, first of all, the sector opening up. policy becoming much more clear, and general awareness itself is slightly better right now. So the question now is that 5 to the 100 million point. I think now 5 million is not that.
5 million is in the bag. 5 to 100 is the journey we now need to navigate. But always, you know, we were chatting and I was telling you that, you know, when we talk to investors today, everyone's talking about space tech as one of the areas that they're looking at. But are they starting to write the big checks yet?
Yeah, I would say not the big checks in India yet, at least, right? So as I think every year we have raised money, the next year it has gotten easy to raise that round, right? So in 2019...
So what's the 2025 benchmark?
So I think the 2025 benchmark, I pretty much agree with Srinath. 5 to 10 million you can probably get from purely Indian investors if you have not even started generating any revenues. If you're doing really good, if you have a really strong team, maybe, you know, you've hired a lot of people from ISRO, you've built a prototype, and you have strong pedigree, you can probably relatively easily raise up to $10 million today in India. But for you to be able to do beyond that, you have to get foreign investors and foreign money to actually come in.
And you've gotten it.
First to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Esteemed guests and friends, above all today, we express our deep...
The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon.
Well, the Reserve Bank of India's policy was distinctly more dovish than what the market expected. Everyone expected a rate cut, but only a minority expected a change in stance as well to accommodative from neutral. Secondly, very few expected the Reserve Bank to cut both its growth and inflation forecast, even if they themselves had cut their forecasts. This was doubly a dovish delight. Thirdly, post the press conference, some in the market are veering to the view that the Reserve Bank may take the repo rate to as low as 5.25. Finally, the governor almost seemed to assure that he will keep liquidity surplus up to 1% of the deposits. That is around 2 trillion rupees. He didn't say as much, but he seemed to imply that, and that was, of course, music to the ears of bankers. Now, with that preface, let me invite 4 experts to give us their takeaways from the policy. I have with me Mridul Sagar, former member of the MPC, former RBI Executive Director. B. Prasanna, he heads Treasury and Global Markets at ICICI Bank. And Samiran Chakrabarti, the Chief Economist at Citi India. In a bit, we are also going to be joined by the country's biggest banker, the SBI Chairman, Mr. C.S. Sethi. But for the moment, Samiran, Prasanna, Mridul, thank you very much for joining me. Samiran, may I begin with you? Would you have read it like I read it, that the governors almost gave it away, that the terminal rate may not be 5.5, but even lower?
Thanks, Lata. We live in a world of uncertainties, so it's difficult to talk about terminal rates in that sort of an environment. But having said that, I think what I picked up from the policy is, and then governor's press conference, is that he's indicating that about 1.5% is a reasonable neutral rate. And if we juxtapose that on our average inflation forecast of about 4% for FY26, then we arrive at something like a 5.5 on the policy rate, which we believe is very much doable. If we go in the increment of 25 basis points, then it will be already August when we will be going to 5.5. So whether we will need to do a rate cut in October will depend much upon by then what kind of growth signals we are getting. My sense is that we will not allow growth rates to dip below 6%. So if there are signs that we are going there, then both fiscal and monetary policy action could be more aggressive. But otherwise, we would probably pause at 5.5 and see how the rest of the things evolve. But what we have also written in our report is that if the need be, then this is a time when RBI can go below neutral as the downside risk to growth far outweigh the upside risk to inflation.
Okay, then let me take that to Mridul. Mridul, the governor, the Reserve Bank has cut the growth forecast to 6.5. Have they cut it enough?
Lata, to my mind, the growth could fall faster than that and could hit around 6% this year. So that would be an optimistic sort of growth projection, because what we are seeing is some sort of a global shock, which is not ordinary. I mean, I haven't seen this kind of a shock after the Nixon shock of 1971, where gold convertibility was stopped. So on the trade front, this is a very, very serious issue. China has just levied a retaliatory tariff of 83%. So the currency war and the trade wars are going, tariff wars are going to accentuate. So we do not know how the new global order will emerge, how it will get really settled, the whole thing, and by then how much damage to the growth it may cause. So on an optimistic front, I think if we do 6% in the coming year, it should be fine. Indian economy could probably stand out among other peers and stuff. It's hard for the central bank to upfront guide a very lower growth rate, because at the moment it's not in the data. So you would unnecessarily sort of influence the expectations. But I think the policy announcement in the sight of, given that you had a cumulonimbus clouds gathering. I think governor has got it right, and he has actually given a clear guidance in sort of making it accommodative in terms of stance. And he has managed the expectation without really raising the expectations too much, because markets otherwise go well ahead and crunch numbers about the policy rates, as you were saying. They will price it in the asset prices very quickly.
Then let's get to the market expert. Prasanna, what has the market priced in, and what is your own view? Would you also agree that in this cycle, a 5-quarter cannot be ruled out? Or is actually likely?
No, a lot of us have been working with a shallow rate cut cycle up to 6%, and it was very recently that we moved from a 6% repo to a 5.5%. And by the way, our outlook for today was also a 5.5% and a stance change as well. So to that extent, it was as per expectations. But then a couple of things which was a welcome surprise was a decisive method and way in which the governor communicated the change of stance, very clearly indicating what the stance means for the rate trajectory going forward. The other positive was a clear method or way in which he spoke about liquidity and the focus on system liquidity, which he has made in the statement rather than durable liquidity, which gives you the comfort that even if government balances were to be high, the RBI will take care of the system liquidity and hence the banking system surplus. And the third was his acknowledgement that inflation has very clearly come into a durable alignment of headline inflation to the target of 4%. So I think these three were the welcome surprises. And so we still believe that it is 5.5, which is where we believe they will reach by, say, August to October. And this is notwithstanding the global turmoil. And actually, to just add on to what Mridul sir's point was on asset prices pricing in fact, I do feel that the governor was as clear as you can get. And if the global volatility was not there, the bond yields would have fallen even more today.
Oh, exactly. Why don't you take us through that as well, Prasanna? What is constraining us is not the Reserve Bank's policy, but the fact that US yields, after touching 3.9, the 10-year went back to 4.5, almost 4.5%, 4.4, when the governor was making his speech. So do you think that the constraint for the cost of capital in India will not be so much Reserve Bank, but the fact that, y'all are looking over your shoulder at US yields?
So I would just say that it's not going to be a negative impact. It's not as if that because US yields are going to go up, the cost of capital is going to go up for India and Indian companies. It's just that the salutary impact of what RBI is doing, the benefit of that is not going to be fully felt till the time the global turmoil kind of blows over. And the fact of the matter is that when people are doubting US dollar as a safe haven, while I don't believe that it's a sustainable thing, but whatever is happening is giving rise to question every historical market facts and occurrences. And when that happens, and there is a lot of repricing which is happening, and we have never seen in this kind of a scenario where US dollar weaken and bond yields go up. Typically, those are the ones which benefit out of a crisis kind of a situation. But since this is possibly can be placed at the door of US, maybe to that extent, US is paying the price for it. But when the turmoil gets over, when it gets settled, we'll get the benefit. So to answer your question, Lata, I think the benefit of what RBI is doing will continue in the markets. But at the same time, you have to also acknowledge that there is some level, a little bit of uncertainty whether RBI will be able to do what it is said to do if the, the volatility and the turmoil continues the way it has been continuing.
Absolutely. Samiran, that question to you. We are now looking over our shoulder, not just to where dollar index is, as Prasanna is saying, but also what's happening to the yuan. And the yuan showed a distinct devaluation. The PBOC's fixing itself was at, September 2023 levels. What's your sense, therefore, that are we in for ugly currency wars? And how does that impact India and impact policy?
So it could be pretty quick that the tariff war gets translated into a currency war, because in the Trump 1.0 episode, we saw that the yuan moved almost 14% in a very short period. So there is a possibility that we see a repeat of that occurring, although the circumstances today are very different. The extent of tariffs that we are talking of is very different from that period. Now, question for India would be to what extent India follows the yuan movement one for one, or would we have some sort of flexibility in addressing these issues? We will not join that currency war, so to say, because what might at least theoretically occur is that if India does not depreciate as much, in a negotiation with US, that might turn out to be a slightly more favorable backdrop for us. So this balance will have to be struck. But at this point of time, the 40-country RER for INR is bang in the middle of the range that we have historically seen. So from a valuation perspective, we are starting off on a very neutral footing. We have the possibility to move either way, depending upon whether we need to support the exporters or we need to have a better bargaining position in that US trade negotiation.
I don't know what the negotiators are even looking at. If you looked at the way they fixed tariffs, they don't seem to give a damn about tariffs or non-tariff barriers. They just want the bottom line. Don't have a trade surplus with me. I mean, let's see what turn the negotiations take. Mridul, would you say that we are in for reasonably not just disinflationary but deflationary times? Considering that there is excess capacity in China, and even without probably counting that, the Reserve Bank throughout this calendar 2025 is forecasting no time when the inflation will go above 4%. They have sub 4 for all the three remaining quarters. So do you think we will be in for an even worse deflationary shock?
I would hesitate to say we would be in deflationary shock. Yes, disinflationary, definitely. And we could go down below 4 for sure. But disinflationary would require a massive kind of a global commodity price fall. Today, obviously, Brent crude is trading at almost 58.58.5. So it looks like we are heading somewhat in that direction. But even with those kind of numbers, given the nature of the Indian economy, even if we get a negative inflation, it would be very, very ephemeral at some point. I don't see it as a sustained negative inflation coming into being. In any case, the other thing is it would add to our sort of kind of space for the monetary policy to act. Today, we are at neutral rates, in my view, Lata, like with 4.4% inflation expectations 1 year down the line. Our real policy rate is at 1.6%, which is almost the middle of the range which RBI has given in terms of the neutral rate. But we can go accommodative from anywhere between 50 to 150 basis points, depending on how the multiple equilibria evolve in this setup.
Okay. Well, we have to come to the close of this conversation. So some rapid fire. Mridul, what is your biggest fear for India from this, ongoing trade and currency war? Very briefly.
So if the world gets divided into two trade blocks, for instance, I think it won't really help India. So we have to sort of manage this process. And we hope that in due course, things get resolved. And we would be back.
No, quickly. I don't have so much time. Your biggest fear is that we get hurt if there are two trade blocks.
Yeah.
Samiran, your biggest fear, what does 2025 can hold?
Uncertainty.
Oh, okay. Yeah, that is there every day. We are so scared to even write a headline. Prasanna, what range will you give for both 10-year, for the end of the year? I know it's a long time, and for the currency.
So I think currency is possibly the relatively easier part. There is a depreciating bias, Lata, as long as there is going to be a tariff war, there is going to be depreciating pressure on yuan and all the EM currencies. So while the dollar will weaken, it will weaken against the developed market currencies, and the EMs will continue to weaken against the dollar. I think that's one part. And on the bond deals, again, I think it's going to be a gradual move lower. Like I said, if there is a comfort that U.S. market dislocation and bond deals in the U.S. are not going to go out of the whack, then I think we can be a little bit more confident of the downward part towards interest rates. But I'm still willing to say that this quarter we will see yields heading towards 6 quarter.
Okay. Well, out of time, Mridul, sub 6% growth possible?
Possible, but at the moment, baseline looks like 6 to 6.2.
Okay. Samiran, same question.
So our baseline is 6.3, but we have said another 30 basis point downside risk if tariffs are more permanent in nature.
Okay, I think then both of you are in the same terrain. Thank you very much. Unfortunately, out of time. And in any case, new questions and new issues are going to be thrown up by the hour. So we will touch base with you. Thank you very much, Prasanna, Samiran and Mridul, for giving us a quick take, not just on the policy, but also on this terribly uncertain environment in which we find ourselves. We have to go into a break. Don't go anywhere. We're going to be joined by the biggest banker of the country, State Bank of India's chairman, C.S. Setty.
To our visionary Prime Minister, Shri Narendra Bhai Modi ji. Pandit Deen Dayal Energy University owes its very birth to his extraordinary vision. All of you are benefiting from what Narendra Bhai thought in the early 2000s. And when he called me and said in 2005 that we have to build one of the finest institutions in Gujarat, right? And that is what we have achieved from 2007 onwards. So we will always be grateful to our Prime Minister. Long before he became Prime Minister, he foresaw that India needed Atmanirbharta in energy. Over 20 years ago, he told me he wanted Gujarat to lead the nation in energy and energy products. He also told me that Gujarat should take the lead in cultivating world-class human resources needed to achieve India's clean energy ambition. That is how he helped establish this pioneering university. Friends, there are many things that we learn from our beloved Prime Minister. Let me mention just 2 lessons here for all of us. 1, Modi ji never lets a good idea go to waste. His Man Ki Baat inevitably becomes his Man Ka Sankalp. His Sankalp is always Vajra Sankalp. His determination is as hard as a diamond. He does not rest with simply making a Sankalp. He knows how to turn his Sankalp into success. In the last...
Welcome back. We are watching our special coverage of the Reserve Bank of India's monetary policy. We just spoke to some economists, but now we have the country's biggest banker, State Bank of India Chairman, Mr. C.S. Setty. Mr. Setty, thank you very much indeed for joining us. Well, much discussion came about transmission of rate cuts. It gets transmitted to loans because it's connected. Loans are linked to the repo rate. What is your expectation in terms of the first deposit rate cut? Does it happen in April?
Thank you, Lata, for this opportunity. Yes, I think I've been watching your discussion. Obviously, the monetary transmission cannot happen only through the loans. So obviously, liability side, that is deposit side. Some transmission should happen. The extent of deposit rate readjustment or cut will depend on 2-3 things which are specific to a particular bank. One is what are their LDRs, high LDRs, probably there's only so much room the bank may be doing. and also the liquidity available to them internally. The LDR and liquidity are broadly related. And I think, but more or less in this quarter, most of the banks would be looking at adjustment in the deposit rates. This is our assessment.
Okay.
And
Mr. Sethi, sorry I'm interrupting. You are the best bet for the Reserve Bank in terms of liability transmission or transmission of rate cuts, because you all have a deposit franchise. You have salary accounts. Unlike younger banks who are depending on many of their current and savings account or current accounts at least coming from mutual fund deposits, you have stable deposits. You have, I think, the highest salary account. As well, I hear from the market that certificates of deposits have already started falling, probably by 1 percentage point. Bulk deposits have fallen. Have you seen that? Bulk deposit rates falling? And therefore, I'm asking you, will you be able to manage a deposit cut in the month of April?
In the rate cut cycle, obviously the first adjustment in the rates will happen on the bulk deposits, which we have seen even post 25 basis point rate cut. Okay. It might not have reflected very well in the March quarter because everybody was scurrying for deposits. But we have seen that the rates got softened on the bulk deposits. In terms of retail deposits, as much as it is both an advantage as well as, in a way, it's a challenge for a franchise-based bank like ours, where we need to compensate our customers properly. So it is just not that we have a large franchise and we have a large deposit base we cut aggressively. I did mention, Lata, earlier also that the deposit rates for SBI is a combination of our requirement for deposits as well as compensating our customers adequately. Okay. I think that is something which we need to be careful about.
Okay. So anyway, the key takeaway for me is that you are expecting cuts in April itself. Your depositors may be upset, but your investors will be happy that margins will perhaps be protected. But do you think margin pressure continues for the April, May, June quarter as well? So
I won't be able to talk about our margins, obviously, but in general, as the transmission lag is there on the deposit repricing, because whatever interest rate reduction on the deposits will be on the new deposits which are coming in. We have this stock and flow concept, right? The stock will remain till the maturity. The flow gets repriced. So whereas the loans, particularly repo-linked loans, will get immediately repriced. Lag will put some pressure on the margins, definitely.
Okay, fair point, and that's everybody's problem, which is why we are, even though I am fundamentally a depositor, I keep talking like an investor. Let me come to the other banking-related announcements that the RBI made, which are more draft rules. I don't know if you had enough time because it was a bunch of draft rules that the Reserve Bank has put for consultation. There are gold loan rules, which is a consultation paper or draft rules. And there are rules on co-lending. First, the gold rules, are they stricter? Is there anything new about them? If you can even give us one or two.
So I did go through quickly. I haven't had the time to really deeply analyze that, but I think it broadly looked like what Governor mentioned in his interaction, that it is more in terms of the conduct related to the gold loans business, number one. Number two, harmonization of these guidelines or the directions across the regulated entities. I think this is something what is coming out. And when we looked at our own compliance, I thought that more or less in terms of the limits, caps, assessment, auction, most of the guidelines we are in compliance, which means that it is more in terms of standardizing the guidelines across the regulated entities.
Fair enough. There were some bankers who said probably the Reserve Bank means that this 75% loan to value, which NBFCs adhere to while giving the loan, may not be adhered to during the life of the loan, if the interest is calculated. So maybe that's what they're setting right, but that is still a matter of guesswork. What have you made of the...
They did make mention about, the LTV being maintained through the life of the loan, yes.
Okay. Okay, so then that's certainly a new rule for NBFCs in particular. What about the co-lending? Do you think the fact that you can do co-lending not only for personal, for priority sector loans, but all kinds of loans, how does that change the terrain?
So large bank like ours, obviously, we will be sticking broadly. We haven't taken any decision as such, but I think our focus on co-lending has always been in terms of tying up with NBFCs, MFIs for PSL purposes. Okay. And I think that will continue. But if any small bank would like to expand their reach and expand the last mile connectivity through these NBFCs, I think this is a good opportunity to have non-PSL also in the co-lending.
Okay. And finally, they have also announced new rules in terms of securitizing stressed assets. Until now, the ARCs were the kingpins of stressed assets. Do the new rules expand the terrain? I mean, do they bring in PEs and vulture funds and special situation funds? Is that a good move?
It is definitely a good move. There are for two reasons. It's not only about new entities which will come in terms of buying these pooled assets. The pooling of stressed asset is also something what did not have much clarity in terms of the regulatory point of view. While we did attempt in the past putting the pool together and selling to an ARC, we do have some experience. But expanding beyond ARCs definitely will bring new capital required for this securitization purposes. More importantly, I think the draft guidelines also defined what is a pool of stressed assets and what are the pools which cannot be securitized even if they are stressed, like educational loan, farm credit. I think there's a lot more clarity in terms of what securitization and pooling, what we can do. I think it's a good move in my view. And there are also resolution entities which have been brought in, which means that the capital is brought in by an entity and also a resolution entity, including incidentally, ARCs also can be a resolution entity. So
yes.
I think the ARCs will not become irrelevant. I think still they will have a role to play.
No, I'm sorry if I conveyed that idea. What I meant was that they were the only guys in the play. Now, perhaps, there can be more actors. Just a final word, sir. What's your sense in terms of loan growth? There is a bit of a gloom because of the tariff war. Should we be prepared for, some slowness or, much slowness in the economy and therefore in loan growth?
I'm quite optimistic in the sense that if the inflation, liquidity, and the growth rate, even if it's slightly moderated at 6.5, are the ones which we are looking, which means that 6.5 real GDP and 3.5% inflation, we are broadly at nominal GDP of 10% as the budget expectation. Credit growth is generally 2 to 3% over the nominal GDP. So if these numbers play out, I think we would be looking at 12 to 13%. There would be some seasonal variation from one quarter to another, but I think broadly we will be.
Just one very quick question that occurred to me. Are you worrying about bad loans in the export sector?
See, I fully agree with the governor. What he said is that the overall export in the economy, the GDP is also small. Number one, number two, the export credit incidentally is much smaller. Many of the export-oriented entities are cash rich. It's good as well as bad for us because we have never been able to lend to them in a big way. But it is also a fact that if they are not leveraged so much, we don't have to worry about the asset quality.
Okay. Oh, that's a big relief actually at a time like this. Maybe you will get more business with them. Thank you very much, Mr. Sethi, for explaining a bunch of things that the monetary policy threw up. And we do hope that FY26 is a good year for you and for SBI. Thank you very much for joining us.
Thank you.
Well, we have to wrap up on this special broadcast on the monetary policy. Thank you for watching. More news and headlines follow.
The world has seen how he especially chooses impossible-looking tasks and transforms them into reality. This, for all of us, is lesson number 1. Lesson number 2 is about his boundless energy. Narendra Bhai Modi's name stands for Anant Shakti, infinite energy. Since PDEU is an energy-focused university, all of us should learn to be as energetic as our Prime Minister. People often ask the question, where does Modi ji take rest? Or does he rest at all? I can tell you that I know the answer to this question. The answer lies in what Pandit Deen Dayal Upadhyay ji has said, who is the founder and whose name this university bears, has said about rest or Vishranti. He has said, Kaam mein badlav hi Vishranti hai. Change of work is itself rest. And I think this is our Prime Minister's motto. This should be our motto, dear students, also. Therefore, when we think about these two lessons, how to turn ideas into action and how to work tirelessly, we cannot escape the conclusion that Narendra Modi ji is not only India's Pradhan Mantri, but for us and this university, he is our Gurudev, our respected teacher, and we will follow his learnings.
आज जैन समाज का एक कार्यक्रम था बड़ौत में सीपीएल स्कूल में, जो पिछले 30 सालों से हर साल होता है। और यहाँ पे एक वुडन स्ट्रक्चर था जो कोलैप्स हो गया और अराउंड 40 लोग जो हैं वो घायल हुए हैं और उन सभी को 108 की एम्बुलेंस समय वहाँ पर मौके पर पहुँच गई थी। सबको हॉस्पिटल पहुँचा दिया गया है और 20 लोगों का प्रथम उपचार करके उनको घर भेज दिया गया है। बाकी 20 लोगों का उपचार अभी चल रहा है।
Hello and welcome to Business 360. I'm Arundhati Ramnan and here are the headlines that we're tracking for you this evening. The global trade war escalates. China hits back with an 84% tariff on US after Trump administration imposes a levy of 104%. The US reciprocal tariffs on nearly 100 nations, including a 26% levy on India, kicks in today. Trump says countries are calling him dying to make a deal, also threatens pharma tariffs very shortly. The Trump tariff sell-off resumes worldwide. Stocks tumble across Asia and Europe, but China bucks the trend thanks to strong domestic buying.
I'm Sanjay, but I'm not Sanjay of Mahabharat to be able to, foresee that far.
Reserve Bank cuts repo rate by 25 basis points as expected, changes policy stance from neutral to accommodative. Governor raises the red flag on tariffs, says he worries more about the impact on growth rather than inflation, refuses to predict where rates are headed amidst the tariff wars. RBI cuts GDP forecast for this fiscal by 20 basis points to 6.5%, highlighting global risks and the tariff tensions. Also cuts inflation forecast, citing greater confidence in aligning with the 4% target over a 12-month horizon. Weak global cues dent the Lal Street. Sensex loses over 380 points. Nifty drops below 22,400. Rupee weakens for the fourth straight session against the dollar. External Affairs Minister Jaishankar says it is impossible to quantify the impact of US tariffs, remains hopeful of a bilateral trade deal, saying India is the only nation which has reached an understanding in principle with the Trump administration.
don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement.
Noted American economist Jeffrey Sachs warns India about getting closer with the United States at the expense of its ties with China. Says India should not be anti-China to please the U.S. That's an exclusive. Indian government approves a 63,000 crore rupee deal to buy 26 Rafale marine jets from France. The government-to-government deal is expected to be signed shortly. The big story this evening, U.S. President Donald Trump's reciprocal tariffs on about 90 countries took effect today. The sweeping tariffs, which hit U.S. allies and adversaries alike, are in addition to a 10% baseline levy, which came into effect last Saturday. The tariffs include a 26% duty on all Indian goods exported to the U.S. China has been hit the hardest by the tariffs with a net levy of 104%. Expectedly, Beijing has hit back with additional 50% tariffs, taking the total levy to 84% on U.S. imports. The new tariffs will come into effect tomorrow. The country's foreign minister had said earlier that it is ready to fight to the end if the U.S. insists on waging a tariff war. China has also added 12 new American companies to its export ban list. USA's Treasury Secretary Scott Bessent has called the move unfortunate. No country has successfully secured a formal exemption from the newly imposed U.S. tariffs so far. However, Trump said his government was working on tailored deals with trading partners. The White House has said that it will prioritize allies like Japan and South Korea. Speaking at a dinner with Republican lawmakers, Trump insisted that countries were dying to make a deal.
This is the largest transaction in the history of our country. And don't let some of these politicians go around saying, because I'm telling you, these countries are calling us up, kissing my ass. They are dying to make a deal. Please, please, sir, make a deal. I'll do anything. I'll do anything, sir. And then I'll see some rebel Republican, some guy that wants to grandstand, say, I think that Congress should take over negotiations. Let me tell you, you don't negotiate like I negotiate.
The ratcheting up of U.S.-China trade tensions, followed by Trump holding his ground on the historic tariff levies, weighed on global equities. From Wall Street to Europe to Asia, stock markets remained under pressure. U.S. equity futures currently trading with cuts of close to 2% after China's latest tariff measures. The U.S. equity market has already lost 11% of their value in the last 4 trading sessions and is expected to see a weak opening. The sell-off resumed across the Atlantic over a one-day break. The frontline indices all trading with losses in the range of 3%. China, however, bucked the sell-off trend in Asia thanks to strong buying from domestic buyers. In fact, mainland Chinese investors bought Hong Kong stocks worth a record $4.6 billion as well. Back home, a volatile day on Dalal Street saw the benchmark indices ending with cuts of 0.5%. However, the Nifty and Sensex ended off the day's lows